States, where we're down circa 1%, and what we're seeing here in Europe. So you've got the Stoxx 50 down around 0.2%, FTSE down a little bit more, 0.3–0.4%, DAX down around 0.3%. We're down less than 0.5% in Europe, whereas we're down a lot more in the United States. Now, Europe didn't climb as much on Friday, and therefore maybe doesn't have quite as much to fall. But it'll be interesting to see whether or not there's more downside as we work our way through the early stages, Critty, of the session this morning.
Absolutely. Today, the focus may perhaps be on the deficit, the Moody's credit rating, but the tariff impact still very much showing in some of the narratives when you hear about the individual stocks. Ryanair is one great example. When we're talking about the U.S. impact, a lot of worries about whether or not people still wanted to travel this summer to the U.S. and even within Europe as well. It looks like Ryanair is saying the latter is true, where they are seeing some increased summer travel demand, but sticking to those domestic borders. And that's going to be something that comes in line with the share buybacks, perhaps received quite with open arms at the open. Diageo as well, talking about increased sales growth in the second half of the year, saying that their tariff story can be cut in half. The tariff impact can be cut in half because of cost cuts to the tune of about $500 million. Then, of course, some European news in the banking sector. Commerce Bank as well in the spotlight, as Joe Easton was telling us earlier, Guy. Friedrich Merz saying no risk of UniCredit taking over the bank at the moment.
Those are some of the single stocks that we are going to be watching. Let's talk about the top-down macro picture. What are we seeing in this market this morning? Remember, it was only a week ago that we were talking about the trade deal with China and the huge effect we saw off that. This morning feels like a very different narrative. The FTSE 100 down as expected a little bit this morning, but not by much. Let's call it 0.2%. I round up, but we are anticipating maybe 0.3%. These are small margins. The Stoxx 600 is down by 0.3%. Again, I round a little bit higher. But these moves pale into comparison with what we're seeing over in the United States, where we are seeing obviously futures significantly lower. The DAX, clearly nothing is happening in Germany this morning because the DAX is open quite quickly, and we are down by 0.2%. The IBEX is a little softer as well. The CAC out early as well. Europe is not the story this morning. We're down by 0.4%. None of this really, I think, really gives us much of a steer on how markets feel, because the focus is very much on the other side of the Atlantic. What is happening with the downgrade? What is happening with the deficit story? All of the politics being folded in as Trump returns off his Middle East trip to what is a very different picture, you could argue, in Washington this morning. But that's something maybe for a little bit later. This morning, European markets a little softer.
A little softer on the index level, Guy, but I feel like when the news, when we get a little bit of a respite from the news and the tariff story, it's worth paying attention to some of the individual stock moves as well. So a bit of a mixed picture when you look at the sector story. Healthcare, telecom, travel, leisure, utilities, all in the green. The rest in the red, but again, by tiny margins. I think it's the individual stock story we need to be paying attention to, because from an index perspective, your biggest contributions to the upside are Diageo and Ryanair, both of which are very much reflecting and talking about the impact of the news coming out of the United States. I think Diageo is the key one to focus in on, just given that that is the weighting that is moving this market the most, both in the FTSE and the Stoxx 600 as well. Remember, they had talked about $500 million worth of cost cuts, and so the tariff impact is about $150 million. Mix that in with some higher sales growth in the back half of the year. And they're saying the tariff bite may not be as big as its bark, or at least what the stock market was pricing in. Those shares higher by about 1.6% this morning. Ryanair also very much in focus. That buyback story helping them out.
So Michael's interesting on this. He was hinting in his conversation with Tom this morning that actually maybe he'll take more of a back seat on the buyback because everybody else seems to want to buy my shares. Why should I be chasing it? Which I think is a really interesting point. So he's just thinking about kind of what he does with the buyback going forward from here. He's quite confident in what the share price is doing. The biggest effect for Ryanair right now is what is happening with the oil price. It is huge. They are hedged at the moment in the kind of the 80s. That's going to come down into the 60s. That is a huge tailwind for Ryanair. If they can lock in that kind of effect in summer 26, summer 27, that's going to have a massive impact on the bottom line. So it's going to be interesting to see whether or not the oil price, and you see what's happening with BP this morning. BP down, Ryanair up. Just that's the effect that you're seeing. Oil price majors are giving back some ground. Ryanair is up. It's doing very well. Remember as well, actually that's a longer term chart. My eyes deceive me. The story this morning is still on what is happening with the deficit story, but it's the other thing I just need to mention as well is lots of ex-dividends in the market. BNP is one of them.
Absolutely. We're going to keep an eye on those. And of course, like I said, today is a day where we don't have a macro narrative necessarily moving this European market. Some of the individual stocks are floating to the forefront. Let's bring in an expert here. Emmanuel Cao joins us around the table, head of European equity strategy over at Barclays. Pleasure to have you on the program. Thank you, as always, for coming in. Talk to us a little bit about how we should be thinking about the bond market moves off of the deficit sources, I'm going to say this right, off of the deficit story in the States, but also the deficit story here in Europe. How does that get factored into the calculations around the equity market?
Yeah, good morning. I mean, I don't think the Moody's downgrade is really a game changer. I mean, this should not have a tangible impact on the bond market, or I don't think any forced selling of treasuries or any issue on the money market, etc. But this is just a reminder that the weak link here is the bond market, right? And to some extent, all the other markets, all the other asset classes depend on the valuation on the bond market, right? So we do have a preference for equities over bonds because we think equities have earnings and a pretty resilient corporate sector as backstop or support. And bonds are basically backed by weaker and weaker governments in most developed markets, basically. But I think we're getting to a point where after 15-20% rallies in equities, which was largely valuation driven, obviously equity market is getting again more sensitive to valuation and bond yields. And what we've been saying is that 4.5% 10-year yield in the US, 5% 30-year yield in the US are getting close to the danger zone for equities. If you look at the last 10, 15, 20 years, whenever we got to those levels, we started to see a bit of wobbles in the equity market. So we're going to need at some point earnings to really support the equity market. And I think for the equity market to really shrug off this persistent pressure from rates, we're going to need to see at some point more evidence of earnings resilience and growth resilience. I think this is where the debate is in the market right now. Can the equity market cope with higher yields if they're here to stay?
So historically, when we've seen that 5% level, for example, in the bond market, it's been because it's harder then for, say, a big tech company like Apple or whoever to then go in and borrow at those levels, right? That's the logical piece. There's another story here of whether liquidity is a positive or a negative in that factor, and that if you're holding more cash, a higher bond yield actually hurts you. But if you're but you could also be holding more cash and actually helps you navigate the situation. In this environment, is more cash on a balance sheet a good thing or a bad thing?
I think it is a good thing, and what we've seen, by the way, over the last couple of years is a pretty resilient corporate sector coming to its own rescue whenever we had stress in the equity market. So buybacks, for example, share buybacks, have been a massive source of support to the equity market. And I think in the last couple of weeks, again, we are seeing buybacks really contributing to this rebound in the equity market. And the cash-rich businesses, buybacks-heavy stocks, have been basically outperforming for some time. So yes, if you're having a strong balance sheet, a lot of cash to deploy or to invest in your business, you might be able to cope with this bond market volatility. If you have very poor balance sheet or high leverage and the cost of funding are going higher, that's going to be an issue for you. And there's a clear polarization in the market between good businesses, good balance sheet, and investors want quality basically as the number one factor in their allocation, and the low quality stock which have been lagging mostly in the last couple of years.
This time last week we were talking about China and the trade deal. It's amazing. It's just a week ago. Was the market too quick to price in the all clear, to say that everything's okay again, back up, almost in a straight line off the lows that we've seen? What do you make of that? What signal do you take away from it?
My signal is that there is a clear, I think the Trump administration is very willing to de-escalate this as soon as possible. And even though we lack real substance, so there's still a lot up in there and to be negotiated, I think those positive trade headlines will keep feeding market optimism, right? And I think there are reasons to see the glass being half full in a sense that we still don't know where the tariff will settle, but there is a path toward de-escalation. And we are yet to see more deals with other countries, but the big one was China, and we've gone from 25% aggregate tariff to 14, which is very much close to what was our base case ahead of Liberation Day, right? So I don't think tariffs are the key market driver anymore, but obviously.
So what is the key driver now?
I think it's very much, the bond market now, the fiscal policy in the US, the tax bit, that a lot of what Trump will be doing on the fiscal side will ultimately depend on the resolution of this tariff crisis, right? So we think there is still room for de-escalation on the tariff side, and I think there's still a lot of concern in Europe in particular about tariff. Even though we're not talking about it today, there's still a question mark about the deal that we're going to have at some point between US and Europe. If you are seeing confirmation that 10% is a tariff that we're going to have in Europe, I think the market will be able to move on, right? So a lot of good news are priced in, but I still believe that, as the market gets more positive headlines on this de-escalation between US and other countries, that might still help to keep the glass half full for investors.
What's going to outperform going forward? Is it going to be US equities? Is it going to be European equities? Or as Michael Hart has been pointing out over at Bank of America, is it going to be emerging market equities? What do you think is primed as you look across the landscape and you go into meetings and you get kind of feedback from everybody? What do you think is the kind of the area of outperformance that we are going to see in global equities?
I mean, there's a lot of hype around this Sell America, and maybe it got a bit overdone at some point. And what we saw in that post-Liberation Day relief, we had US actually outperforming the rest of the world. But I think there's still a lot of appetite to diversify away from the US. Look, on our side, we turned overweight emerging market ex-China equities compared to the rest of the world months ago. So we're seeing a weaker dollar, and tariff de-escalation should be supportive of emerging markets. Their central banks are in a much better position to support the economy. They don't have too much inflation to fight in the first place, and we are in the pro-European camp. It's not smooth sailing when you invest in Europe because there's always something to worry about, and the execution risk on the policy front is very high. But again, what we are seeing this morning between UK and Europe is a step in the right direction. It's more convergence on the policy front. Europe has less of an entrenched inflation issue to deal with. And again, there's a bit of pro-growth mindset coming back, and what Germany hopefully will be doing should be a game changer for the region, right? So valuation are cheaper in Europe, positioning is cheaper, the growth story is pretty decent, and we think there is far less of a political risk on the market.
How far do you think that trade has gone thus far?
Well, Europe is still cheap. Europe is still trading in line with long-term average multiple. If you look at the long-term investors or asset allocators, they are not overweight Europe. Right. Germany is still trading below the long-term average. Earnings forecasts are 3% in Europe, 10% in the US. So yes, there's a lot of hype, as I said, around this Sell America. And now Europe has to deliver. I don't think the trigger, I don't think the hurdles they have to clear is that high. And I think the bar for positive surprise is getting much higher for the US.
I mean, valuations has never been Europe's issue. No one has ever said Europe is too expensive to own, or if they have, there are rare moments in history where that's happened. Arguably, in the first quarter of this year, people said maybe this was gone a little bit too far. Growth has always been the concern, but can you really trade the policy convergence, as you say, between the UK or the EU, or can you really? I mean, I'm curious how much faith you can really put in this fiscal spend coming out of Germany, something that's earmarked for 10 years. What kind of visibility do you have in 10 years when the rest of Europe is still struggling to generate growth?
I think there's a narrative now which helps us invest in Europe. And I agree with you that, we're going to have to deliver on that. But I think we have now capable people in Germany, driving the policy agenda. To some extent, again, positioning is not very high. And I think there's appetite to diversify away from the US. So South America is half of the story, but you need something to capture the money. Elsewhere, I think this shift in the policy dynamics in Europe, where now there's a bit more self-help and, again, intention to support the economy, might help, right?
Is lower yields in Europe, there's talk this morning of cutting rates below 2%. How big a factor, how big a tailwind could that be?
I think the growth policy setup is more favorable in Europe. Again, we don't have a huge inflation issue. Yeah. There's more room for the ECB to cut rate. Germany doesn't have a fiscal imbalance. They have too much, basically, savings. They have too little deficit, so they have fiscal headroom to support the economy, which is a luxury these days. Not many countries in the developed world have excess fiscal capacity, basically, right? So again, the narrative is exciting. Now, can they deliver on that? Time will tell, but I don't think the price to pay to believe it's going to work is that high. If you think about the US, you are paying more than 20 times to believe that the US can maintain this exceptionalism. And that's obviously, coming with a maybe less exciting risk reward.
But if the argument, and you made the argument on Europe here, if the argument for Europe is the fiscal spend that may be coming down the pike, why aren't the funds going in more force to Asia or China specifically, where the fiscal spend is much larger and the reach for those companies are much larger?
We think they should. I mean, that's why we went back to emerging market a month ago to say, look, there's an opportunity in emerging market. We think the inflation backdrop is much more favorable. We don't see much of a fiscal issue there. We think there's a valuation argument to own emerging market. And in a world where dollar is likely to stay weaker for longer, that makes life easier for a lot of emerging market central banks, right? So I think there's a case for broader diversification away from the US. But this is just starting, and bear in mind that investors for the past 20 years were very much in love with US exceptionalism. It takes time for people to change their mindset and their investment strategy, right?
The muscle memory of the last 15, 20 years, buy the dip, buy the dip, buy the dip. That takes a long time to come out of the story. Nice to see you. Thanks indeed for stopping by to see us. Manuel Coe, Head of European Equity Strategy, joining us from Barclays. Call 6, quick look just to see what's happening. This is the picture you find yourselves with this Monday morning, fairly mixed. A little bit of defensiveness, as you can see, with Nestle maybe trading a little bit higher. But broadly, the tech sector under a little bit of pressure as we look to maybe some weakness coming out of the United States. Joe's got his eyes on Ryanair, which appropriately this morning is in the green. Joe.
So Ryanair is doing well, as you say, Guy, in the green pretty firmly today. One of the best performing stocks in Europe. We're up around 4% at the moment. Now, some of the quarterly sales actually look a little bit weak, but the guidance in terms of where the bookings are going into the summer or the end of the summer, towards the end of the summer, do look pretty strong, according to analyst notes I've been reading today. And also, potentially those comments around the trade war, the tariffs not having a huge effect, as O'Leary was telling Bloomberg earlier today. Positivity coming into that stock. So we are up a good 4% on that one for Ryanair in the airline space. Then over in drinks, Diageo doing well, up 2.5%. The company's net sales, again, it's pretty much in line with where the consensus was, but some people probably expecting a bit of a downgrade. And then another thing I read was that North American consumers potentially bringing forward some orders, so pubs and restaurant chains buying up some of the Diageo products ahead of tariffs coming through. And finally, Diageo actually holding an investor day at the Guinness factory in Dublin tomorrow. That is probably the best place you could ever have an investor day. I'd love to be at that one, but that's in the focus for Diageo, the maker of Guinness, gaining it today around 2.5%. Then in terms of M&A, the tech space, we do have Just Eat getting this bid, an all-cash bid from Prosus. They've got the price on that. It's just above 20 euros. We already knew that this deal was coming through, but that is very slightly higher than I think some were expecting. So the stock edging up very slightly, not too much of a gain, but it is in focus on the M&A front. Then the other M&A story was Commerzbank. The comments out of Italy, or out of Germany rather, that they do not expect an Italian takeover, and a takeover by UniCredit to come through anytime soon. We're seeing some calls on that one very slightly lower, but pretty much in line with where we were trading on Friday for Commerzbank. But those comments from Merz, the Chancellor over in Germany, saying they don't expect a takeover anytime soon. Nonetheless, it is on our radar. Then another one on our radar was in Alzheimer's. We did get news of the FDA clearing a blood test for Alzheimer's. That is seen as positive for companies making drugs to treat Alzheimer's. So we're seeing BioArctic up. We're seeing a little bit of a gain in Roche as well, but that one in focus today. There we got Roche on the screen, up 0.2%, potentially some positivity on the Alzheimer's front, lifting those stocks this morning.
Joe Easton from our equities team walking us through some of those early movers. We thank you so much and certainly appreciate it. From an index level, it's still fairly quiet despite the movers that we are seeing, at least here in Europe. Stateside, a different story.
It's getting uglier and uglier as the morning progresses. You've now got NASDAQ futures down by 1.5%. You've got E-mini futures, the S&P, down by 1.2%. So people dismiss this ratings downgrade. But there is a wider picture, which is kind of the deficit matters, what is going on is really important. And the politics, yeah, we're kind of inching maybe towards a deal, but there's so many hurdles still to cross in terms of what this deal is ultimately going to end up producing. I really don't know. But the knee-jerk reaction is maybe it's time to roll over some. Like, it's a week ago since we had the great treasury. It's just taken a week, and suddenly that's kind of the tone has shifted, and the Nasdaq is off pretty hard. You're seeing that reflected in European tech stocks this morning. Names like ASML are down, so you're getting the AEX underperforming. The London market's also underperforming. There's a huge number of ex-divs in the market this morning, so you're going to kind of park those. But we have been rolling over since the get-go on US futures, and it gets uglier and uglier as the morning progresses.
Absolutely. That's the equities picture. The bond story, as you pointed out, the deficit story really driving that one. It's the sustainability and the sustainability of the volatility, and that if you were starting to see bigger spikes of the long end of the curve, how much can the corporates, like let's say your big techs that have the most liquidity, actually navigate those? And how quickly does that volatility show up in things like financial conditions and the ripple effect into mortgage rates, et cetera? And that's where I think September 2023 is the key quarter to look at, because we have this exact conversation. Deficit, politics, a budget, a treasury sell-off. We weren't at Sell America just yet, but we were getting there. And I'm just curious how much time we need and how much margin of a move we need before people really hit the panic button.
Yeah, it doesn't feel like they were quite there yet. This doesn't feel like panic this morning in any shape or form. It's interesting, actually, you are seeing a bit at the front end. So actually the curve's steepening up. So this is there are two different narratives being told in what is happening in the United States as well. But yeah, no, like 5% on a US. Jordan Rochester was talking about 5% on a 10-year.
Yeah.
I think that would cause some consternation by the end
year
of the
end.
year. By year end.
Yeah. The 10-year still very much within its range at right now, 450 on that Treasury yield. Coming up, we go right back to the micro picture. Ryanair saying the biggest threats to profit growth this fiscal year are tariffs and geopolitical risks. More from our interview with the airline CEO, Michael O'Leary. Next, shares higher by about 4%. Stick with us. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bring you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
Look at Ryanair this morning. The shares are up really quite strongly on the back of the ongoing buyback, which is something that Michael maybe will kind of tamper down a little bit going forward from here. But demand still looks really good. That's really positive for the summer picture going forward from here. You've got this buyback being announced. You've got a fuel story which looks great. The stock is up, therefore, really quite nicely. We spoke to Michael O'Leary, MOL, a little bit earlier about the outlook.
I was written to by some U.S. lawmaker asking me not to guarantee that we won't buy Chinese aircraft, and I wrote back politely saying, go to hell. I'm not giving you, we will reserve the right to buy aircraft wherever we so wish. We remain a big...
Not certified yet, COMAC?
No, they're not certified and won't be certified for another 5 or 10 years, but been written to by some congressman in the US whose iPhone was made in China, asking Ryanair not to guarantee not to buy Chinese aircraft.
Yeah.
We would give no such guarantees. I mean, I don't see any great prospect of us buying a COMAC aircraft. The Boeing are making great aircraft. You look at our numbers this morning, an awful lot of which are being driven by the Boeing MAX 8200s. Those aircraft offer us 4% more seats. They're burning 16% less fuel. They're transforming our economics. And I think you add those new aircraft to the declining cost of oil for the foreseeable future. And I think not just Ryanair, but the airline sector in general looks set for 2 or 3 years of reasonably strong earnings.
Talk to us about the oil price. I mean, you're seeing prices now about $62 a barrel on Brent. You hedge around oil prices. Are you hedged to the upside, or are you well protected on lower prices?
No, I mean, we hedge straight for jet fuel into plane. We were hedged in the last year. So the results this morning, we were hedged at $79 a barrel. We're 85% hedged this year at about $76 a barrel, about a 4% fuel saving. We took advantage of the uncertainty post the Trump tariffs or Independence Day, whatever it was last month. We hedged about 40% of summer 2026 fuel at about $66 a barrel. This is jet. Jet at the moment, spot is about 67, Brent is 62. That's about a 13% saving on fuel into next year. Our annual fuel bill is about $5 billion. So if we could hedge out the remainder of next year at $66 a barrel, you're looking at savings of between $700–800 million going straight through to the bottom line, which would create an enormous opportunity for Ryanair to really meaningfully lower the cost of air travel across Europe next year.
That's what he's always relied on, that impact of lower prices and the pushing that effect has onto consumer demand. Michael O'Leary, MOL, talking to Tom McKenzie a little bit earlier on. Charlie Wells is here with an update on the numbers. What he was talking about there, the oil price, that stands out to me. What stood out to you?
Yeah, so look, I mean, they had all of these headwinds in the year, right? And they still got this 1.61 billion euro after-tax profit. You think about the uncertainty. You think about all the Boeing delays, the issues that they had to deal with there. You think about this value-sensitive consumer that they had to contend with there, but they really deftly navigated on price there. So you see, coming in at the high end of their guidance on profit, passenger numbers, they beat expectations, 200 million passengers just north of there. I was one of them. They had a slight miss on fleet, and again, that's where some of this Boeing issue comes into play. And then I think the real numbers that come out, it's that 750 million euro buyback. Investors are really liking that. They're saying that it's just too early to provide guidance for the year ahead. And then interestingly, when you dig into this report, they sound bullish on Boeing here, which is a real change in tone, I think, for the industry, saying we are working closely with Boeing to accelerate deliveries and are increasingly confident.
Where does the trade war fall into all of this?
I mean, look, it seems like this is evidence of executives across industries, but Michael O'Leary in particular, picking up on the Trump playbook and knowing what it is and how to use it, right? So he's talking about how Trump talks tough, but then quickly kind of withdraws some of these threats. And so I think that's a sign that he can navigate this pretty deftly.
Absolutely fascinating conversation coming out of Ryanair and Michael O'Leary himself. I thought it was really interesting that he talked about getting a letter from a U.S. lawmaker. You can really see where the sentiment is over in the States as well. Charlie Wells there breaking down some of those numbers for us. Coming up, we stick with that conversation. We're going to check the pulse of the U.S. economy, get the outlook for tech. And Kathy Wood from ARK Invest joins us next. This is Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty. into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. About 30 minutes into today's session, seeing some red on the screen in Europe. You are starting to see some of the risk sentiment on this side of the Atlantic catch up to what you're seeing in the States. Let me walk you through some of these numbers here. The Stock 600 down about 0.5% this morning. A lot of the concentration is in the French index, of course, but the FTSE 100 as well, down about 0.5%. Take this with a wagon of salt, though, because we've got a ton of ex-dividends hitting this market as well. So that's going to be factoring into that story. But then, of course, you compare this to what you're seeing in the States. I'm looking at a futures picture down about 1% on S&P 500 E-minis, about 1.5% when you look at the NASDAQ story. The bond market, the dollar, all selling off, and it's coming from one key piece. Moody's downgrading U.S. government debt from its top rating on Friday. The credit rating firm citing successive administrations' failures to deal with rising U.S. debt and deficits. That's just one part of the market conversation. The other, of course, is going to be the geopolitical story, the tariff story, and whether or not this market is juicy enough to invest in. On that and more, I'm pleased to say we're joined now by Cathie Wood, founder, CEO, and CIO of ARK Invest, joining us around the table this morning. Cathie, a pleasure to have you here in London.
Thank you, Krita.
Welcome to the table and to the set and to the UK. I want to start off with the main kind of headline of this morning, which is Moody's has now been kind of the last domino to fall in terms of this credit rating as well. On top of that, you have these tariff deals. On top of that, you have these deficit concerns. How does it feel right now to be an American investor?
Well, it actually feels a lot better right now than it did at the beginning of so-called Liberation Day, when it seemed chaotic. Our hypothesis at the time was that that there was a lot of negotiating going on behind the scenes. And when we saw Treasury Secretary Bessent really take over from Peter Navarro, that was an important moment. We knew the negotiations were perhaps about getting non-tariff trade barriers down, as well as getting tariffs down. And if that is where we end up, that's a tax cut. That's a positive. But as the turmoil was the inferno seemed to be blazing. I know that there was a lot of uncertainty just because of all of the rhetoric, but I think we're beginning to, understand now that this is more of a tax cut and a freeing up of markets. I mean, even here in the UK, I didn't know we couldn't sell our beef into the UK. Now we can, or our ethanol. So, and hopefully it's a two-way street that the US is opening up as well. So it's a win-win for our trade partners.
That's the perspective on the trade story, but you used a key phrase, which is tax cuts. There is a bill and legislation going on through Washington, D.C. right now of further tax cuts, bigger perhaps than what Donald Trump had initially campaigned on as well. That is fueling concerns about a ballooning deficit as well. Give us your thoughts on that. There's a lot of folks who are saying this is not the time to be investing in the States, not just because of the volatility emanating out of Washington, but because of that ballooning deficit. How do you trade in that environment?
Well, I am a Laffer disciple, so the Laffer curve. And we have some evidence now. In the first Trump term, he cut the corporate tax rate from 35%. We were uncompetitive. A lot of companies were moving out of the United States. 35% to 21%. And of course, that faced a lot of criticism. Corporate tax revenues since then have gone from $200 billion to $500 billion as more companies relocate back into the U.S. We're more competitive now. So if tax rates are too high, then cutting the rates typically leads to more revenue. Now, one of the other things we think is going to happen, and consider the source, there is so much innovation taking place right now, technologically enabled innovation. We think real GDP growth is going to accelerate well beyond what people expect now. So this idea of growing our way out of deficits, many people are dismissing that. I just gave you a very good example with corporate tax rates. And if you look in the United States at revenues as a percent of GDP, individual tax revenues, they're roughly around 18, 17% all the time. If tax rates go higher, people either stop working or find ways to shelter the income. So we think that government spending up closer to 24% is the problem, and we need to continue to show some discipline on that front.
Are there better opportunities inside the United States or outside of the United States right now?
It depends what sectors you're talking about.
Let's talk about technology.
Well, the wonderful thing about what's going on with artificial intelligence in particular is that the cost of innovation is collapsing. Our AI training costs are dropping 75% per year. AI inference costs 85 to, if you believe DeepSeek, 95% per year. So we think we are on the lookout for more innovative companies popping up in the rest of the world. I do believe the U.S. was at risk of losing innovation, certainly under the last SEC chairman, Gensler. We almost lost the digital assets revolution to other countries. Now it's coming back. I think under this regime, technology in the U.S. will do very well. And one other thing I'd like to say about that, the Mag 6, many people lump them as technology and thinking they represent technology. They quintupled in market cap from 2019 to 24. If you look at the rest of what we call technologically enabled innovation, it was up a mere 30%. We believe the market is going, in the U.S., is going to broaden out and reward some of the companies that have lagged badly.
Examples? Any examples? Which areas? Give me more specific.
Sure. Well, a lot of the multiomics names, they are AI-enabled these days. Multiomics is life sciences. Yep. So CRISPR Therapeutics is curing sickle cell disease and beta thalassemia. We have, of course, Coinbase. It is starting to make a run. Palantir's had a magnificent move, just got into the S&P 500. Roku is the operating system for connected TVs, certainly in the U.S., and number 2 in the U.S., and now spreading around the world. We have other multiomics names like Twist, therapeutics, which is going to be critically important to the blood tests that are going to help us identify cancer in stage 1, or maybe even before stage 1, as tumors shed or polyps shed into the blood.
So basically, don't buy the Bag 7, look for other areas.
If we look at our portfolio, we have faced a tremendous headwind over the last 4 years, valuations coming down to roughly a market multiple as measured by enterprise value to adjusted EBITDA. We've worked with S&P on this.
Yeah.
We were at 275% premium to the S&P. Now we're roughly a 10% premium. So if you ask us, again, consider the source, we believe that innovation, technologically enabled innovation in the U.S., away from the Mag 6, which have been rewarded handsomely, is highly undervalued.
Kathy, a lot of that innovation, though, that you're touting, and even just and you mentioned the SEC as well, the kind of change in antitrust sentiment as well, that is fueling the tech sector and the biotech sector specifically. A lot of that has come from expenditure coming from the government as well. And you kind of touted this idea that when you bring down some of these government expenses from a deficit standpoint, kind of rein in that spending, at what point does that start to hit the innovation ecosystem that you're talking about?
I think that innovation is part of the program, and especially with Elon Musk at the helm. He has been at the helm. He's going to be stepping aside. I think he has been shocked and has surfaced how old the technology is and how inefficient it is and how much we are doing manually. So I think
at government.
In the government sector,
Yeah.
We've had Palantir go in, starting with the Department of Defense, and now it's moving into other parts of the government and increasing efficiency enormously. We desperately needed this. Some of these systems were 50, 60 years old.
Yeah.
And so if we look at the FDA, for example, we're already seeing more transparency and streamlining, which is absolutely essential. Deregulation. Regulations have been strangling innovation in the U.S. The FDA already has approved, for the first time, a piece of software code, which will help in the diagnosis of heart disease. Is getting rid of animal testing because it doesn't work when it comes to monoclonal antibodies.
But Kathy, some of the examples that you're giving, and you mentioned the Defense Department as a great one, DOGE as another, I'll add a third, which is the FAA and a potential transformation there.
Yes.
That all requires investment in the infrastructure and the technology that you're talking about modernizing. Yes. And yet we've seen the Trump administration pull back on some of those federal contracts and that defense spending. I think Palantir is actually one of the few exceptions that you're seeing for that rule. Do you really expect that to continue, given the pullback on that spending?
Well, having watched from Poland personally on an on a base, it was an army base actually, them training the Ukrainians, we've learned that war is changing. It's becoming much more electronic. And our systems, we call them the primes, the big defense companies, they produced elite equipment. The world's going towards commoditized when it comes to drones, and of course, in Ukraine they've been using DJI drones, and we've been learning a few things about them. So we're spending too much in the wrong places as technology changes the nature of war.
Are big tech companies spending too much in the wrong places? This huge investment that we're seeing at the moment in AI, is that going to be able to continue? At the moment, the conversations I'm having with people are talking about costs crashing, and you kind of obliquely referenced this a little bit earlier on. Costs are coming down. Are we certain that all the investment that we're seeing at the moment in big tech, in AI, is being spent wisely?
No, we're not certain. We're never certain. Whenever you see a flood of capital moving into one space, which it has, one of the things we think about is software as a service. Internally at ARC, there's something called vibe coding. I don't know if you've heard about it, but we're all coders if you think about it. Natural language processing, vibe code. We can go to ChatGPT or Claude.
Write some code for me.
Yes, and say, build me this website.
Yep.
And it will happen. Or
Who makes money on that? We still haven't figured out who's ultimately going to be making the money.
We're going to, because we're going to lower our costs.
Okay.
We're going to lower costs. We're going to eliminate.
But that's not what's priced into the market right now. At the moment.
No, I think the biggest. So there are three huge areas. One is massive productivity gains that every company can enjoy. Yeah. That's one, and you'll see that more in efficiencies. Two is the largest AI project on earth is autonomous transportation, whether it's robo-taxis. So Tesla, we have said for quite some time, is the largest AI project on earth. The most profound AI applications are going to be in healthcare. If you think what makes AI tick, it's data. We have 37 trillion cells in our body that we're now analyzing, and we can analyze because of AI.
At the moment, the market is pricing, giving the big multiples to the companies, the picks and shovels companies, the companies that are making the AI, the companies that are making the data centers, the operators of the data centers. That's where the valuations are at the moment. Are those on the wrong valuations?
They've corrected quite a bit.
Sure.
They've corrected quite a bit. I think the better question is, are some of the opportunities I just mentioned, especially in healthcare, are they recognized at all? They are not. They are not recognized at all.
Kathy, speaking of the healthcare story, there's a question here, and I know you specialize in kind of biotechnology specifically, but I know that you also have in previous iterations of your holdings talked about other pharmaceuticals as well. There's a question right now, especially in the European market where so many people are holding pharmaceuticals and biotech as well as part of their portfolio, of what a tariff impact or reciprocal tariff impact may look like in terms of the raw materials needed to develop that kind of innovation you're talking about, but then ultimately passing on the cost of that technology to the consumer. And I know, again, you're speaking to a very kind of innovative sector or piece or kind of cross-platform or cross-slice of the market. But I'm curious about what that does to margins, what that does to the actual costs involved with creating something. As I'm looking at your holdings in Tesla, Palantir even, I'll throw CRISPR Therapeutics in there. Walk us through the margin story with the context of things might be getting more expensive in the short term.
We think the healthcare sector has the opportunity here to take returns on R&D, which are in the low single-digit range, way down from the golden age of the 80s and 90s when they got up to 20, 30%, back to 15, 30, even 40%, because AI is going to collapse the cost of drug discovery and development. We think the number of years it will take to discover and then launch a new drug will shrink from 13 years to 8 years. We think that we're going to have molecular diagnostic tests, as I mentioned before, to diagnose disease much earlier. And so we're going to move from sick care spending, which in the U.S. is 85% of healthcare spending, more towards therapies that actually cure. So if you look at CRISPR Therapeutics and others, we think that the combination of sequencing technologies, artificial intelligence, and CRISPR gene editing is going to cure more diseases. We're already seeing cures in sickle cell disease and beta thalassemia, as I mentioned. They have one that will compete with Lipitor or the statins in the works right now, which is showing amazing results. Again, once and done, not having to take statins all your life, which have all of these side effects. So I really think healthcare is the most underappreciated beneficiary of AI out there. But as you mentioned, your viewers have a lot of pharma holdings. You have to make sure that they are harnessing these tools, because the old way of doing things is not going to work anymore. It's very inefficient. There's a lot of guesswork.
Yep.
And technology is going to change that. You have some great pharma companies, but they have to harness these tools aggressively. Otherwise, newbies will come around and nipping at their heels, it will seem like, and then surprise.
I think we're all going to feel better after this. Certainly science sounds a lot better. Kathy, great to see you. Thanks for stopping by as ever to come and see us
and
here in London. Kathy Wood, founder and CEO CEO and CIO of ARK Invest. Coming up, we are going to be talking about the Russian and US presidents, expecting to speak a little bit later on today. We're still waiting for details on exactly how this is going to happen. We're going to discuss why Vladimir Putin is unlikely to offer any meaningful concessions. That seems to be the theme right now. We'll talk about that next. This is Bloomberg.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
A51, welcome back. President Donald Trump says he will have a phone call with the Russian President Vladimir Putin today to discuss how to stop the war in Ukraine. This, of course, comes as Kremlin forces launched the largest drone barrage over the weekend since the start of Russia's full-scale invasion in February 2022. Let's bring in Ollie Crook from Berlin to talk more about this. Ollie, what do we know about this call?
Yeah, well, we know it's happening at 10 a.m. Eastern time. We know, which is 4 p.m. Central European time. We know that this is after a sort of week that saw the failure to get any progress on that ceasefire, that 30-day ceasefire that the Trump administration, that the Europeans, that the Ukrainians have been pushing. And then Putin said that he would have, potentially diplomatic talks instead. And that basically after those failed, the Trump administration and Donald Trump himself basically determined that nothing is going to get done until there is a direct conversation between Donald Trump and Vladimir Putin. And that direct conversation conversation will take place a little bit later today. And what we had in the lead up to that was a flurry of diplomatic activity. We had Friedrich Merz, we had Keir Starmer, we had Emmanuel Macron, Giorgia Meloni all speaking to Donald Trump yesterday. We had J.D. Vance sitting down with Zelensky for the first time since their sort of confrontation in the Oval Office over the weekend in Rome, all basically trying to get Donald Trump's ears, speaking their sort of corner, trying to get the message across from the European side anyway, that Putin is the impediment to peace, Putin is the problem, and that without basically serious sanctions on Putin, no progress will be made. We do know now that there is a list of sanctions that the U.S. is considering if Donald Trump determines that Putin is the problem. These are the so-called bone-crushing sanctions that Lindsey Graham has proposed. There's bipartisan support for that if Trump wants to move forward on it. This is talking about sanctioning second-party countries that are still buying Russian oil and gas, which would be very, very significant. The question is, how far are we from basically that convincing by Zelensky and the Europeans that Putin is the problem? Either way, no matter what happens on the call today, we edge closer to something, which is the Americans having to make a choice. Is Zelensky the problem? Is Putin the problem? Or is it a problem that's too complicated for them to solve and that they're going to step back? After this call today, we'll have a slightly better picture. We know that Trump will then, after the call with Putin, talk to Zelensky and some of the other NATO leaders a little bit later in the afternoon.
Bloomberg's Oliver Crook there in Berlin, walking us through what we can expect from what is clearly a very contentious issue just a couple days after, of course, those very first direct talks between Ukraine and Russia. We thank you so much. Let's get more on a different set of negotiations closer to home on a deal said to have been reached between the UK and the EU on strengthening ties. Leaders due to meet at Lancaster House this morning. Our UK correspondent Lizzie Burden is live on location. Lizzie, walk us through what we expect to be announced today.
Well, Critty, we are expecting a deal to have been reached. They were crunching at it until the early hours of this morning. 2 a.m. is what we heard. The draft, though, still yet to be approved by political leaders on both sides. But those leaders are going to arrive here at 10:15 a.m. London time here at Lancaster House. There'll be a plenary session at 11 a.m. and then a press conference at 12:30 p.m. But look, this is a significant moment for both sides diplomatically post-Brexit, a moment to show unity in the face of, as you were just discussing, Putin's war on Ukraine, but also Trump's tariff war. And yet you still have leaders on both sides of the channel needing to project strength in the face of the right-wing opposition parties in different countries. What we're expecting, though, in terms of the nitty-gritty today is a three-part deal. First, on defence and security. Second, a common understanding of how they'll cooperate in future, and that includes, for example, access to e-gates at passport lanes. And then thirdly, just a statement of closer alliance through this uncertain geopolitical climate.
They're very hemmed in, though, aren't they? Both sides by domestic politics, Lizzie.
Absolutely, Guy. And as ever, fish, a thorny issue in these talks. Britain wanted to extend the deal on fishing rights that expires next year by just 4 years, we hear. But France said, if you want to just do 4 years on fish, we'll do 4 years on food checks, which of course would create uncertainty for Britain. They also said, we hear, that they wouldn't go for a deal on defence if Britain held up the path on fish. Now, a senior British official told us that that was ridiculous, the idea that Brussels would want to squander the opportunity to show unity to Putin just because France wanted a better deal on fish. But to unlock it, a draft that we have seen shows that Britain is going to agree to reciprocal fishing rights for more than a decade. And in exchange, that's unlocked the path to a deal on food checks and on energy cooperation as well. To unlock defence, the UK has said that it will look towards working on the Erasmus student exchange programme with a time-limited youth visa. So it's been a diplomatic game of chess, but it looks like we've got a deal here.
Okay. We'll look to that a little bit later on. The leaders will be arriving circa 10 o'clock this morning. Lizzie will be there to cover that event for us. Lizzie Burden down at Lancaster House. Thank you very much indeed. Coming up, an exclusive conversation with the EU's Foreign Policy Chief, Kaja Kallas, is going to be joining us 9:15 London time. Looking forward to that.
Absolutely. In the meantime, a quick check on these markets. As we've been speaking, we have seen risk sentiment worsening on both sides of the pond, and specifically when it comes to the dollar. Starting to see some real weakness there, but that is a boon for the likes of the euro and the pound. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Doha, ahead of the Qatar Economic Forum, which begins tomorrow. And these are your top stories. Sell America is back. The 30-year Treasury yield tops 5% for the first time since April. U.S. futures fall, and the dollar slides after Moody's strips the U.S. government of its top credit rating. President Trump is set to speak on the phone with Russia's Vladimir Putin as Washington looks for progress after last week's failed peace talks between Moscow and Kiev. Plus, resetting relations, the EU and UK negotiators are said to have reached a deal to strengthen their post-Brexit relationship ahead of the crucial summit today. Now, we'll also speak exclusively to the EU's Foreign Affairs Chief, Kaja Kallas, in a short while. But first thing is first, let's look at the European markets map. Now, again, there is quite a lot going on in the markets. We look at treasuries, euro, dollar, and a lot of U.S. assets. Now, Moody's ratings downgrading the credit rating of the U.S. government, citing a ballooning budget deficit that shows little sign of narrowing. So if you look at futures in the U.S. are dropping, you can see also a lot of the European stocks on the downside. The treasury yield curve steepened after this change from Moody's. Again, if you look at a gauge of the dollar, I think we can go cross-asset. That's weakening 0.3%, and then European stocks falling. Bullion, actually, gold, the only thing that we're looking at that's getting a little bit of support, gaining some 0.9%. Appetite for the haven asset boosted by concerns about the U.S. economic outlook and budget deficit. Now, the Treasury Secretary, Scott Bessent, has downplayed concerns about the U.S. government following that downgrade from Moody's. Bessent spoke to NBC's Meet the Press.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. You know, we inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
Now, for more, let's bring in Roz Matheson, EMEA News Director. Roz, what's the reaction been in Washington to the downgrade news?
Well, as you were just showing, Scott Bessent, the Treasury Secretary, he's been saying this is something that's a hangover from the Biden administration. He describes the Moody's move as a lagging indicator, and to some extent he's not completely inaccurate in that, because Moody's was in essence catching up to the other ratings houses. This move was anticipated, including by the market. So you're seeing an interesting reaction, obviously, in the long end of the Treasury curve, a bit in stock futures, but not a massive flow-through elsewhere in the financial markets today. But what it does do, if anything, even if you could say that Moody's is a bit symbolic, as per Scott Bessent, it does come at a time there are real concerns about the fiscal outlook in the US. And you can see a lot of conversation in Washington about that, particularly with Trump's tax bill that he really wants to get pushed through the House. You know, his very omnibus tax bill at this point with a lot of other things attached. This tax bill is important, possibly for the US economy in many ways, but including what it does for borrowing down the track. And does this Moody's move really highlight the concern about unfunded liabilities in the US economy, and those questions again about sell America? Is US exceptionalism gone? You know, the safe haven aspect of US assets gone? And so a lot of officials in the White House found out saying Moody's doesn't really mean anything, but it does point to those concerns longer term about the US economy.
So we also heard about, Trump's tax bill, and that's advanced through a key House committee. What do we actually know, Roz?
Well, that's right. So it did get through the Budget Committee overnight. That's after a couple of hardliners got their way in terms of they want cuts to Medicaid or access to Medicaid for quite potentially a large group of people. And this is the issue again with this bill. So it got through this committee. It gets towards a House vote at some point. But at this point, this bill is so sprawling and so large with so many things attached to it that getting it through is very, very difficult. I mean, Republicans fundamentally do want tax cuts, but there's a lot of other things now that are moving parts with this that could cause problems for it in the House, and obviously also in the Senate if it gets through the House. And that's things around Medicaid, but also around deductions from federal taxes, from state and local taxes. There's also the questions around phasing out some of the clean energy credits. There's a lot of things packed into this bill, so it's harder to get it through. And even though it got through committee, the outlook for it is still very uncertain.
Yeah, and Roz, we had some, big breaking news, sad news yesterday from the U.S. that Joe Biden has been diagnosed with an aggressive form of prostate cancer. What do we know actually about the illness?
Well, that's right. So as you say, it's an aggressive form of prostate cancer, and it is actually, it seems, in his bones. But also it's a form that can be treated quite successfully with hormone treatment. So it is an aggressive, fast-moving form of prostate cancer, but it also responds quite well to that hormone treatment. And so prostate cancer is obviously, one that is being diagnosed more and more around the world, including in the US, but it's also a cancer that can be treated more and more. And so for the president, there's the question of what does this do to his daily life? We've seen him step back quite a bit since the election from daily life. He's been popping up more and more recently in interviews because there's a lot of resumed conversation around his mental state during his presidency, and he's been coming out to defend that. Does this lead him to take a low profile again? So there are questions around what it impacts him personally in the minute, but also what does it do to his time in daily life in America?
Roz, do you know if actually both parties will put differences aside, the Republicans and the Democrats, given the illness?
Well, certainly you saw Donald Trump come out immediately last night and issue a statement that he was wishing Joe Biden well with his treatment and sending him his warm regards. I mean, Donald Trump is a person who has been extremely critical of Joe Biden over the years, including calling him Sleepy Joe, questioning his mental acuity through his second presidency. And that's been something that he's really latched onto, but an immediate message there of concern for Joe Biden, his family. Of course, for Biden, cancer is a very personal issue, of course, with his son dying of cancer. So there's a lot around all of this for the Biden family. But it seems, at least for now, Donald Trump is just wishing him all the best.
Ross, thank you so much. Ross Matheson there with the very latest, of course, news from the U.S. Now we're joined by Jennifer McCune, Chief Global Economist at Global Economics. Jennifer, thank you for joining us. I mean, we all woke up to the news, and I think the first time I heard actually a big Wall Street person, it was Ken Griffin here in Qatar exactly a year ago, warning about deficits in the U.S. We all woke up to the news about Moody's. Does it change what you're expecting economically the U.S. to do over the next 12 months?
No, I think it's a short answer. As we've just heard, this is really just a matter of Moody's following what other ratings agencies had already done, what was already known in financial markets about the very poor state of the US public finances. That said, it does highlight that Trump's wiggle room is very, very limited in terms of what he can do on fiscal policy. We've always known that he was really beholden to the market in terms of any further fiscal loosening. I think really, although tariff revenue might give him some scope to spend, he can't go much further than the tax bill that's already gone through the House Budget Committee.
Jennifer, what are you looking at in terms of possibility of a recession in the U.S.? Again, we spoke to many Fed governors, Fed presidents, and it does seem at the moment that if you look at the dual debt mandate, they may wait a little bit because they worry more about inflation than, for example, unemployment. What trajectory do you see the U.S. taking?
Well, we're not forecasting a recession, and I think the recent data actually have very much been in support of that. We've seen a slight softening in retail sales and industrial production, but really nothing to be too concerned about. And at the same time, the labour market, which of course is crucial, is holding up very well. The payrolls data still look good. So, you know, it could also obviously get a lot worse. It's very early days so far as tariffs are concerned. But at the moment, we're putting the probability of a US recession at less than 30%.
And do you worry about inflation in the U.S. more than you do about GDP?
Yes, yeah, we do, and we think the Fed will do as well for a little while at least. I think that tariffs are a stagflationary policy, but I think probably the impact on inflation will be bigger than the downside for activity. We're expecting inflation to go to about 4% later this year on the basis of current tariff policies. And I think in that environment, although this should, on the face of it, be a one-year hit, a level shift in prices, I think given the recent experience that the Fed is going to be concerned about whether this might prompt second-round effects into wages, into broader prices, and so I think it's going to stay on hold for the rest of this year before perhaps considering further rate cuts next year if this inflation shock does prove to be a temporary one.
Jennifer, is there a danger that actually, it's a bold call to actually call for no cuts from the Fed this year? Is there a danger that then they'll have to cut quite aggressively and quite quickly into 2026?
It's possible. It just depends very much on what's going on in the economy, doesn't it? And assuming that the economy does remain as resilient as it has done lately, then I don't think there would be a case to cut aggressively. I think US interest rates are currently only a little above the equilibrium or the neutral rate. So it only takes a couple more cuts to get back to kind of a normal policy stance. And in an environment where the economy is still growing, albeit perhaps a bit slower than its potential, then that's fine. Of course, if we do start to see a bigger downturn, particularly if there are significant job losses, then the Fed will just act sooner, and we'll get those rate cuts coming through possibly this year.
Jennifer, give me a sense of what you learned about, trade and tariffs. Again, there's this holding pattern, I guess, between the U.S. and China. We had a big trip of President Trump in the Middle East. Things were signed, thin on details. Does it give you a better idea of what the Trump administration wants to do when it comes to trade and tariffs?
Oh, crikey, it's difficult, isn't it? I think essentially we are pretty much in the situation that we thought we would be at the outset of Trump's presidency. We had assumed that there would be a universal tariff of around 10%, and that tariffs on China would be much, much higher, just given the extent of the imbalance there in the relationship between the two economies. We'd assumed about 60%. If anything, it looks like it may be a little lower than that at the moment. But there's so much uncertainty. There are several flashpoints coming up, most notably the end of the 90-day pauses on tariffs, both the Liberation Day tariffs and the tariffs on China are paused for 90 days. So heading into July and August, there's going to be some tension for sure. So we're looking for more of these types of trade deals, the kind of thing that we saw from the UK and what we're seeing in the Middle East too. But as you say, it is pretty light on detail at the moment, and it's not clear that it's offering all that much reassurance, particularly when a trade deal, even with the UK, which is an economy that does not run a large surplus with the US, we've still not had that 10% tariff removed, and we've got no really clear assurance on sectoral tariffs either. So limited progress, I would say, and a lot more uncertainty to come.
Jennifer, thank you so much for joining us. Jennifer McCune there, Chief Global Economist at Capital Economics, looking at some of the flashpoints, possibly early July. Now, coming up, we'll also speak with the EU's Foreign Affairs Chief as the UK holds a summit to reset relations after Brexit. So that interview is next, and this is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
This week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum continues this week right here on Bloomberg Television. Context changes everything.
Welcome back, everyone. I'm Francine Lacqua. This is The Pulse, and we're live from Qatar. Now, the UK and EU are said to have reached an outline deal on strengthening their post-Brexit ties. Leaders are due to meet at Lancaster House in London this morning. Lizzie Burden, our UK correspondent, is there. Lizzie, so what details do we actually know so far?
Well, Francine, they were hammering out the details until 2 a.m. this morning. But as you say, it looks like a draft has been agreed, even if it needs to be approved by the political leaders on both sides. Now, that is set to include, first of all, a defence and security agreement, secondly, a common understanding on future cooperation, which means on things like travel, access to e-gates at passport control, and then thirdly, a common understanding of how they're going to work together as allies in these uncertain geopolitical times. But this is a crucial moment diplomatically post-Brexit for both sides. You've got the need to show unity in the face of Trump's tariffs and Putin's war on Ukraine, but of course, as ever, the need for political leaders to project strength in the face of right-wing opposition parties back home. So both are going to want to look like tough negotiators. We're expecting leaders to arrive here at 10:15, just under an hour's time here in London.
Lizzie, so what are the thorniest issues?
Well, Francine, fish, as ever, you'll remember it well from the Brexit days, has been front of mind in these negotiations. But it does look like they have reached a reciprocal agreement to extend fishing rights for more than a decade, to 2038. Now, originally, Britain had wanted just a 4-year deal here. But France said, well, if you want to do 4 years on fish, we want 4 years on food checks, which, of course, would create uncertainty for Britain. They also, we hear, said we're not going to do a deal on defence if you won't agree on fish. And one British senior official said to us, that's ridiculous. The idea that they would squander the opportunity to show unity to Putin just to get better terms on fish. But I know you're speaking to Kaja Kallas in just a moment. She is, of course, the EU's top diplomat. Even on Friday, she was saying that they just weren't there on defence. So in order to thread the needle, it appears that Britain's agreed to a longer deal on fish. That's paved the way to a longer deal on food checks and energy cooperation. And to open the door on defence, it appears that the UK has agreed to working towards being part of this EU Erasmus student programme with a time-limited youth visa as well. So, as ever, a very complicated game of diplomatic chess, but it looks like they've managed to get there.
Lizzie, when you look at, domestically, what the leaders, of course, have to face at home, how limited are they because of politics, domestic politics?
Completely, and the EU, of course, has 27 members who all need to have eyes on this and agree to it, all of them wanting to, as I say, show that strength at home, none of them wanting the UK to be able to cherry-pick the benefits of EU membership without agreeing to the commitments like free movement of people. Keir Starmer, it should be noted, is somewhat sympathetic, perhaps, to these arguments. He was once the arch Remainer, don't forget. He advocated for a second Brexit referendum, and he needs that economic growth. Some economists, like ING, have said that a UK-EU trade deal could unlock £15 billion for the UK Treasury at a time when the Chancellor, Rachel Reeves, is extremely fiscally squeezed. But, of course, he's got the threat of Nigel Farage, the former face of Brexit, whose Reform UK party has seen some electoral success of late. The Conservative leader, Kemi Badenoch's already calling this the Surrender Summit. So Keir Starmer needs to show that he is a tough negotiator. He's already agreed to this US trade pact, which of course includes an agreement on that 10% minimum tariff, much to the chagrin of some EU officials, by the way, who've got to negotiate their own deal with Washington. So it's very important today that Starmer can show he is not caving to Brussels.
Lizzie, thanks so much. Lizzie Burden there, of course, outside Lancaster House. Now, President Donald Trump says he'll have a phone call with Russian President Vladimir Putin later today to discuss how to stop the war in Ukraine. This comes as Kremlin forces launched the largest drone barrage over the weekend since the start of Russia's full-scale invasion back in February 2022. Now, for more, let's bring in Bloomberg's Oliver Crook in Berlin. So, Oli, a source has told Bloomberg that Putin is feeling pretty confident ahead of this call.
Yeah, that's right, Francine. This call that's supposed to take place at 10 a.m. Eastern Time, 4 p.m. Central European Time, the call between Donald Trump and Vladimir Putin, the call that Donald Trump said last week after sort of overtures and discussions and failed to make any kind of breakthrough on getting that 30-day ceasefire that the Europeans, the Ukrainians, and the Americans have been paying for, the phone call that Donald Trump says has to take place in order for there to be any meaningful progress on the issue of Ukraine. Whether or not that will be the case, you heard a lot of skepticism about it. I mean, you're about to speak to Kaja Kallas. I caught up with her on Friday. She says basically that Putin is just playing games, and that's really the sentiment that we've been hearing from a lot of European leaders. And of course, for Zelensky and for the Europeans, it has all been about convincing Donald Trump that Putin is the impediment to peace, that the real problem lies with Putin. We've seen Zelensky really change his tack ever since that disastrous Oval Office visit. We've had a huge amount of diplomacy over the last 48 hours. We had Zelensky speaking with J.D. Vance in Italy over the weekend, the first time they spoke since that Oval Office visit. We also had Giorgia Meloni, Friedrich Merz, Keir Starmer, Emmanuel Macron speaking with Trump yesterday, and that all just trying to push Trump in that direction towards those sanctions that we know have been prepared by Lindsey Graham, the so-called bone-crushing sanctions, the secondary sanctions, which would target third-party countries that buy Russian oil and gas if the Trump administration is convinced that Putin is the impediment to peace. We will say that they are not yet convinced of that fact, but regardless of what happens, Francine, regardless about whether or not there's going to be any sort of significant progress, what this is all pushing towards is the United States having to make a decision. Is Putin the problem? Is Zelensky the problem? Or is the problem too complicated and the U.S. needs to admit it needs to step back? We're getting closer to that with this phone call between Donald Trump and Vladimir Putin.
Now, Ali, a pro-European centrist has beaten a far-right Trump loyalist in also Romania's presidential election. What more do we know?
Yeah, so listen, Francine, the politics are really fascinating across all of this. I mean, there's been a competitive category of what sort of political story in Europe has been the most interesting and the most sort of controversial over the last, couple of years. I think Romania really is in a position to claim that title because, of course, it was a very sort of stark contrast. You had an ultra-nationalist, anti-EU, Eurosceptic candidate versus a centrist, sort of moderate, pro-NATO, pro-EU candidate. That is who won in the end. Nico Jordan won the election. So that was sort of high stakes enough. But the real fact of the matter is this was a rerun of the election that happened back in November that was canceled by the courts in Romania because basically an unknown candidate won 22% of the vote after they claimed, the mainstream parties in the courts, that were basically being gassed up and promoted on social media by the Russians. This, of course, also caught the attention of the U.S. administration. It was part of J.D. Vance's speech in the Munich Security Conference where he basically accused mainstream European parties of basically ignoring democracy and canceling elections whenever it suited them. So for Romania, at least, hopefully it ends this sort of period of total political instability, which has had a real effect on the markets, and that can move forward. Now that you've had a decisive vote, you have one of the highest turnout rates in 25 years, and the Romanian people have chosen at this stage to go with the pro-EU and the more mainstream politician, who is also, we should say, an independent, so sort of a rebuke to the mainstream politics of Romania, but not going to the sort of ultra-nationalist, sort of anti-EU tack.
Ollie, thanks so much. Oliver Crook there in Berlin. Now, other stories we're following today. Portugal's ruling centre-right coalition has won the country's snap election. Now, according to early results, the Prime Minister, Luis Montenegro's coalition, got nearly 33% of the vote and increased its seats in parliament from 80 to at least 89. The vote saw the far right and the socialists compete neck and neck for second place, rocking the two-party system that's dominated the country's political life for 50 years. Now, the mayor of Warsaw is poised for a narrow win over a pro-Donald Trump nationalist in the first round of Poland's presidential election. An updated exit poll suggests the ally of Prime Minister Donald Tusk is set to win 31% of the vote. Now, the candidate of the opposition Law and Justice Party is heading for a second-place finish with 29%. The two will face each other in a runoff on the 1st of June. Now, we're also just getting some breaking news on Israel, and the Prime Minister, Benjamin Netanyahu, says the IDF will gain control of the entire Gaza Strip. Now, this is, breaking news just a couple of minutes ago. He says aid to serve as a bridge until secured areas have been set up. The Israeli Prime Minister has acknowledged pressure from allies in the decision to resume Gaza aid. So we'll keep, of course, up to date with any breaking news from Israel and Gaza. This is a picture across markets. Let's also have a look at what the impact of Moody's downgrading the U.S. has been. Now we look at treasuries, we look at dollar, treasury sliding, Stocks a little bit on the downside. The downgrade led to a drop in U.S. equity futures, steepening of the yield curve, and a weakening of the dollar, with investors seeking haven assets like gold. We'll have plenty more from the Qatar Economic Forum here in Doha. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Doha, and these are your top stories. Sell America is back. The 30-year Treasury yield tops 5% for the first time since April. U.S. futures fall, and the dollar slides after Moody's strips the U.S. government of its top credit rating. Well, President Trump is set to speak on the phone with Russia's Vladimir Putin as Washington looks for progress after last week's failed peace talks between Moscow and Kiev. Plus, resetting relations, EU and UK negotiators are said to have reached a deal to strengthen their post-Brexit relationship ahead of a crucial summit today. Now, currencies and stock markets in developing economies have gained for 5 straight weeks on signs of easing trade tensions between the U.S. and China on bets of Federal Reserve interest rate cuts. Now, they've been propelled by a shift away from the U.S. that's pushed investors to look at undervalued emerging market assets. Well, let's get more on the outlook with James Lord, head of FX and emerging market strategy at Morgan Stanley. James, I hope you hear the nice music background as well. It's always good to have a bit of oomph when talking about FX and emerging markets. Thank you for joining us. What's your take on dollar right now, and what does that mean for a lot of the emerging markets?
Yeah, thanks very much, Francine. Thanks for having me. So we're bearish on the US dollar. I mean, we've been bearish pretty much since the beginning of the year and have been sort of revamping our targets as the story in the US has unfolded. But really, we see a couple of key drivers now for a weaker dollar. I mean, one is simply the U.S. growth outlook. Compared to the past sort of 10, 15 years where investors have been used to growth rates in the United States of 2.5%, we think this year is going to be somewhere closer to 0.5, maybe a little bit higher after some of the de-escalation of the trade tensions, but really, a much weaker growth story for the U.S. This is mostly driven by the immigration outlook, where immigration policy has obviously changed a lot under the current administration. Limited fiscal stimulus, but also now facing trade tariffs that are substantially higher than they were at the beginning of the year. All of these things are going to put downward pressure on U.S. growth, make it more difficult to fund the current account deficit, and ultimately put the dollar under some downward pressure. I mean, we're mostly expressing this against the majors in the G10 space, so euro dollar, dollar yen, sort of alternative safe haven currencies that we think will really benefit in a world where you face high uncertainty and slowing global growth. I mean, ultimately, given the targets that we have for euro dollar, we're seeing it going to 120. Dollar yen, we see heading down towards 135. Like that kind of dollar weakness is you're going to see emerging markets benefit as well. But I would say that the emerging markets will probably underperform on the crosses like euro and yen.
Yeah, James, I was going to ask you actually about dollar level, which you've so kindly provided right now. But are you expecting actually a lot more sell-off of U.S. assets, especially after the Moody's news overnight?
Well, I mean, the Moody's news overnight is, something that, given that S&P and Fitch moved on their credit rating some time ago, I think most investors have sort of incorporated when they look at average credit ratings. You've had 2 of the 3 major rating agencies already downgraded the U.S. So from that perspective, I don't think this changes a huge amount in terms of, what investors technically have to do with their treasury holdings. But clearly, what we've just been through with the U.S. fixed income market and the FX market in April, investors are highly sensitive to anything that suggests that the U.S. term premium outlook, anything that introduces more term premium into the U.S. curve. And I think what the Moody's decision does, it just keeps the conversation going. We've obviously got U.S. budget bills working its way through the legislative process, and everybody's watching to see how much more treasury supply there will be. We're very much in the camp of steepeners and are expecting to see more term premium coming into the U.S. market, and that will put some downward pressure on the dollar as well. So, we're not talking about moves that should be really concerning for anybody. I mean, we're just talking about moving euro dollar to 120. It's not nothing out of the ordinary really, but we do think we're going to be in a period of dollar weakness through the rest of the year.
James, could you talk to me a little bit about flows into, again, emerging markets? What's that looking like? And is it, broad emerging markets, or are certain regions doing better than others?
Yeah, so I mean, in the flow data that we can see, when you're looking at investments into emerging markets, you can clearly see that there is a preference at the moment for non-dollar denominated assets. So moving into local currency fixed income and away from hard currency. Local currency fixed income in emerging markets has been not really seen much in the way of inflows for many, many years, mostly due to dollar strength. And so now that the dollar trend is changing, you are starting to see that flows come back. I mean, at the beginning of the year, it was quite focused on the CEMEA region. I mean, I think this was partly due to the rising euro and the expectations that German fiscal stimulus might boost regional growth. So I think the European markets were sort of benefiting from that. But more recently, really since the beginning of April, you've seen a much bigger shift into Asia. So you've seen, from the regionally mandated fixed income funds, most of the flows have actually been going into Asia markets, which is interesting. I mean, maybe this is related to some expectation of flows coming back to the region following the tariffs that were implemented. Maybe Asian investors have been obviously huge investors into the U.S. markets, and as the tariffs were unfolded, very much affecting large parts of the Asia region, it's possible that some of these flows were now being repatriated and invested more regionally.
James, when you look at emerging markets broadly, I don't know what you do with renminbi, and again, if there's something that you'd stay away from right now, given all of the trade and tariff dynamics.
Yeah, I mean, our preference at the moment in EM is to really find the bottom-up stories where we have a lot of conviction in and provide some idiosyncratic kind of anchor or domestic anchor in the face of, a lot of global uncertainty. So, the bottom-up reform stories are the places that we're really interested in, and these are places like Turkey that obviously had a bit of a scare in March, but we think it's time for investors to start reconsidering that trade again. We've been very much bullish on the Egypt story as well. So, the sort of slightly smaller markets where there are solid reform stories underway, I think these are the places that are going to provide a lot more alpha to investors who are thinking about exposure to EM. I mean, on the renminbi, clearly there is a growth slowdown underway as a result of the tariffs that have been implemented. We are expecting weaker growth this year. I'm not sure that you're going to see much renminbi depreciation, though, relative to the dollar, considering the dollar outlook that we have. The renminbi is getting a bit of a devaluation or depreciation in its value just simply on the crosses. I mean, keeping the currency fairly stable against the dollar means it is weakening against the yen, it is weakening against the euro, and the CFETS basket that the PBOC manages is clearly heading down. So I don't think that there's much more that's required in terms of a valuation adjustment beyond like the trend that we're seeing. So I don't really see much sort of impetus for dollar renminbi to head up. But I do think that being short renminbi versus things like euro, things like yen, I think those sorts of ideas are things that investors should look at.
James, I mean, of course, a lot rides on, I think it's July 8th, where it's the end of the 90 days, and then possible negotiations between the U.S. and China. Could that be a game changer in terms of flows and also where you see everything headed?
I mean, I don't have a very strong expectation of what's going to happen at the end of that 90-day period. I mean, obviously, we're in that negotiation phase at the moment. Treasury Secretary Scott Bessent, I think, was just saying yesterday that clearly tariffs could go back up if there was any sort of sense that negotiations were not moving in the right direction. So I think investors face significant amounts of uncertainty around the tariff outlook, and I think that uncertainty is something that really will weigh on the dollar. I mean, it's not an environment where investors are getting a lot of clarity. Even as we've seen tariffs come down, it has been associated with a rally in risk assets, but the dollar remains very, very weak. And I think this largely reflects just the huge amounts of uncertainty that there is about investing in the US at the moment. What kind of tariff regime, what tariff outlook will you be facing over the next few years? Things can change like multiple times as we've noticed, and I think that sort of uncertainty will make it harder to attract funding for the U.S. current account deficit, and is one of the things that will put some downward pressure on the dollar.
James, thank you so much for joining us. James Lord, they're head of FX and emerging market strategy at Morgan Stanley. Now, the world's largest EV battery maker is also making the world's biggest listing this year. Now, the Chinese giant CATL debuts in Hong Kong tomorrow after raising $4.6 billion in a secondary listing. Well, Craig Trudell, our global autos editor, joins us. Craig, good morning. So what are CATL's aims with this listing?
Well, $4.6 billion is obviously a significant amount raised for this company, but I think it's also just, the fact that, in the face of this global trade war where China has been at the center and where the electric vehicle sector within China has really been a target, it's just been remarkable to see CATL, sort of go from strength to strength. Obviously, they are pretty insulated from the U.S. tariff story, given that they were already shut out of that market, before things, sort of ratcheted up and continued to ratchet up. There's some potential, of course, for them to at least partially crack the U.S. market in the form of these licensing deals that they've reached with, first with Ford, potentially with Tesla in the future. I also think, just the ways in which they continue to lead from a technology perspective with, just a few weeks back, BYD making a lot of noise with the amount of charge it was able to pull off in 5 minutes. CATL one-ups them just in a matter of days. So this listing is effective also for just continuing to get the name out there, the familiarity with this company. They've really become a force in the automotive sector, and it's so widespread, as we saw with the customers that just flashed on the screen, just how broad they are in terms of how many manufacturers they serve now in this industry. This is if you're making electric vehicles, it's quite likely you're using CATL batteries for those.
Okay, Craig, thank you so much. Craig Trudell, there, Bloomberg's Global Autos editor. Now, NVIDIA chief executive Jensen Huang has unveiled technologies from faster chip systems to software aimed at sustaining the boom in demand for AI computing as competition in the industry, of course, becomes more competitive. Now, Huang opened Asia's biggest electronics forum, Computex, in Taiwan, with an update on timing for NVIDIA's next generation GB300 systems.
This year, in Q3, we'll upgrade to Grace Blackwell GB300. The GB300 will increase the same architecture, same physical footprint, same electrical and mechanicals, but the chips inside have been upgraded.
Well, Ryanair shares have gained this morning after Europe's largest budget carrier said it's seeing strong summer demand as it reported earnings and announced a €750 million buyback. Well, the chief executive, Michael O'Leary, spoke to Bloomberg's Tom McKenzie a little earlier about the outlook.
I think our experience with Trump and the tariffs is, he talks tough and then they walk it back pretty quickly. You saw the deal with the Chinese, the deal with the UK. I'm not sure it will. I'm not that worried about tariffs on commercial aircraft.
Does the deal with the UK and the US, does that mean you could source the aircraft from the UK then? Would you look to that?
It's a possibility. I mean, one of the alternatives is we could take the aircraft in through the UK, but ultimately we have a fixed price agreement with Boeing, and our discussion with Boeing, our tariffs are Boeing's problem, not ours.
Well, Charlie Wells is here with a deep dive on the numbers. Charlie, so what stands out in Ryanair's earnings report?
Francine, so this was a very solid set of numbers for Ryanair, despite a lot of the uncertainty that the airline sector has seen across the board, a lot of that uncertainty in the midst of the trade war. Also for Ryanair, they exclusively fly Boeing planes, and there were delay issues, but they still were able to deliver profits after tax for the prior year that came out on the higher end of their guidance. The airline said that they are not able, at least at this time, to provide guidance for the year ahead, but Michael O'Leary, the CEO of the company, was relatively optimistic when he gave an interview to Bloomberg News earlier this morning. And one of the reasons why, if we take a look at some of the fuel price changes that we've seen over time, you can see that he was able to hedge, given the uncertainty, he's been able to hedge and kind of lock in something of a discount on that fuel price. We also heard about optimism about that all-important summer sales season. They've expanded a number of their routes, and they see an optimistic outlook for summer sales, increasing passenger numbers there. And it's really interesting. It's sort of creating this divide within the European airline space where you have a number of these firms that exclusively fly in the region, in Europe, into the Middle East, maybe points slightly farther afield, but not exposed to that transatlantic routes. And you see those airlines, I'm thinking IAG, I'm thinking Lufthansa, under a little bit more pressure, or at least not performing quite as well in the market compared to the likes of Ryanair or Wizz.
Charlie, thanks so much. Charlie Wells there with the very latest on airlines. Now, there have been some big market moves, so let's look at the U.S. 30-year yield actually rising to 5.02%. It gone above 5% about 2 or 3 hours ago, and that's the highest since November 2023. There's a lot of market moves also on the back of the Moody's downgrade. Coming up, we'll be joined exclusively by Robert Friedland, the founder of Ivanhoe Mines. This is ahead of the start of the Qatar Economic Forum. That's next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Welcome back, everyone. I'm Francine Lacroix here in Doha, where we're ready for the Qatar Economic Forum, which kicks off in full force tomorrow. Now, the tariff truce between the United States and China has brought some relief to commodity markets, which had been hit by the trade war, which dented the outlook for economic growth. Now, tariff uncertainty, of course, sparked a heavy sell-off in metals. While there's been some recovery in prices, concerns about the impact of tariffs continue to linger in the sector. Now, joining us now is Robert Friedland. He is founder of Ivanhoe Mines and iPulse, which is not affiliated with the Pulse. Let's just make that clear, Robert. But I love interviewing you because you're the king of commodities. You understand copper and copper demand more than anyone. Where are we in the cycle?
We need copper for everything. We need copper to keep these lights on in the studio. We need copper for the greening of the world economy. And as we balkanize the world economy, in no small part due to tariffs, we also need copper for national security. So we're going from a sort of integrated, just-in-time world to a just-in-case world. So everybody's scrambling for copper and other critical raw materials.
Yeah, I mean, you secured, like, Santa Cruz is one of the big projects, right, when it comes to copper. As everyone tries to get more copper because there may not be enough of the stuff, what are the plans for Ivanhoe?
America is very anxious to rebuild its domestic copper mining industry. In fact, it's mining industry for all critical raw materials. So Santa Cruz is in Arizona, where about 10% of the world's copper has been mined. It's on private land. It'll be a super green, ultra modern new copper mine on private land in Arizona. Just exactly what America needs. I'm happy to say US Exim Bank sent us a letter expressing support for long-term debt financing for the project. And there's a lot of hoops to jump through to get everything right, but that mine has a very bright future.
Can you give us a timeline on when you're expecting it to, to get stuff out of the ground and then peak output?
Normally to get to where we are today, it'd take about 15 years. You have to find it and drill it and study it and engineer it. So we're on private land, which shortens the permitting process. And the new administration is very friendly to the permitting process, especially on private land. So there's no federal permitting. So we should be in production in late 2028, in about 3 years, which is tomorrow morning by mining standards.
Oh, that's quite exciting. You're in the region. Is there anything that you're looking to buy or any deals to make, either with Qatar or Saudi Arabia?
Of course.
Always. And they are?
No, we already have a partnership with the Kingdom of Saudi Arabia. We have 50,000 square kilometers in a partnership with the kingdom to look for copper and gold and other critical raw materials. And that work is now underway. We're very happy with our Saudi partnership. And we're talking to all of the regional governments here because most of the world's undiscovered critical raw materials are in Islamic countries. Islamic countries are quite underexplored. So the Kingdom of Saudi Arabia has a great mineral endowment. And from this area, in the center of the world, with all these airlines coming here, you can look at Africa, you can look at Uzbekistan, Kazakhstan, all those parts of Asia that have never really been properly explored.
Robert, can you give me again a sense of like the timeline of what you're expecting to find and what kind of capex are you putting into these projects?
Billions and billions of dollars. Mining is capital intensive. We've invested over $40 billion in mining in the last 20 years in our own group. So we a very big mine in Kazakhstan, a very big mine in Mongolia, a very big mine in the Democratic Republic of the Congo. Close to $8 billion has been invested there. So these are capital-intensive, long-lived assets at the bottom of the world cost curve. They'll go for generations.
And again, in terms of when you're expecting to find something, because you need billions to explore.
Only Allah knows when we're going to find something. So, the exploration process is high risk, high reward, and is now very technology intensive. So we use pulse electrical power injected into the earth to light up water or metals at a great depth. And there's a lot of software, a lot of AI. So there's a hardware system and a software system combined. So we have a huge confluence of all the world's new disruptive technologies. And that disruption has come to exploration and production. What we do is a lot like a CAT scan or an MRI. If you have a problem inside your body, we're non-invasively looking at the earth to see what's there, rather than drilling holes all over the place.
And this is what iPulse, right? When are you?
Well,
I mean,
it's
the
a division
iPulse
of
is kind
iPulse.
of
That technology was spun off from the New York Stock Exchange as Ivanhoe Electric, and we're using that technology in Saudi Arabia in a partnership with the National Mining Company of Saudi Arabia.
When will you IPO iPulse? If you'll IPO iPulse, is that on the cards?
We've been private 20 years, and we'll save that for a future announcement. But we became a unicorn more than 10 years ago, so we're a well-financed private American company.
Are you expecting actually your site in Arizona to benefit from the Trump administration push to give more permits quicker?
Yes. Well, we don't need the permits because we're on private land. So the permitting authority is the state of Arizona, and they understand mining. Mining has been done in that part of Arizona for generations. So I'd say they're friendly and realistic about the permitting process in Arizona.
Give me a sense also, I mean, Congo you've mentioned, right? You've built one of the biggest copper mines actually in Congo in the world. How big is that project going to get?
It's an enormous project. There's 30,000 people working there, and it's going through several stages of expansion. So it's the largest new mine on the African continent. We're building the largest smelter on the African continent. Women are working in that mine. They're empowered there. There's a great relationship with local communities. It's very high grade. It's very green. It runs on hydroelectric energy. And it's grown faster than any copper mine in the world, and it's still growing.
And do you think it'll grow at the same pace?
It should, God willing. Yes, it should. Yeah, we've already completed the third phase of expansion, and soon we'll be announcing the numbers on the fourth phase, and we see a fifth phase of expansion as well. It's currently running today as the third largest copper complex in the world.
What are you most excited about? I mean, viewers won't know this, but I sometimes bump into, Robert Friedland in corridors at conferences like this, and you show me, mining gadgets. I mean, you absolutely love what you do, and you're excited about some of the new technologies. What are you most excited about now?
We need a new way to mine. We need a better way to find mines. We need a better way to crush and grind rock without using so much electrical energy. If you need a data center for big data, you need astronomical amounts of electrical energy. Bitcoin uses huge amounts of energy. These studios use a huge amount of energy, all these bright lights. And so we really look like we have a problem for certain critical raw materials over the next 5 to 10 years. And so we have to reinvent the whole enterprise. And that we're doing with Pulse Power. It just happens to be that this show's called The Pulse.
It's a good name.
Yeah.
It's a very good name, Robert. But how much energy are you expecting to? Is it, can you cut energy consumption?
Yes.
Looking for this by 20, 30%, or even more?
Yeah, even 80%. So
80%.
What we're doing is we're taking very small amounts of energy and compressing it with some supercapacitors to create huge amounts of power. A lot of people are confused, thinking that energy and power are the same thing. They're not.
No.
So this technology was used in weaponry, strategic weaponry. It's used in electromagnetic pulse weaponry. And now we're using it for civilian application, authorized by a Western government, to find a more energy-efficient way to do things. And we really need to revolutionize the mining industry if we're going to find and develop the critical raw materials we need to have a better world.
Robert, thank you so much, as always, for joining us. Robert Friedlander, founder of Ivanhoe Mines and iPulse. Now, we'll be live all week here from the Qatar Economic Forum in Doha. Guest highlights include Elon Musk, Steve Mnuchin. We'll be speaking to Donald Trump Jr., the QIA chief executive, and JP Morgan Chase's Mary Erdoes. Also joining us, the Turkish finance minister, Mehmet Şimşek. This is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for VVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good Monday morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. A ratings cut, stock futures, the dollar, treasuries all dip as Moody's downgrades the U.S. 30-year yields touch 5%. Moving along, the House Budget Committee advances President Trump's tax bill that could speed up cuts to Medicaid coverage. And NVIDIA unveils new technologies to keep up with the boom in AI demand. Well, it is a rough morning if you are just waking up this Monday morning. Stocks, the dollar, treasuries, all of them under pressure. You can see S&P, NASDAQ, and Russell 2000 futures all more than 1%. That's after last week that the indices gained for all 5 days. We turn around. It's remarkable how quickly the narrative has pivoted from tariff deals to concerns about the budget and the Moody's downgrade. Same goes for your treasury market this morning, under pressure. I want to point out the long end of the curve because we are back at 5%, the first time since November 2023 when inflation concerns were front and center. Besides that, to get back to these levels, you have to go all the way back to 2007. I should say, again, the dollar, the euro versus the dollar at the bottom of your screen, the dollar falling basically against all of its G10 peers this morning. So those are your overall markets. Let's look at some of the stocks underneath the surface here with your stocks to watch, as always, is Bloomberg's Joe Easton. Good morning, Joe.
Hey, Danny. So we are seeing weakness across the Mag 7 today. Take a look at Tesla. We're down close to 5% on that one. Nvidia weaker as well. All of this seems to be stemming from that downgrade from Moody's, hitting the tech stocks, pushing up bond yields. this morning. Then we've also got vaccines in our sight. Novavax soaring in the pre-market. We saw Asia peers rallying on reports of a spike up in COVID cases in Singapore and in Hong Kong. And we've also seen news of potentially Novavax getting approval for one of their COVID vaccines as well. So that stock, one of the best performers, up around 15%. Finally, Netflix downgraded over at JP Morgan after 2.5 years as an overweight. Now, we have got Squid Game Season 3 coming out in the second half of the year. I'm not sure if we need another series of that. But nonetheless, JP Morgan's reckoned that the valuation is a little bit too high for that one, so they come down to neutral. Netflix lower, 2% in the pre-market this morning, Danny.
I feel like we just got Season 2. We're already getting Season 3?
I know, right? We've just gone through that one. Where else can we go with this?
Hey, if it works, it works. Netflix will keep pumping them out. Joe, thank you so much. A lot on the move this morning. Bloomberg's Joe Easton will catch up later in this hour. Also, in just moments, we're going to speak with Alfonso Peccatiello of Pallarino Capital. And later in the hour, we'll catch up with Keith Lerner of Truist. And we've been talking about it so far this morning. Moody's ratings stripping the U.S. of its top credit rating agency, setting a ballooning budget deficit. Treasury Secretary Scott Bessent responded on NBC yesterday.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. You know, we inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
Alfonso Peccatiello of Pallarino Capital also discussing the downgrade, writing, quote, people will try now to compare the short-term bond market reaction to 2011, when the last time when the U.S. Treasury received a surprise and significant rating downgrade. Yet, the comparison makes no sense. I'm pleased to say that Alfonso joins us now. He's the founder and CIO of Pallarino Capital. Alfonso, that's exactly what we've seen this morning. People have been making that comparison. Why is it not apt this time?
Well, I would say there are a few things to consider. The first one is the broad macroeconomic situation, 2011 versus today. So in 2011, you were just coming out of the great financial crisis. You had a relatively weak U.S. economy. Today, the story is very, very different, right? So that's the first thing. People will look at third-year bond yields and say, oh, now we've got to sell off because there's been a U.S. downgrade. And, you know, basically they want to make a one-to-one comparison with 2011. I would encourage people to think about the long end as a multiple layer problem. So, of course, there is a term premium. So there is the uncertainty that people want to be compensated for. And that makes a lot of sense because there is inflation uncertainty, growth uncertainty, and the policies that the Trump administration is putting through. But there is also the growth cycle and inflation cycle we're in today and the level of federal funds rate that are to be considered. And, of course, when you look at the reasons why Moody's downgraded the U.S., they're citing the fact that deficits go to 9% of GDP. That's a very large number. I would just encourage people to understand that bond yields are not only driven by term premium, but they're also driven by today's growth and today's inflation prospects. So there is a lot to consider given the complexity of the trade policies today.
Well, you also write, Alfonso, even if that is the case, it still requires a different approach to the bond market than we had during 2012 to 2019. So what is different?
Yeah, well, what's different really is the fact that you are looking at an administration that is willing to print money for the private sector because that's what fiscal deficits are. Those are stimulus that are coming through for the private sector through an extension of a lower tax rate, for example. And when you do that on a sustained basis, and even if you exclude interest rate costs, you're looking at 3% or more of primary deficits printed every year, you're effectively giving more fuel to the private sector, which is already running in nominal terms relatively strong. So what you are doing is effectively you're raising, I think, over the long run, the nominal neutral rate for the United States, because an economy which used to have a nominal neutral rate around 3% without fiscal deficits now probably has to have it a bit higher. The private sector in the US is deleveraged compared to 7-8 years ago. So there is less debt to GDP at the private sector level, which means the private sector is more resilient. It can afford a bit of a higher nominal neutral rate. And on top of it, you have an administration that keeps putting on primary deficits over primary deficits. So effectively, you need to expect a higher equilibrium rate. You need to expect more volatility around the level of interest rates going forward, which is a higher nominal neutral and higher term premium on top of that. That's very different than 2012, 2019.
Alfonso, I guess I'm just trying to understand the line as to what you just look at and say, this is stimulus, and you get that impact there, versus saying, this is irresponsibility. This is growing supply at a time that we've also seen foreigners start to pull back from the treasury market. What is the line between what is just stimulus and what has gone too far, and what is too far with ballooning deficits?
Yeah, look, it's a great question, and I think the market is already trying to tell us via breaking correlations that they're not going to try and treat these deficits as they treated the deficits 7 or 8 years ago. So when you start to basically have an emerging market-like action in U.S. bond markets and in U.S. assets, that's when you really need to start worrying. And an emerging market-like action is basically when the U.S. announces a deficit, and what it does is it tightens financial conditions, which means effectively you have your currency that devaluates, you have a sell-off in assets of that country, so you have bond yields up, equities down, and the currency down. This has never, ever, ever happened in the United States over the last 45 years. But even if you are the global reserve currency issuer of the world, which the U.S. still is, and you really go for primary deficits over primary deficits over primary deficits while inflation remains sticky. That's the key point. If inflation remains sticky and the administration continues with primary deficits, we might have an emerging market-like price action in bond markets. We haven't seen it yet, but I think investors have to consider the probability this time.
And look, I know one day does not a trend make, but we're starting to see that today, Alfonso. It is higher bond yields. Stocks are selling off, and the dollar is weaker too. So when you look at a 30-year yield at 5%, which is a quite rich level, again, besides 2023, the last time we saw it higher than this was 2007. How do you decide, okay, we might be heading into an environment that looks like EM versus this is a generational buy opportunity in the 30-year yield right now?
Yeah, another excellent question. So we ran a study at Palinuro where we looked at other episodes in the past where you had this trifecta that looks like an emerging market move like we're having today. So stocks down, dollar down, yields up. And you have had 11 of these episodes which last for about a month or so and had a 1 standard deviation move in all 3 asset classes that we discussed simultaneously. So you've had 11 instances. The problem is that there was never a sustained follow-up. So you had this move, and it actually ended up being a great buying opportunity to come back to normality effectively, right? So what you need to see is whether this remains sustained. And really what you're saying is, if you're selling 30-year bonds at 5.02% and Fed funds are at 4.25, what you're really doing is you're paying negative carry. So unless you think the Federal Reserve is going to hike rates, which it's a little bit hard, I would say, as a scenario to imagine, you're effectively willing to pay away carry for not owning that bond that is yielding 5.03%. You need to ask yourself, is this justified? For how long can it go? Will we continue to have these policies? And to be honest, the answer is always probabilistically. I think the probability at this point in time, given the mix of policies, has never been higher over the last 40 years than you can have a sustained price action. You need to be prepared for it, and especially for portfolios is important because all the correlations that we're used to, so basically you have a stock market decline, therefore you're going to have bonds rally. No, you're not going to have that. You're going to have a dollar strength with stock market declines. No, you're not going to have that. You really need to be prepared at the portfolio level, I think, for that probability to be higher than it has been over the last 40 years.
And again, that kind of
Taiwan. And so today we're announcing that Foxconn, Taiwan, the Taiwanese government, NVIDIA, TSMC, we're going to build the first giant AI supercomputer.
Shares in Alibaba, meanwhile, are sliding down 2% this morning after report that the Trump administration has raised concerns over a potential deal between Alibaba and Apple. The New York Times reporting that the White House and congressional officials have been scrutinizing a plan to make Alibaba's AI available on iPhones. Elsewhere, the latest Chinese data showed consumption undershooting expectations as retail sales growth weakened last month. Meanwhile, industrial output expanded faster than expected. Economists warned that the data highlight the need for more supportive policies. Coming up, President Trump's tax bill passes the House committee and advances to the Senate. We're going to have more on that coming up next.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Yet to solve, but I think we're going to do that over the weekend. So we're moving the dials, as I said earlier. There's enough things to adjust to make it happen. You offered them a new number? I'm not going to tell you what I've offered. We're negotiating with a number of members, a number of caucuses, and we'll get there. So stay tuned.
Do you think the negotiations are close enough to actually get something done by the end of the weekend?
I do. You know me, I'm an optimist. We move forward. We've been demonstrating that every step of the way, and we're going to do it again.
House Speaker Mike Johnson's optimism materializing over the weekend when party leaders met for negotiations. The tax bill has been approved by the House Budget Committee, but still faces obstacles. Joining us now is Bloomberg's Josh Gallo. So, Josh, at one point on Friday, this didn't look like it would pass, at least a initial vote. We got it through the Budget Committee over the weekend. Does this look likely to go through the House?
I think there are a lot of details that still need to be worked out to know exactly where it stands. Speaker Johnson, obviously, as you just showed, he's non-committal in terms of what sorts of things he's promised to Republicans to get it out of the committee. Of course, they rejected it on Friday and then came back late on Sunday and essentially abstained in order to move it through. So, you have these hardliners that are concerned about the budget deficit. They're calling for, earlier requirements for work in order to receive Medicaid. That's set to kick in the draft, not until 2029, and of course, notably after the next presidential election. They want to move that forward. That's sort of a core issue for Republicans and has been for some time. But, this bill adds $3.8 trillion in spending, and the cuts that they've already proposed are not going to cover that. So, the hardliners on the budget side, they're not yet quite happy with where this is, even though they say they've been promised some, earlier cuts to Medicaid, education, clean energy subsidies that would go some distance in making it more affordable. But on the other hand, you have people in Republicans in states like New Jersey, New York, California, who are pushing for basically more tax breaks. Like they say that the state and local tax deduction is not going to be big enough for them to support it. So I think Speaker Johnson still has a way to go to get everybody on board that he needs to in order to get a vote by Memorial Day, which is what he says he wants to do.
So once we get through that, Josh, but then we also face the Senate. What does the battle look like there?
Similarly, there are a lot of people who are holding out. Again, you're going to face the state and local tax deduction barrier that those states that I mentioned, California, New Jersey, New York, are going to be pushing for. But you also have people like Senator Josh Hawley from Missouri, who's pushing for not having these steep cuts to Medicaid. They might be able to bridge that by making it less of a cut and more of a work requirement for people on Medicaid. But, there's still a steep hurdle. So we'll have to see. The House bill that comes out is going to face a lot of changes by the Senate, and it's not clear that everybody can get on board with this, that they need to push it through. And they have this ambitious timeline of getting it to Trump's desk by July 4th, and it's going to be pretty tense negotiations all the way through.
Yeah, and it is a market that is increasingly turning its attention to budget deficits, especially after the Moody's downgrade. Josh, thank you so much. Bloomberg's Josh Galou. Just want to point out George Servelos of Deutsche Bank putting out a note just now talking about the market nervousness after the Moody's downgrade, but pointing to the fact that what is decided in the next couple of weeks will likely be locked in for the remainder of the decade, given a very difficult reconciliation process, the potential loss of Republican majority in the midterms. Again, that leaves only space, he says, for one major fiscal event, saying that the diminished appetite to buy U.S. assets and the rigidity of a U.S. fiscal process that locks in very high deficits is what is making the market very nervous. And nervous we are today. You can see futures down 1 1/3%. Okay, coming up, we're going to take a look at the other headlines around the world. What's on your front pages, including a relationship reset between the UK and the EU ahead of a summit today. You're watching Bloomberg Brief.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Let's take a look at the front pages this morning. First up, the Washington Post and most newspapers in the country leading with former President Joe Biden and his diagnosis of an aggressive form of prostate cancer. Biden's office said that the condition has spread to his bones, but that the disease appears to be manageable. President Trump also posted a support message on Truth Social along with other politicians. Next up, the New York Times also covering the deal struck between the New Jersey Transit and its engineers union. The agency said trains would start running again on Tuesday morning, so bad luck for you if you're commuting from New Jersey today. But even so, it resumes Tuesday morning after spending a day conducting safety checks today. And one of the most read on the Bloomberg terminal this morning about the EU and UK agreeing to terms of a post-Brexit reset for Britain. That comes ahead of a summit by both sides today. The agreement covers defense and security, geopolitical challenges, and a common understanding on a range of other issues. For more, we are joined by Bloomberg's chief European correspondent, Oliver Crook. And Oliver, we are in this moment of more optimism, let's say, around Europe. Is this another reason to be optimistic about the EU and UK?
I mean, I think the negotiators will certainly want to spin it that way, and in some ways it is certainly progress, and obviously what they want to do is try to expand some of the economic relationship between the EU and the UK in the absence of the United States in its sort of unpredictable status in the world right now, and this is meant to be the first step to that. So we got a draft of this deal. We're going to get it hopefully sort of ratified a little bit later today. I'll go through a little bit of what it entails. So it's an agreement that basically includes 3 different texts, one on defense and security partnership, another one on working together on geopolitical challenge, and then another, again, sort of very ambiguously, a, quote, common understanding on a range of other issues. So on the defense side of things, what could get interesting is the UK working more closely with the Europeans, potentially on joint procurement, for example, of military equipment. They will not be eligible for a lot of the European programs that Brussels has put up. But again, a lot of the sort of negotiations had to do around fishing. Danny, I know that you were sort of pleased to not have to talk about this issue anymore, having left London, but it's still a live one between the Europeans and the United Kingdom. You know, also freedom of movement of people, of students studying within the United Kingdom. But I think that fundamentally, Danny, the issue that you have and you always return to, this is Keir Starmer's attempt to sort of soften Brexit a little bit to try to deliver some of the economic promise between the EU and the UK without sort of crossing any sort of red lines that will upset the domestic population in the UK. And fundamentally, Danny, the difficulty with Brexit since the very beginning is it's very difficult to square that circle. So yes, a step in the right direction. How impactful it will be, I will have to see.
I don't know, I just think the British populace is going to care most that they're able to use e-gates again in Europe. I think that's what everyone's going to concentrate on. Oliver, elsewhere, on a more serious note, we are expecting a phone call elsewhere in Europe between Vladimir Putin and President Trump on Monday. What are we expecting?
So listen, what we got from Donald Trump over the weekend was this announcement that he will be speaking with Vladimir Putin at 10 a.m. Eastern time, so 4 p.m. Central European time, in order to make a sort of breakthrough in the discussions between Ukraine and Russia in terms of the possible ceasefire. Remember, this is something that the Trump administration has been putting increasingly pressure on. The Europeans got on board with it. The Ukrainians trying to get that 30-day ceasefire, with which Putin rejected last week. We had these sort of talks in Turkey that led to nowhere, and the idea now is that Donald Trump will try to break through that deadlock and try to advance the conversation around the ceasefire. We've had a flurry of diplomatic activity over the last 48 hours. We had J.D. Vance meeting with Zelensky for the first time since that Oval Office blow-up in Rome in Italy over the weekend. We had a call between Friedrich Merz, Emmanuel Macron, Keir Starmer, Giorgia Meloni speaking with Donald Trump yesterday, trying to get his ear ahead of this conversation with Putin. And all the leaders I spoke to last week at the end of the week in Albania were saying that basically Trump is Putin is just playing games, trying to buy for time as he prepares for this conversation with Trump. The question is, will he be able to break through? And for the Trump administration, no matter what happens in this phone call, this will take them closer to having to decide who the problem is. Is it Zelensky? Is it Putin? Or is the problem too complex for them to solve?
Oliver, thank you so much for your excellent coverage. As always, that is Bloomberg's Oliver Crook. Now, coming up, we'll chat with Keith Lerner of Truist on how to navigate what he calls tricky situations in markets as equities, bonds, and the dollar sell off this morning.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. A ratings cut, stocks, futures, the dollar, and treasuries dip as Moody's downgrades the U.S. 30-year yields reach 5%. Moving along, the House Budget Committee advances President Trump's tax bill that could speed up cuts to Medicaid coverage. And NVIDIA unveils new technology to keep up with the boom in AI demand. Good morning to you. It is a tough day for U.S. assets. Stocks, bonds, dollar, all under pressure. We're down 1.2% for your S&P. NASDAQ 100 and Russell 2000 underperformed, down more than 1.5%. It is a market whose narrative has quickly flipped from tariff and negotiations around tariffs to the budget isn't sustainable and a concentration on the downgrade. You continue to see yields under pressure. The front end still pinned by the Fed, but the 30-year yield goes up another 7.5 basis points. We are at 5% for the first time since November 2023, while the dollar falls against most of its G10 peers. That's your overall markets. Back with some stocks to watch. Here is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we are seeing weakness across the Mag 7 this morning. Take a look at Tesla. We are down around 4% in the pre-market, pretty much driven by those macro issues with the downgrade for the US debt rating. Therefore, that move up in treasuries hitting the tech stocks today. NVIDIA was also lower. Apple as well, pretty much across the board in that space. Then we've got Novavax on the radar, a big rally in this one pre-market. There is news of an uptick in COVID cases over in Asia overnight. We've seen a spike in the illness over in Singapore and Hong Kong, lifting vaccine makers. Also Novavax getting a bit of a boost from an FDA approval for one of their COVID shots. That one probably going to be one of the biggest movers today. Then Netflix, JP Morgan downgrading the company, going down to neutral after 2 years, recommending buying the stock. Squid Game 3 coming out. We're all very excited about that. Not sure where they're going to go with that one, but given we've already had 2 series of that, but the stock getting cut at JPM. They cite the price-earnings ratio as well. That stock declining 2% in the pre-market today, Danny.
Yeah, they've done already everything they can do in Squid Games. Maybe just like a whole new cast. I don't even know. Joe?
They've even had a video game as well. So
You're right. They do have a video game. Squeeze that bad boy for all it's worth. Joe, thank you so much. Bloomberg's Joe Easton. All right, so we are more than 90% into this earnings season. Corporate America has shown caution around guidance for the coming quarters, Walmart included. Take a listen to what Treasury Secretary Scott Bessent had to say about one of the largest companies in the country.
Walmart is, in fact, going to, as you describe it, eat some of the tariffs that, just as they did in 18, 19, and 20, The other thing, though, that we are seeing, that Doug passed along to me, that with their consumer, the single most important thing is the gasoline price, and gasoline prices have collapsed under President Trump.
Keith Lerner of Truist showing confidence in corporate America, writing, quote, U.S. companies have been battle-tested through the last several years amid the highest inflation rates in decades, the fastest Fed rate hiking cycle in decades, and COVID, and they continue to outperform expectations. You got a sneak preview of him here. Keith joins us now. Hey, Keith, really wonderful to see you this morning. Look, it is this push and pull between administration that's telling companies that they shouldn't be raising their prices to Walmart saying it is inevitable. How do you see the political and both margin mix evolving after we heard from them and their earnings for most of corporate America?
Yeah, well, great to start the week with you, Danny. So, listen, I do think corporate America has actually weathered this so far pretty well. And I think there was more, even though it wasn't a blowout earnings season, relative to expectations, it was somewhat better. That said, we published a note recently, and we do think we're in a tricky situation. Back in February, we downgraded equities. We thought there was a lot of complacency. Towards the lows, you had a lot of recession built into markets. Now you're up 23% for this market, and I think the risk reward is becoming somewhat less favorable. And that's even before we saw this movement on the 10-year and the 30-year. And to your question specifically around margins, what we've already noticed is forward earning estimates for the overall market have been flatlining over the last 2 months. And now, as we hear from Treasury Secretary Bessent about profit margins may be at risk at some point. At a time, you're back to a 21.5 multiple, so you're close to peak multiples as well. So I think even though corporate America has done well, now you have a lot of good news that's being priced into markets, and you're vulnerable to something unexpected like we saw on Friday.
So what would it take you to get back to something that looks more constructive on stocks, on risk assets, Keith?
Yeah, well, as I mentioned, we were slightly underweight equity, so it's not like green light, red light, all in, all out. So we still have exposure, but for us to get more constructive, there's a couple of things. One, maybe just somewhat lower prices. Two, maybe just a consolidation of these recent heady gains. What's interesting though, Danny, is if we look back to the day after the election, we're only up 0.4% since the day after the election. So we've seen this huge volatility, but I also think we just really need to kind of move past this tariff uncertainty, and then the market starts to focus on those animal spirits again, those pro-growth policies with the tax bill, with deregulation, and maybe just some consolidation, some digestion of these gains where you correct in time and a little bit in price. That might be enough, but really at this point, we're in a holding pattern, much like the Fed is today as well.
Keith, I got to say, there is some little bit of irony because the market does seem, at least for the very short term, to have moved on from trade policy, but it's moved on to something that isn't exactly great either, and that is ballooning deficits. You can see it in the market this morning with the tax bill making its way through the House after the Moody's downgrade, where you see stocks, bonds, and the dollar all selling off simultaneously. Do you think that can last as a driver of this market, as a negative driver? Does that hurt that outlook for equities as well?
When you rebound and you're up 23% and you're back to almost peak multiples, a little bit of bad news can go a long way. And I think in this period right now, that 10-year and that 30-year, which I heard you discussing earlier, above 5%, is a concern. Because if you think about it, if you look at the earnings risk premium for the market, the inverse of the PE right now, or the earnings yield, is around 4.5%. And that's close to where the 10-year is. So you're not being compensated at the same level. And I do think that 10-year Treasury is key. And the market, to resume its uptrend that we've seen recently, is going to want to see some stabilization or some give back in that 10-year. We also know that Secretary Bessent has also highlighted the importance of the 10-year. So I'm sure they'll start to maybe jawbone that a bit more as well. But that will be really probably the key for this week.
Is it also key for tech? Because I know you were quite optimistic on tech, especially after earnings and all the capital expenditures and all the AI spending that's happening. At what point, or are we there now, that tech stocks, longer duration stocks, can't keep absorbing these higher levels of yields?
Yeah, well, tech has also just had a really big run. So even though they've been really a standout in being resilient, and that's what I really, coming out of the earnings season, the healthy spend in AI was really, something that stood out to us. That said, I think the relationship between the interest rates and tech is somewhat over-extrapolated. If we look back historically, what has been a bigger driver for tech is the relative earnings momentum, meaning if the earnings momentum is growing at a faster pace than the overall market, it tends to outperform. That earnings momentum is still there. I suspect you've had a big move up in tech, like the overall market. I think if it pulls back a bit, you'll have some buyers. But on a short-term basis, it is extended and somewhat vulnerable to these higher rates. But ultimately, I think earnings are going to be a bigger driver for the outperformance. And we're overweight. We are overweight communication services, but we're also overweight utilities and financials, kind of a mix of cyclicals and defensives at this point.
Keith, I also want to go back to the idea that you mentioned that this is an administration that cares about the bond market. It's not yet clear that it is a Congress that does, that there's any fiscal discipline really coming into the conversations that we've heard over the weekend and that are going to continue this week. There was one bond market veteran who essentially said that we need something that looks like a Liz Truss moment in order to inject any sort of fiscal discipline into the market or into the conversation, and otherwise it's not going to happen. Do you think that that is the case, that you need a large bond rupture to actually move Congress to back off of some of the deficit ballooning that they expect to do?
Yeah, it's a good question. I mean, the one thing as far as on the partisan side is Democrats and Republicans have really agreed over the last couple of years to continue to move the deficits up. So maybe that is, I think it was Winston Churchill that said the Americans will do the right thing after they've tried everything else. Like, I'm sure I messed up that phrase. But yeah, maybe you need that. But I do think there's a little bit of a wake-up call. The downgrade that we saw from Moody's in itself, in our view, isn't a game changer, but it does spotlight these deficits that continue to rise. And the 10-year Treasury, as much as I mentioned before, that we can jawbone it, it does have a life of its own. It could be like kind of this bond vigilante again. So I do think it's going to become more in focus. Whether we need that Liz Truss moment is debatable, but I do think it was going to get the attention of Congress as we see these yields move higher and being spotlighted now with this recent downgrade from Moody's.
Keith, we love starting the week with you. Thank you so much for joining. That is Keith Lerner of Truist. Let's now get you some other top stories that are trending on the terminal this morning. Israeli Prime Minister Benjamin Netanyahu says the IDF is set to gain control of the entire Gaza Strip. Israeli officials are poised to order tanks and troops into Gaza in an all-out bid to destroy Hamas. Netanyahu also said that Israel will allow a basic quantity of food into the Palestinian territory after allies pressured his government to avert a famine. And a check on Alibaba shares sliding this morning by about 2%. That move follows a report that the Trump administration has raised concerns over a potential deal between the Chinese tech giant and Apple. The New York Times reporting that the White House and congressional officials have been scrutinizing a plan to make Alibaba's AI available on iPhones. Elsewhere in China, Chinese consumption data undershot expectations, with retail sales growth weakening last month. That's according to the latest national statistics. Meanwhile, China's industrial output expanded faster than expected. Beijing has been making boosting domestic consumption a priority, aiming for 5% growth target, but economists warned that the latest data suggests more support may be needed. Coming up, Trump's tax bill advances. The GOP makes a deal with hardliners despite a tough road ahead. We'll have the details for you coming up next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah,
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Pieces yet to solve, but I think we're going to do that over the weekend. So we're moving the dials, as I said earlier. There's enough things to adjust to make it happen. Have you offered them a new number? I'm not going to tell you what I've offered. We're negotiating with a number of members, a number of caucuses, and we'll get there. So stay tuned.
Do you think the negotiations are close enough to actually get something done by the end of the week?
I do. You know me, I'm an optimist. We move forward. We've been demonstrating that every step of the way, and we're going to do it again.
And that optimism from House Speaker Mike Johnson on Friday was not misplaced because the House Budget Committee went on to pass President Trump's tax bill late last night, but the package still has a long road ahead. Joining us now is Bloomberg's Josh Galud. Josh, where does the bill head from here?
Well, from here, it's moving on to be debated on the House floor, and there, as you said, it's a long road ahead. So, don't forget that it is a victory for Johnson to get that out of committee, but it was rejected on Friday, and on Sunday when it came through, that was really because the 4 hardline Republicans who are really tough on deficit issues, they abstained. They didn't vote for it, they abstained. And it shows that there are several issues about how to pay for this $3.8 trillion in tax cuts over the next 10 years that are still out there. Chip Roy, for instance, from Texas, he's standing in the way. He wants there to be a work requirement for Medicaid, for that to kick in much sooner. There are other Republicans who are pointing towards curbing the subsidies for clean energy. So there are a lot of things still out there that have to be negotiated, and it's far from certain that this is going to be a straight road for Johnson.
Well, needs to head, after all of that, to the Senate as well. And Josh, there's a real fear among markets this morning, especially after the Moody's downgrade, that deficits are ballooning. You mentioned some of it there, but is there any really serious conversation about deficit restraint happening at the moment?
There is conversation about it. The hawks are talking about it, but the question is really, can they get this paid for? So the deficit reduction in particular is really not a focus. They're just trying to pay for these tax cuts and not add as much to the deficit. So, if you talk to again, Chip Roy from Texas, they're going to be concerned about this, but are they going to stand in the way of a bill that has these massive tax cuts if it's adding less to the deficit? It seems unlikely, given that they let it pass through. Again, it goes down to their core demands on some principles and to their districts about what they'll support. But overall, I don't think we see any real movement in lowering the deficit over time. The Republicans also have walked back in, some ideas about raising taxes on the most wealthy. That appears not to be the case. And at the same time, the projections are not for great growth in the coming quarters and this year. So, deficits have really not been as much a topic as you would think after the downgrade.
All right, thank you so much. That is Bloomberg's Josh Galou with the latest coming out of Washington, D.C. By the way, even though stocks are selling off this morning, Mike Wilson of Morgan Stanley writing that you should be buying any dip fueled by the Moody's downgrade, saying that the odds of recession are lower after that U.S. and China trade deal, making stocks a buy. Now, speaking of stocks selling off, NVIDIA is among them. The shares are lower in the pre-market this morning, largely driven by all of Mag 7 falling, with bond yields on the long end going above 5%. But elsewhere, we did have the CEO, Jensen Huang, unveiling faster chip systems, new software, and other new technology at the Computex event in Taiwan.
This year, in Q3, we'll upgrade to Grace Blackwell GB300. The GB300 will increase the same architecture, same physical footprint, same electrical and mechanicals, but the chips inside have been upgraded.
Let's get more with Bloomberg's Charlie Wells. Charlie, overshadowed this morning what we heard by what's happening elsewhere in markets, but was there any inclination whether this is enough to kind of make up for some of the market share loss, some of the demand loss coming from China restrictions?
Yeah, Jenny, that's a really good question. And I think one of the key themes here is just kind of the different vibe of this show versus prior years. And there have been a lot of announcements coming out. I think the most striking here, and maybe the most consequential, is NVLink Fusion. That is a new version of a system that would allow NVIDIA customers to deploy rivals chips in systems ultimately based on NVIDIA's technology. And that is a big opening up of NVIDIA systems. And I think that speaks to the themes that we're really seeing here at this conference, where it's less about this exuberance, this excitement about the newness of AI, and more about attempts to try to entrench it in systems to justify it and to maintain, at least in NVIDIA's case, their lead over rivals that is increasingly under competition.
There's competition and there's pressure from policy, and you see it really abundantly clear in tech. Even just this morning, Charlie, Alibaba shares have been falling. I think they're down about 2%, or they fell about 2%. There seemed to be that New York Times report on Trump concerns about Alibaba and Apple's deal. What were the details there?
Yeah, Danny, so this comes at a difficult moment for Alibaba. They just reported a worse than expected earnings report. And so this indication that the Trump administration has been looking into a potential deal between Alibaba and Apple for Apple to deploy AI services in China. Now, this is not great news for Alibaba, but it is also bad for Apple because Apple needs a local partner in China in order to roll out these all-important AI features on its iPhone. The Chinese market is the second most important for Apple after the United States, and these features are a key way for Apple to try to compete in that hot Chinese market where there are a lot of other competitors, there are a lot of other AI participants, and so this is not great for Apple, not great for Alibaba. Remains to be seen how it will all shake out, but this is certainly putting both of those companies under pressure right now.
Charlie, thank you so much for your reporting this morning. That is Bloomberg's Charlie Wells. Now, earnings season continues on. We heard from Ryanair citing robust demand, higher ticket prices in Europe. Bloomberg's Tom McKenzie spoke with CEO Michael O'Leary following the results from the airline.
I was written to by some U.S. lawmaker asking me not to guarantee that we won't buy Chinese aircraft, and I wrote back politely saying, go to hell. I'm not giving you, we will reserve the right to buy aircraft wherever we so wish. We remain a big...
Not certified yet, COMAC?
No, they're not certified and won't be certified for another 5 or 10 years, but I've been written to by some congressman in the US whose iPhone was made in China, asking Ryanair not to guarantee not to buy Chinese aircraft. Yeah. We would give no such guarantees. I mean, I don't see any great prospect of us buying a COMAC aircraft. The Boeing are making great aircraft. You look at our numbers this morning, an awful lot of which are being driven by the Boeing MAX 8200s. Those aircraft offer us 4% more seats. They're burning 16% less fuel. They're transforming our economics. And I think you add those new aircraft to the declining cost of oil for the foreseeable future. And I think not just Ryanair, but the airline sector in general looks set for 2 or 3 years of reasonably strong earnings.
Talk to us about the oil price. I mean, you're seeing prices now about $62 a barrel on Brent. You hedge around oil prices. Are you hedged to the upside, or are you well protected on lower prices?
No, I mean, we hedge straight for jet fuel into plane. We were hedged in the last year, so the results this morning, we were hedged at $79 a barrel. We're 85% hedged this year at about $76 a barrel, about a 4% fuel saving. We took advantage of the uncertainty post the Trump tariffs or Independence Day, whatever it was last month. We hedged about 40% of summer 2026 fuel at about $66 a barrel. This is jet. Jet at the moment, spot is about 67, Brent is 62. That's about a 13% saving on fuel into next year. Our annual fuel bill is about $5 billion. So if we could hedge out the remainder of next year at $66 a barrel, you're looking at savings of between $700–800 million going straight through to the bottom line, which would create an enormous opportunity for Ryanair to really meaningfully lower the cost of air travel across Europe next year.
Ryanair CEO Michael O'Leary speaking with Bloomberg's Tom McKenzie. O'Leary also speaking on the analyst call at the moment, saying that they can avoid tariffs by taking jet deliveries in the UK. So you see this real attempt by companies to try to adjust and try to adapt, even if they are based in Ireland. Okay, coming up, we're going to get you set up for your week ahead. We'll take a look at your trading diary next on your Bloomberg Brief.
The most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance. Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading week on this Monday. JP Morgan's Investor Day conference, that will be kicking off at 8 a.m. Eastern. Then President Trump is scheduled to speak with President Putin of Russia at 10 a.m. to discuss how to end the war in Ukraine. And then Lowe's and Target report earnings. That happens on Wednesday. Just want to give you a quick look at markets as we head to the end of the hour, because you have this mix that Afonso Piketty was describing as very EM-like. That is, you get rising deficits, and the reaction is tighter financial conditions across the board. We are selling off. Your 30-year yield That is back above 5%. We're up by more than 7.5 basis points this morning. The last time we had above 5%, it was 2023. We're in the throes of inflation. But we did hear from Mike Wilson of Morgan Stanley saying that any dip related to that Moody's downgrade in stocks you should be buying. And a dip we are having this morning down 1.2%. His argument that we have less of a chance of a recession because of the China-U.S. trade deal. Therefore, stocks are a buy. All right, that is it for your Bloomberg Brief. Surveillance is up ahead on this Monday morning. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Markets have wanted tax cuts and markets want fiscal responsibility.
The market is laser focused on these negotiations.
So much uncertainty is built into the market.
This is going to be the most expensive bill in U.S. history. And so how are we going to offset it?
If we get big deficit numbers coming out of this tax bill, I don't see how equity valuations hold here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday as the U.S. receives a downgrade.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. And we are determined to bring the spending down and grow the economy.
The White House pushing back as Moody's strips the United States of its top credit rating. The move hitting just as President Trump's big, beautiful tax bill advances in Washington, happy to send equity markets lower and 30-year bond yields back through 5%. The dollar is weaker Bond yields are higher.
This is the wrong kind of mix, given the fact that we have both bonds and stocks and the currency selling off, and it really highlights how the fiscal deficit is coming very much to the forefront. And Scott Besson is not completely wrong. That in general, this is a lagging indicator, and we've already seen S&P and Fitch downgrade the credit ratings of the United States. However, what you see, the Wall Street Journal, the stark math in the GOP tax plan, it doesn't cut the deficit. The Deutsche Bank, at this stage, there are no signs of any serious deficit restraint, and you're talking about $1 out of every 7 that the U.S. is currently spending that's going to interest payments that is greater than the expense for the Defense Department.
As you say, Lisa, the Treasury Secretary is absolutely right, and Moody's references successive governments. We've been running budget deficits of 6%, north of 6% of GDP in good times, not bad times. The question for this administration and Republicans down in Washington, D.C., is if you've got a plan to do something about it.
Well, they have a plan to spend more. When you look at how this is going to be tallied up, you're looking at potentially $4 trillion over the next 10 years. The question I have this morning is, does this give momentum to the deficit hawks that at the moment, when they voted last night, they said they're just going to vote it through, they're going to stay on the sidelines, not a yay or a nay, just that they abstain, and it goes to the next Rules Committee. But they're putting out messaging that this is not enough to tackle our deficit, and this fight is going to continue and linger.
So for markets, we've got 2 examples. August 2011, the downgrade from S&P. August 2023, the downgrade from Fitch, each with distinct backdrops, each with very different market outcomes. Lisa, there seems to be a belief that at the moment this is probably something closer to August 23 than August 2011.
2011 was a shock. It came as a surprise. You saw a real knee-jerk, pretty big drawdown in the U.S. equity market. People do not expect that to be the case this time around. Pretty much everyone's saying, well, how is this a surprise to anyone? We've been talking about this for a long time. That said, on the margins, to the extent that it causes anyone to pull back, Christine Lagarde, did you see over the weekend, she came out and she said, right now, the euro in the strength reflects, quote, the uncertainty and loss of confidence in U.S. policies among certain segments of the financial markets. So international leaders can have a rich opportunity to comment obliquely on U.S. policy.
Yeah, I picked up on the same quote, throwing some shade there just a bit with euro dollar at 112.81. Dollar story is interesting. I find it also equally as interesting that you're not seeing a bid in German bonds. You don't see that in JGBs. In fact, you're seeing a repricing of yields higher around the world. So there's no haven bid in one particular bond market this morning.
It's a wonderful point. Essentially, this bond market globally and the developed market rises and falls together, which is the reason why you see emerging markets may be diverging to some degree. But we saw that on the way down with NERP and ZERP and all of these very low rate policies. And maybe now you're seeing that on the way up, especially with the fissuring in global trade and the potential ramifications for inflation.
We've got a lot to work through this morning. On a 5-day winning streak on the S&P, we snapped that. S&P 500 futures negative by close to 1.3%. Coming up this hour, we'll catch up with Bob Dole of Crossmark following a U.S. downgrade from Moody's, Jeanette Lower-Strategas as the one big, beautiful tax bill advances, and Andrew Bishop of Signum Global Advisors with Trump and Putin set to speak later on today. We begin this hour with stocks and bonds falling as the U.S. loses its top credit rating. Bob Dole of Crossmark writing a rebalancing of portfolios away from the U.S. should persist as the premium equity valuations associated with the U.S. exceptionalism theme have further to unwind. Bob joins us now for more. Bob, welcome to the programme, sir. You lived through it, we all did. Just how relevant was that August 2011 experience to where we are right now?
Well, it's more of the same. I agree with the analysis you just had about what was a surprise and what wasn't, but we're marching slowly but surely, some would say quickly, to a point of no return. We're paying no attention to the debt and the deficits. The bill that's about to go through will raise it by trillions more. And at some point, there's a day of reckoning, and that U.S. exceptionalism is tied to that.
So, Bob, the bill down in Washington is advancing. Do you believe there is a level at which this begins to constrain the ambitions of Republicans in Washington? And if it's not 5% on the 30-year bond, what is it?
That's a great question. I mean, the 5 on the 30-year and 460 on the 10-year has been for technicians point of concern, yes, for the bond market, but also for the stock market. Can we support those kinds of levels? And of course, you're getting all kinds of blinking by hawks on the deficit in Washington, D.C. Look, the alternative, of course, if we don't pass a bill, is the largest tax increase in U.S. history on December 31st, and nobody wants that either. So we're between the proverbial rock and hard place.
At this point, Bob, as a market participant, do you buy the blinking, the sense that there will be some capitulation on the part of Washington, D.C. to the deficit hawks? Or do you say this is a different and kind of existential concern that causes you to really back away from any movement that we're seeing, any sell-off in the bond market?
Lisa, I think that the bond market is sending a message. The message is you can't do this forever. And we're trying. We're trying really hard. Look, if the stock market weren't selling at 21 or 22 times, demanding near perfection, you might blink and move the other direction. But the stock market can't take much bad news at these kind of valuations.
There's this concern between the rock and a hard place, Bob, and it raises really one of the ultimate questions for the market right now. What is the bigger risk? A sort of dramatic deceleration in growth, whether it's a policy shock on the budget side or whether it's some sort of policy shock on the trade side, or some sort of acceleration in growth but fueled by increasing deficits and what some people could argue is fiscal irresponsibility.
I'm still concerned about the slowing of the U.S. economy. We have that fight, Lisa, as you know, between the hard data and the soft data. The soft data mostly falling off a cliff, the hard data kind of hanging in there. But we know hard data usually follows soft data. So either the soft data have to recover nicely, they may do some of that, or the hard data to fall, and I think it's going to be a bit of the latter. And we're going to have earnings estimate cuts, which we don't need it 21 or 22 times.
Bob, you have the Treasury Secretary over the weekend saying he doesn't put much credence into the Moody's report, but do you think the Moody's downgrade can actually change votes in Congress?
That's a great question. Look, I think it will change the dialogue to some degree. The deficit hawks will have a louder voice and probably think, well, maybe this is our chance to make a difference. We'll see. They obviously voted present rather than no to get to the next stage, but this is not pretty. Let's see how the bond market does, and that will be a signal to those legislators about how hard they should, how hard a line they should take.
Yeah, some like Congressman Chip Roy voted present, but he's also in the next hurdle. He's in the Rules Committee. He voted present in the Budget Committee, so potentially has a change of heart overnight, depending how the market does. If it was to potentially mean that we could see some votes change, trigger some votes down in Washington, D.C., where do you think it would come from? Where would they cut?
Yeah, that's a great question. Look, I think they'll try the best they can to cut the spending in the out years, so it's easier to reverse later on, as opposed to doing things now, which is a lot of smoke and mirrors. But you know that's the way they tend to operate.
Bob, all these reasons to be bearish bonds, are they good reasons to be bearish stocks as well?
Well, yes, I think the reasons are, look, the stock market has a problem. The bond market has a problem with slowing economic growth and potential further earnings cuts, and the valuation. You put all that together and, you don't have to be bearish, but boy, it's hard to be bullish.
But the retailers have got a problem as well. Let's finish on those retailers. Some of them report later on this week. We'll hear from Home Depot. We'll hear from Target as well. This White House is piling on the pressure on Walmart and sending a warning, I think, to retailers across this country that if you raise prices, we're going to make public relations for you very, very difficult. What do you think that means for pricing strategies across corporate America?
I think they will still have to raise prices. You know, the retail business has very low margins. And so when there are cost pressures, it's hard to eat them. They'll eat some of it probably with all this pressure from the White House, but by and large, they're going to have to raise prices if their input costs are moving up. And for a lot of reasons they are, most related to the trade.
Bob Dole of CrossSmart. Bob, appreciate your time, sir. As always, the president over the weekend eat the tariffs.
Yeah, really angry about Walmart, saying you're going to come out, you're going to blame that on tariffs. Scott Bessent pushed back a little bit on some of the Sunday talk shows. Treasury Secretary Bessent came out and said, yes, Walmart's going to eat some of the tariffs. They're also going to have to pass them along. He conceded, and he said, Doug and I have a very good relationship, and talked about how it was a conciliatory discussion to really get more information rather than to jawbone him. It's sort of this good cop, bad cop that they have going on right now.
And the Treasury Secretary said this is the most draconian measure that they have to offer because of SEC rules to their investors. They need to say what could be the worst, kind of throwing some cold water on that. Actually, for Walmart, this is going to be the worst case scenario.
This is the world we live in right now. You had that report several weeks back about Amazon breaking out the tariff costs. What happened? The president called Jeff Bezos. What happened this time? The Treasury Secretary called the CEO of Walmart to work out what was going on.
If Walmart, though, does raise prices, that gives a real free ride to the other retailers to do the same. And that's the reason why Target and TJ Maxx and all the other retailers that are reporting this week are going to be crucial to understanding just how much power Walmart gave to them to say the same thing.
It's quickly becoming a big feature of earnings season for the retailers. We'll hear more from the retailers later on this week. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The House Budget Committee approved President Trump's tax and spending package after Republican hardliners won over party leaders to speed up cuts to Medicaid health coverage. The bill now heads to the full House and then to the Senate, where the deeper Medicaid cuts and other provisions face scrutiny, if not outright opposition. Meanwhile, President Trump is set to hold a phone call this morning with Russian President Vladimir Putin. That's after Ukrainian President Volodymyr Zelensky met with Vice President J.D. Vance yesterday at the Vatican. Secretary of State Marco Rubio says President Trump is prepared to back new sanctions on Russia if today's talks don't go well. And former U.S. President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has spread to his bones. According to a statement from his office, the president and his family are reviewing treatment options with his physician. Biden is 82 and left office in January as the oldest president in history. That's your Bloomberg Brief. John?
It goes without saying, we wish the president all the best. Yahara, thank you. More from Yahara later on this hour. Up next on the program, advancing Trump's tax bill.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets.
They're maintaining that aggressive timeline. It's sending a signal to this bond market, all right. We'll get into it in just a moment with Jeanette Lowe of Strategas, live from New York City this morning. Good morning.
In New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The message from Mike Wilson of Morgan Stanley this morning. Buy this dip. Here is the dip. Equity futures on the S&P 500 negative 1.3% following a 5-day climb on the S&P 500, posting a 5% plus advance on the S&P last week. We break that streak so far this morning. In the bond market, just check this out. This is the ugly mix we've been talking about. Yields up, dollar weaker. Yields up 8 basis points at the very long end of the curve, through 5% on 30s. Dollar weaker, euro stronger, 112.78. US assets, once again, trading in one bucket.
And this is because ultimately you have a downgrade just simply underscoring the concerns around fiscal as well as some of the trade policy uncertainty. That 1-2 mix is the reason why a lot of people have gotten really nervous.
The focus on the tax bill down in Washington under surveillance this morning, advancing Trump's tax bill.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets, and as I mentioned, to job creators and entrepreneurs and risk takers. This will be the pro-growth economy that we have been waiting for and that the American people voted for. We're going to deliver on this, and we'll get everybody in line to do it.
So here's the latest this morning. A key House committee passing President Donald Trump's tax bill overnight. Republican hardliners allowing it to advance after party leaders agreed to speed up Medicaid cuts. Joining us now from the nation's capital, Tyler Kendall. Tyler, Memorial Day a week away. What needs to happen between now and then to advance this bill?
Yeah, hey, John, good morning. Well, a few different things need to happen because, to be sure, while fiscal hawks say that they have in writing from House leadership some of these plan changes, including moving up the timeline for Medicaid work requirements, rolling back some of those clean energy tax credits, the bill text itself has not yet been changed, which really does mean that negotiations are ongoing here. We are expecting those changes to happen when the Rules Committee meets. That's on Wednesday, set for 1 a.m. Eastern, where we could see any of those details emerge. And while fiscal hawks did get to bolster their argument in the wake of the Moody's downgrade, which, as you know, blames successive administrations, but also Congress for a ballooning budget deficit, Moody's says shows little signs of narrowing, it's unclear if they really will get those aggressive cuts that they're looking for. In fact, I caught up with Congressman Chip Roy of Texas on a one-on-one basis on Friday before the budget vote was delayed. And he told me that they're really pushing for the immediate implementation of these work requirements, which is considered to be a pretty ambitious timeline, not to mention it would face scrutiny in the Senate and put the White House in a politically fraught decision. John, the other one that we're still waiting, the other sticking point that we're still waiting for details on, of course, is lifting the SALT cap, which just adds to the conversation about those revenue raisers.
I'm glad you mentioned Chip Roy, because not only he's on the Budget Committee and he voted present to allow this bill to go through, but he's on the Rules Committee, so he's going to be at the next round of infighting. And Tyler, overnight, he said the bill does not yet meet the moment. What else does Chip Roy, Ralph Norman, what do they want to see?
Right. Well, they definitely want to see speeding up when it comes to those work requirements being implemented. They say immediately. Right now, they're currently in place to go into effect in 2029. We're hearing that likely there would be a compromise closer to 2027. The other thing, too, though, is trying to cut those deficits down even greater, find more revenue raisers when it comes to the tax side of the bill. Perhaps that could mean lifting the tax rate on some. The House Freedom Caucus has signaled its openness to a millionaire's tax, and we actually saw Nick Lota of the SALT Caucus over the weekend float that potentially they could let the TOPS tax rate expire under the 2017 tax bill, which would snap back that rate from 37% to 39.6%. So perhaps we could see some sort of compromise there. And then lastly, Anne-Marie, importantly, is really those clean energy tax credits. The House Freedom Caucus wants to see those rolled back immediately. That's something else that will face pushback in the Senate from those Republicans in representing those states that are trying to transition their economies.
Tyler Kendall with the latest. Tyler, thank you. More from Tyler in the next hour. Let's extend the conversation with Jeanette Lowe of Strategas Abed Company. Jeanette, welcome to the program. Two events, one event, one outcome. Let's talk about the event. The US losing its final AAA credit rating, this one from Moody's, and the outcome, Treasury yields back through 5% on a 30-year bond. Did the fiscal hawks in Washington just get some extra fuel?
Oh, absolutely. This was definitely something that bolsters their argument. They had gone into this fight all along saying there needed to be much more significant budget cuts. They were the ones who were pushing for even larger budget cuts in order to have larger tax cuts in place. And they're still not satisfied with just overall where the fiscal situation is. Essentially, they're looking at the federal spending levels and seeing that it's essentially about still 4 percentage points higher than it was pre-COVID in our long-term average. And so that's something that they really want to tackle here. So the fact that you had On Friday morning, the members of the House Budget Committee, the fiscal hawks on that committee, voting no against this bill to send a signal that they wanted more significant cuts. They wanted to accelerate them. And then on top of that, you get the Moody's downgrade in the afternoon. That really added some fuel to their argument to say that we need to do something even stronger because of the U.S. fiscal situation.
Did this upend Speaker Johnson's plan to get this all done by Memorial Day?
I don't think so. I think that there is obviously some significant push here to get this done. This is part of Trump's agenda. He does want this bill to get accomplished. There has to be some compromises because obviously the fiscal conservatives do not have a solid majority. They have to negotiate with the moderates to run this through on a Republican-only basis. And failure means that if you would actually have to do a compromise with Democrats towards the end of the year, if you can't get it done through reconciliation, and that means that you would probably have higher spending levels and higher taxes, and that's something that the conservatives don't want.
Well, to you and Jonathan's point, the fiscal hawks seem to have some fuel right now after what happened with the Moody's downgrade. Who else has leverage in this fight?
Yeah, so I mean, obviously, I think the moderates do still have leverage because they are not going to vote for things that are going to cost them their seats. They are obviously the majority makers in this Congress. And so that's going to be really important for them to not have significantly drastic cuts. So that's why I think, having work requirements moved up to 2027 rather than immediately makes a little bit more sense. You also do have the SALT caucus. So the blue state Republicans who are pushing for a higher SALT deduction, they believe that that's really important. So they're still going to be pushing to get their leverage in here. And then obviously we do need to watch the Senate as well. The Senate is saying that they're signaling that they're not happy with some of the provisions that the House has put forward, but the House also does have, and the Senate does have to realize that the House has this very slim majority. There's not a lot of wiggle room to really make significant changes if you have to deal with these competing factions in the House caucus.
Jeanette, I love a good deficit debate. It's a great thing to have. We discuss it all the time. Is there enough discussion about the growth side of this bill, how much it actually does boost growth and the other side of the balance sheet that's crucial to keep the deficit in some sort of balance relative to GDP?
Yeah, and I think this is a really important piece with the tax bill is we have two things that are happening. First, they did include more pro-growth tax provisions in this bill. So they have immediate expensing for CapEx, for R&D, and for structures, again, to kind of get more domestic manufacturing in the United States in the midst of this tariff war that we're essentially having. And at the same time, too, the fact that we had the significant tariff reduction on Chinese goods over the past week. So that also plays into this. So now we can have a tax bill that has more pro-growth provisions in it that can actually help to sterilize the tariffs that are still in place. And that's important because we do have essentially a $2 trillion consumption tax that's put into this economy. So having fiscal stimulus for consumers that will hit next tax season is important. Plus, you have these business investment incentives. And together, we look at what we have as the current bill in front of us. We're looking at saying that that is going to increase or boost a GDP by 1%. And that is a really important point to also keep in mind.
How much does that offset the increases to the deficit on a sort of relative basis at a time where people are saying at the same time growth is going to slow as a result of some of these tariffs?
Yeah, I mean, so I think we still think that the deficit is on a improving trajectory. You do have tariff income coming into the U.S. Treasury that won't obviously count for this tax bill, but we are going to see some improvement in the deficit. Obviously, it's not significant for especially fiscal conservatives, and so that's something that comes into play. But if we were looking at the fact that maybe we would have significant tariffs in place and maybe this tax bill would have been delayed, that wouldn't have helped to boost the U.S. economy and could have been a worse situation. If you actually have some of these pro-growth tax policies in place and they happen before the stronger tariffs hit, that actually provides some boost to the U.S. economy and that actually can help with growth over the long term and then help with the deficit.
Jeanette, just finally, just to wrap it up, do you think they get this done a week today?
I do. I do think that they will get this. This deadline is very strong in the House. Now, maybe it's not done by Thursday, maybe it's done by Friday, or it gets pushed into that holiday weekend. But I do think there's a strong effort to get this done. And the fact that you had the Budget Committee meeting at 10 o'clock at night on a Sunday is really important to show that they really do want to get momentum. Voting present, obviously, was them backing down to some extent to allow the bill to move forward. And now they have a couple of days before they do that 1 a.m. Rules Committee meeting on Wednesday.
Jeanette, appreciate your time. Thank you. Jeanette Lowe there of Strategas, a bad company, the president back in Washington, D.C. And the president's going to be pretty loud, I imagine, this week on this issue.
He already is. He's on the way back from the Middle East to the United States, was saying stop grandstanding and get this done. Also, Child's Play, 10 p.m. meeting on a Sunday. The Committee on Rules will meet Wednesday at 1 a.m. They are dedicated to try to get the Memorial Day deadline. But that's the House. Wait till this goes to the Senate. This is going to be incredibly challenging to pass.
Lisa mentioned the growth picture. Lisa, I think you're dead on. This is the problem they've got. If they don't extend the Tax Cut and Jobs Act, you're going to see the growth picture deteriorate pretty quickly.
This is not just something that austerity can necessarily solve. This is the difficulty that you can't cut your way to a fiscally responsible picture. You have to tweak things in a perfect way on both sides where you're not hampering growth so much that you cut off your income to not spite your face.
A difficult moment for lawmakers down in Washington, D.C. Just about made sense of that.
It didn't make sense.
Equity futures on the S&P. It's early. It's Monday morning. We're down 1.2%. We can't make sense of any of it. Up next on the program, Andrew Bishop of Signum Global Advisors, ahead of a phone call between President Donald Trump and Russian President Vladimir Putin.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
5-day winning streak on the S&P 500. We're snapping that this morning. On the S&P, we're negative by 1.2%. Moody's stripping the US of its final AAA credit rating. That's unleashing a move in the bond market. Check this out. Long end of the curve, yields higher by 7 basis points at 5.01%. I think it's also important to recognize that the tax bill is advancing down in Washington, D.C., and that's going to have a bigger impact on this bond market than anything Moody's has got to say. With yields up at the long end, in the FX market, this is the tell, and it's not a great tell. The dollar's weaker. The euro's stronger, and we're seeing this across G10. Euro dollar, Lisa, right now 112.78.
This is the wrong kind of fiscal mix all around, and it is fueling speculation that international central banks are moving away from the dollar on the margins as a reserve currency. You can have that debate until we turn blue in the face. It's just this kind of mix of asset pricing is not what you want to see, and is currently fueling a question about a mini sell America.
Yields are up in the US. They're also up in Germany. We talked about this 30 minutes ago. Also up in Japan. Gold's rallying. Gold is higher today by more than 1%, and that's been the story of this building, not just this year, but for a number of years.
Christine Lagarde can throw shade at the dollar and U.S. policies, but the reality is that European policies haven't attracted the same kind of confidence that people can really get behind for the euro to have the same sort of reserve currency status. And that's the reason why gold has been the preeminent hedge, whether it's inflation, whether it's dollar supremacy, or whether it's just, it looks nice.
Snap back to reality. 5% plus move on the S&P 500 last week. This morning, negative by more than 1.2% with 3 hours until that cash open. Your morning movers look like this with Danny Berger. Hey, Danny.
Hey, John. It's very clear where the pain is concentrated in individual stocks. It is Mag 7 that is under pressure this morning with the deficit concerns, the Moody's downgrade, bond yields back above 5% for the long end. Nvidia down nearly 3%. Tesla's down more than that. So again, it's those types of names. All of that overshadowing what Jensen Huang was doing early this morning. He was in Taiwan at Asia's biggest electronic forum, touting new technologies, trying to do more of an open source thing for Nvidia code. Even so, shares are down again, back below 3% this morning. To the upside this morning, Novavax, this is a vaccine maker, a really long delayed road for them. It had been to get approval for their COVID vaccine. This still moving shares. They finally got that approval over the weekend. However, it is a more restrictive approval. Only folks over 65 or those with underlying conditions can get the COVID vaccine. Even so, those shares up 16.6%. Netflix, that is also declining this morning with the rest of tech, but it's getting a double whammy this morning. Not only the overall macro environment, but JP Morgan downgrading from overweight to neutral, saying they're still long-term bullish on the stock. It's just run up a lot, some 30%. They say all of that price reflects the bullish case for 2025, John.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, Moody's stripping the US of its top credit rating, citing growing budget deficits from successive administrations with little sign of easing, as President Trump's big, beautiful tax bill advances in Washington, passing through a key House committee after a weekend of negotiations, but facing more pushback as it barrels towards a vote by the full House.
So basically, at the time that Moody's is downgrading the United States, this is going to give really some momentum to the fiscal hawks that say not enough is being done to cut the deficit, especially as we have spending. And you look at some of the independent congressional budget groups that are saying this is going to cost about $4 trillion over the next decade. Lisa, you brought up this great stat I tweeted about this morning from the Wall Street Journal. I think it is the most important stat of the morning, and it has to do with our interest payments. U.S. interest payments are the second line item after Social Security, above defense, above veteran affairs, above everything else we pay out. That's because $1 out of the 7 the U.S. budget pays out is going towards what? Paying off our debt. And this is going to make it a lot more challenging.
Which is the reason why both they have to increase some sort of fiscal discipline while also increasing growth. I just look at this and look at the market response. And when you look at the commentary, people are kind of agreeing with Scott Bessent. They don't really give a ton of credence to a 2011 style sell-off in markets. That said, it brings the debate forward about the fiscal health of the United States and really underscores just what's at stake with that bill.
I just don't think 2011 is particularly relevant. The backdrop was so different. You had the Eurozone debt crisis almost at its peak back in 2011. You had this demand for safe haven assets like treasuries. No one really cared what S&P thought about that. You wanted to buy treasuries, and that continued. This is closer to what we saw in August 2023. And the backdrop for that was a worry about too much spending, too many bonds coming to market. And this basically collided with a quarterly refunding announcement from then Treasury Secretary Janet Yellen, and they had to make a move. This has been building and building under the Biden administration. They managed to cover it up by issuing a load of T-bills, and now the bill's coming due. And the bill's coming due at precisely the wrong time, not just for the Republicans, but also for this country, because you need to extend TCJA, because if you don't, you're going to slam the brakes on economic growth.
You can't really cut that at the same time as trying to repair the fiscal trajectory. The U.S. deficit has been growing under every president. It's grown over under the former administration of President Trump. President Biden expanded it incredibly due to the pandemic, and currently we're looking at something of a deficit that is 6% or more than 6% of the GDP. Moody's was saying that he expects the federal deficit to reach nearly 9% of GDP by 2035. This is akin to many emerging markets, and this is something that isn't so easy to remedy, and this is the reason why there's some yippiness in bond markets.
And we see that yippiness this morning, back through 5% on a 30-year. We need to talk about this too. This is going to be part of a broader conversation as we get more earnings from retail America. President Trump telling Walmart to stop blaming price hikes on tariffs, saying the retail giant should, quote, eat the tariffs. Walmart promising it will keep prices low for as long as possible.
So Walmart on Thursday came out and they said even at these reduced levels announced this week, when it comes to China and the U.S. having this détente, we aren't able to absorb all the pressures. The Treasury Secretary, though, went on TV and said Walmart will be absorbing some of the tariffs, but some may get passed on to consumers. He also said he had this phone call with the CEO and said that he had to give the most draconian response because of SEC rules. So basically pouring cold water on what the CEO had said on Thursday, that this was going to be the end-all and be-all and how they're going to pass on the tariffs. One other thing Scott Besson said that was interesting. He really felt like he was meeting the American people where they are. I don't want to blame consumers after what happened during the Biden administration with high inflation. Basically, I understand why consumers feel this consternation and anxiety right now because they have the lived memory of very high inflation under the prior administration.
We'll come back to this conversation with Neil Dutta of Renaissance Macro a little bit later on in the program. He'll catch up with us about an hour from now. Need to catch up with this story. President Donald Trump holding a phone call with Russian President Vladimir Putin later this morning to try and reach a Ukraine ceasefire deal. Bloomberg's Ollie Crook joins us now for more. Ollie, what's the latest?
Yeah, Jonathan, we've been really waiting for the moment of truth in Ukraine ever since Trump took the presidency. We get one step closer to that today, potentially today at 10 a.m. Eastern time, 4 p.m. Central European time, when he speaks, President Donald Trump speaks with President Vladimir Putin in order to potentially thrash out the conditions to begin a ceasefire, to begin peace negotiations. Remember, this is something that the Europeans and Trump and Ukraine were pushing last week. It was rejected by Putin. Instead, they had those sort of mid-level talks in Turkey, which basically yielded nothing. And then Trump said, listen, nothing's going to happen till I talk to Putin. And today, he will talk to Putin. All of the European leaders that I spoke to over the last few days in Albania at that leaders meeting that was hosted on Friday, they all say that this is basically the President Putin stalling for time because he's got initiative on the battlefield. This is not a serious overture. For the Trump administration, there is coming a point, and I don't know that we reach it today, but we're getting closer to it with every one of these interactions where the Trump administration and Donald Trump needs to decide and needs to say who the problem, the impediment to peace is. Is it Vladimir Putin? Is it Volodymyr Zelensky? Or is the problem too large for the administration basically to take on? And every time we get closer and every time we have one of these interactions, we get closer to answering that question. And that is the question that is before everybody here in Europe and Ukraine and around the world.
Are we closer to a deal or closer to more sanctions? Ollie with the latest. Ollie, looking forward to your reporting in the next 24 hours. Joining us now to build on this conversation, Andrew Bishop of Signum Global Advisors. Andrew, the US, the president, is going to have to talk to the Russian leader, and then he's going to have to talk to the Europeans. Which conversation do you think will be the hardest?
I think definitely the conversation with the Europeans is going to be hardest because it's essentially going to amount to President Trump forcing the Europeans, or at least trying to force the Europeans to agree to President Putin's conditions for a ceasefire. And the main, or let's say most thorny one of those, is going to be a halt to all European weapons supplies to Ukraine during the period of that temporary ceasefire. That's going to be very hard for the Europeans to agree to. At the same time, Trump is going to put enormous pressure on them. And we've seen the Europeans back down quite dramatically over the past several months in terms of how much support and how much they're willing to stand up for Ukraine in terms of actions rather than words.
We have reporting that Putin is pretty confident that his forces can break through Ukraine's defenses by the end of the year. So do you think there's any matter in which Putin decides that he wants to have a ceasefire this year?
That's a very good question. So I think for the first 4 or 5 months of the year or of the second Trump administration, the difference between the odds of a ceasefire and the odds of a peace deal was minimal because essentially Putin wanted neither. Because Trump is running out of patience, we're now reaching a point where the odds of the ceasefire are good. The odds of the end of the war are very, very low still for the reason you just mentioned. And so the answer to your question, in my view, is yes, we are going to get a conditional temporary ceasefire. No, that is not going to lead to an end to the war, given Putin's sort of leverage still.
Andrew, I just got back from traveling with the president. Every single day, he left the door open. This was a lingering discussion whether or not he would peel off his Middle East trip and go maybe sit down with the Russian leader in Istanbul. Do you think Trump has shown his cards? He's too eager to speak to Putin?
Absolutely. Now, there's no question, and this is one of the reasons why I still do not expect an end to the war this year or anytime soon, frankly, because Putin has the upper hand. That being said, President Putin has shown that he's very, very good at, even though he has the upper hand over Trump, staying just one step ahead of Trump in terms of giving President Trump little carrots. And I think that next little carrot to avoid sanctions, to avoid Trump walking away from the table, is going to be a 2-3 week ceasefire.
Andrew, you keep talking about leverage over President Trump, leverage over Ukraine, leverage over Europe. I'm just wondering how much Putin loses that leverage if sanctions and secondary sanctions go on in a significant way.
He would lose it altogether. If meaningful U.S. secondary sanctions on Russian oil were to snap on, Putin would have to end the war within months. There's no question. It is exceedingly unlikely that President Trump is going to take that step.
How much did you view the meeting in Rome as a real positive between the vice president and Volodymyr Zelensky over the weekend? This sense that maybe the U.S. was moving closer to Ukraine. Do you think that that's just sort of cosmetic, or do you think that there is some substantial change in policy?
No, I think that is cosmetic, unfortunately, yeah.
Well, it was certainly welcome because it was a massive difference to what we saw in the Oval Office, Lisa, a number of months back.
Yeah, I found that notable, given the fact that the two of them ended up in a screaming match. I just wonder what the sort of post-facto analysis of that meeting was, whether there was a real sense that it failed on all fronts and why it failed, or whether there was a sense of that chastened the discussion in some sort of way. But it seems like there's been a real change.
The photo says it all, of J.D. Vance sitting next to Volodymyr Zelensky in Rome, and they're both smiling and laughing. It is very different than the tone that was in the Oval Office. So even if it's cosmetic, they are projecting a more united front as the president is heading into this 10 a.m. phone call with Putin.
Andrew Bishop of Signum Global Advisors. Andrew, thank you, sir. Looking forward to that call later on this morning and the outcome of it. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. We start with Moody's stripping the U.S. government of its top credit rating. The agency lowered the U.S. by one level from AAA to AA1 on Friday. Moody's cited the failure by successive administrations to deal with rising U.S. debt and deficits. Treasury Secretary Scott Bessent downplayed concerns over the downgrade, saying Moody's is a lagging indicator. Meanwhile, a Mexican Navy ship crashed into the Brooklyn Bridge Saturday night. 2 sailors were killed and 22 more were injured, 11 critically, when the ship lost power and scraped the bottom of the bridge. The Department of Transportation said there was no major damage to the Brooklyn Bridge. And the New Jersey transit strike is over, but train service won't resume immediately. The Brotherhood of Locomotive Engineers and trainmen approved a deal Sunday night to end New Jersey's first rail strike in 40 years, but rail operations are not set to resume until tomorrow. As for today, New Jersey Transit encouraged commuters to work from home if possible, which we know Lisa also endorses. That's your Bloomberg Brief. John?
Apparently, that's where Lisa wants them to stay. At home, Yahara. Thank you.
I am actually looking out for them. I am actually quietly jealous
Are you
of
supporting
them.
work from home?
I'm supporting a day of a reprieve. I'm not going against some of the return to work. This isn't a big political discussion.
It's not about having fewer people in New York.
This is not about long term. This is enjoy your day. Have a nice time.
Got it.
Go for a walk with your kids.
Not a big fan of work from home.
Do you want to fight about it?
No, I'm good. I'm good. This is
Nor
the
am I a big
policy.
fan of congestion.
Okay. Up next on the program, Sell America making a comeback.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. We didn't get here in the past 100 days. It's the Biden administration. We are determined to bring the spending down and grow the economy.
Bond yields are higher. The dollar's weaker. Up next, Mark McCormick of TD Securities, live from New York City. You're watching Bloomberg TV.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%. And I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Moody's downgrading the United States going into the weekend, and here's some of the fallout. Equity futures negative by a little more than 1% on the S&P 500, down by 1.5 on the Nasdaq 100, following a stellar rally just last week. We snapped that winning streak on the S&P, 5 consecutive days of gains. In the bond market, yields are higher. The 30-year back through 5% for the first time since April, 5.02% on a 30-year. And in the FX market, the dollar weaker. Euro-dollar up to 112.74. Under surveillance this morning, Sell America making a comeback.
I think that Moody's is a lagging indicator. I think that's what everyone thinks of credit agencies. We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. And we are determined to bring the spending down and grow the economy.
So here's the latest this morning. The White House pushing back after Moody's stripped the U.S. of its top credit rating, sending the dollar lower and bond yields higher. Mark McCormick of TD Securities writing the dollar has a long way to go to get back to longer-term fair value. This downturn is likely just getting started. Mark joins us now for more. Mark, good morning and welcome to New York. It's good to see you.
Thank you.
Let's get to the SFX story. We asked this question last week. I'm going to repeat the question to you to get your response. Right. Fiscal stimulus leads to a stronger currency. Fiscal recklessness leads to a weaker one. What is this?
This is the latter. We've already seen this playbook. It looks like an emerging market. What happens is yields go up, currency goes down, equities fall. This is not what we're used to. This is not what you see in the U.S. But essentially, I think one of the things is the balance of payments in net international investment position shows that the kindness of strangers have been basically funding U.S. twin deficits. That is now a challenge. There's a trust problem, there's an uncertainty problem, there's a growth problem, and there's also a valuation problem. So what's happening very clearly in FX, and people have talked about this for a decade, the dollar's been overvalued. The dollar's been basically overvalued except for a little period of time for 40 years. But this is the catalyst. The catalyst is the rest of the world now has other places to invest. They're stimulating their economies. Their equity markets are essentially undervalued. And I think a critical thing here is what we're doing is we're unwinding globalization. And what we're doing is the U.S. was the spender, Europe and Asia were the savers. The savers are bringing their money home, and that leads to local higher rates, more consumption, stronger currencies, and higher equity markets. That's where this is going.
We've seen EM-type frameworks grip DMs before, but it's been temporary. Seen it in the UK, seen it in France, seen it in the southern European countries at times as well. How sustainable do you think this market regime actually is?
Well, I think it's a total regime change. And again, I think a big piece of it is what is Trump trying to do? That's every client meeting is, what are they doing? Are they trying to eliminate the trade deficit? Are they trying to generate revenue to pay down government stimulus? Again, what was Doge? If you look at these numbers, revenues in Doge is a couple $100 billion. The budget that's being announced right now, or the idea around it, we're talking about trillions. So this is not a revenue generating type of environment. So I think the piece of it is they want to eliminate the trade deficit. If they want to eliminate the trade deficit, yes, getting the dollar lower is a precondition, and that's how you could reindustrialize. But there's so many other pieces that comes with reindustrialization. It has nothing to do with the currency in terms of labor, infrastructure, all those kinds of things. But if the goal here is to reverse globalization, U.S. equities and the U.S. dollar are the centerpiece of globalization. And they've been essentially what you're going to do is you're going to eliminate their role within this, and you're going to give the renminbi, and you're going to give other currencies. And this goes back to that multipolar world. You're going to have a multipolar currency world, which gold is the anchor to bring it together.
So this raises a question, just to build on what John was asking. We've been talking about how close we are to a Liz Truss moment, where suddenly there's a real gut check in markets of policies. Is that the right way of looking at this? Do you see something like that on the horizon?
Yeah, so I think we already went through Liz Truss moment .1 in April. Like Liberation Day, the impact of that was a Truss moment. They had we pulled back. You could see that China basically stepped up instantaneously and was like, we're gonna match you on tariffs. We're not gonna back down. And now what you've seen is there's already been a walk back a little bit. But we are going to go through probably many Truss moments. This is probably another mini earthquake version of this with the downgrade. Because again, what the market sees is the U.S. is in a very precarious position where the dollar's reserve status is being undermined at a time when it requires foreign investment. So to say to the rest of the world, we don't need you, we don't want your money, we don't want your capital, we want to be on our own, is saying to the rest of the world to return your currencies home and essentially find a way to grow your own economy. And this, what's happening is we're also seeing it in the pension fund world. The largest holder of U.S. equities is Canada, but there's also Japan's in there, Sweden's in there, Ireland's in there, UK's in there. All these countries own U.S. assets that they're going to bring back home and use and basically stimulate their own economies. And so this is going to pull money out of the U.S.
Can you give us a map to understand what this might look like in terms of mini Liz Truss moments? I mean, what's the magnitude of moves that we're talking about that could potentially cause these tremors, but not necessarily a wholesale change?
Well, I think a piece of it, right, the intuition around what should be happening is the economy slowing. The trade wars have pulled back a little bit. The markets have downgraded how many Fed cuts they're going to expect this year. But what's happening is rates are selling off. The curve is steepening. That's a sign of a loss of credibility. That's a lack of trust in the U.S. market. And what's happening is the dollar is declining. The curve is steepening. So I think one thing you want to keep on the radar screen is the U.S. dollar correlated to rates. It is not. That is a very, very concerning sign, because what you would expect is as rates go up, you're still going to have to pay carry to sell the dollar. And you don't want to have those wide interest rate differentials and pay the difference on it. But the point is as long as rates are going up and the dollar's selling off and those correlations are starting to change, that shows you that the regime is changing. The other thing is that U.S. equities are up. They've been rallying since Liberation Day, but the dollar's still not responding to higher U.S. equities. So I think a lot of it is what's happening in the equity market. If you track portfolios of hedge funds in the U.S. are buying into risk assets, but global funds are not. And you can see macro hedge funds are underperforming like localized hedge funds as a function of they are negatively biased against the U.S. dollar, U.S. assets, And I think that the playbook is to watch how these correlations are not going back to normal. That'll be the key.
Mark, what do you make when the Treasury Secretary continues to reiterate that the U.S. still has a strong dollar policy?
I think he just has to say that. That is the standard litmus test. That is, they can't say that we would it's clear within certain frameworks and papers, the goal was to have a stronger dollar
So he's giving lip service.
That's every Treasury Secretary talks about a strong dollar. I've never heard anyone in the last 30, 40 years say we want a weaker dollar, but it's like, don't tell me, show me. And the behavior that's coming out, and again, the big piece of it, and I think everyone knows, is the U.S. can't run twin deficits without foreign capital. And again, the Japanese are the largest owner of U.S. treasuries. And again, you're talking, and if you see the trade discussions going on with U.S. and Japan, Japan has a very big card they could play there, which is essentially undermining the treasury market and causing a further steepening of the curve.
The US wants that capital. I want to be very clear about that. What they don't want is their exports. Can you have one without the other?
You can't. You have, essentially, there is an accounting identity that works, and it's worked through the entire phase of globalization. And the phase of globalization since China entered WTO is essentially U.S. runs a deficit, and the rest of the market funds it by buying U.S. assets. So you run the twin deficit, you run a current account. The other side of the ledger is a capital account. That's all the foreign money coming in. So the reason why the dollar's overvalued by 15, 20% on a broad basis is everyone has been buying U.S. equities since even the last 5 years. It is the largest holding of assets. Is if you look at foreign holding relative to U.S. market cap, it's almost a third. So essentially, the U.S. equity market's been the only game in town, especially for the 10 years that we had or 15 years of low interest rates. And essentially, you cannot have those two things work together. You need foreigners. And essentially, if you wanted to reindustrialize, you would need the foreign capital to fund the factories and to fund the deficits and to bring the engineers. You would need all that to work.
That's the structural bid in dollar assets. Will we upend that? Mark, it's good to see you, sir. Appreciate your time. Mark McCormick there of TD Securities, a clinic on the FX market. The second hour of Bloomberg Surveillance, just around the corner.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We're going to have mixed data throughout this period. We're not going to really know where we stand.
The consumer is much more sensitive.
What we've seen and heard has allowed us to take down our recession fears just a little bit.
What we're seeing collectively in all this data is an economy that looks to be slowing a bit.
The hard data are going to turn. When the hard data turn, we'll have the Fed cutting.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores look like this. Equity futures on the S&P negative, and we're down across the board following a 5-day winning streak. We break that this morning. The S&P down by more than 1%. Lisa used to talk about a so-called toxic brew. This is what a toxic mix looks like. Equities down, bond yields higher. Check out the 30-year. Back through 5%, yields up 8 basis points at the long end, and the dollar weaker. Euro dollar advancing by some 1 percentage point this morning. Euro dollar at 112.76. That's the toxic mix that we saw back in April. We see it again this morning.
If you want to be optimistic, you could say this toxic brew follows this Nirvana sell-in last week when we saw an incredible rip-roaring rally in equities and bonds. That said, it is a toxic brew when you look at some of the fiscal overhang and when you look at some of the rhetoric coming out of Washington, D.C., not to mention some of the concerns about profit reductions among corporations, not most notably retailers set to report earnings. It is a difficult time to get your handle around U.S. policy, and as a result, a lot of foreign investors clearly are selling U.S. assets.
The Moody's downgrade is not news for many people in this market. It's been on negative watch for more than a year. We've arrived at a decision long after a lot of people had already made theirs. The budget deficit is north of 6% of GDP in this country in good times. Under successive administrations, we've got to do something about this. The question we keep returning to, what is the plan down in Washington as this big, beautiful tax bill advances?
Well, the plan is that they're going to spend more when it comes to this one big, beautiful bill. It passed a key committee last night. Now at 1 a.m. on Wednesday, it's going to go to the Rules Committee. Will it pass? Speaker Johnson has a very, very aggressive timetable. He wants this done by Memorial Day. Jeanette Lowe thinks they get there. But she also thinks the Moody's downgrade gives more impetus to these fiscal hawks to bring forward things like cutting in Medicare and also potentially getting rid of these green rebates and tax credits we saw under the Biden administration.
The size, shape, contours of this bill more important to this bond market than anything Moody's, S&P, and Fitch have got to say about anything regarding the deficit in Washington.
There was a big sigh of what else is new over the weekend with respect to the Moody's downgrade. That said, it put a real spotlight on exactly what you're talking about. I'm having a hard time with the whipsaw, and you pointed this out last week, John, that we were talking about trade. The world is trade. Now it's all deficit. And we're not talking about trade. These things are intertwined. There is a question if you need the growth to offset the deficit, how you get that growth with some of the tariff rates that are on, and how those negotiations continue as that reality bites in Washington, D.C.
Which is why Terry Haynes thinks they actually get this bill done in July 4th. And that comes up to the date that there's this reprieve when it comes to reciprocal tariffs on Liberation Day. So getting everything done in July. Then this administration will be off to the races. It's so much more challenging in Congress. Barclays said this. They said they don't expect the Moody's downgrades to actually change votes in Congress, but could force selling of treasuries, which have much more bigger impact on Congress, which in the end kind of changes votes in Congress.
It just dials up the volume. Dials up the volume as we kick off a new trading week. And your trading week looks like this. Coming up a little bit later on this week, you're going to get numbers from Target and Home Depot at a time when the president is piling on the pressure on Walmart to absorb the costs associated with tariffs.
Yeah, but we haven't heard a public walkback of what Doug McMillon said on the call. And frankly, Scott Bessent took some real venom out of that. So if you wonder if Target and Home Depot reiterate some of the message that we heard from Walmart.
How much of a PR problem could this become? further down the line. I hated it when the previous administration tried to blame inflation on Biden-inflation, you know, on greed inflation and all those silly things. It was ridiculous. They came out with a massive fiscal package, shoved it through an economy that was supply constrained, and we got inflation. It had nothing to do with corporate greed. That was ridiculous. And this is too.
I couldn't agree with you more, which raises the question, do they actually succumb to that and hit it on their margins, or do they band together, or do they do what Tim Cook did, which is we're just going to have to raise prices independent of any policy changes. Prices are just going up, and maybe you're going to have to eat it.
Equities are down this morning. You've got to eat this. We're down 1% on the S&P 500. Yields are higher. This dollar is weaker. Coming up this hour, Jack Manley of JP Morgan with the US stripped of its AAA credit rating. Kathy Jones of Charles Schwab as 30-year bond yields break back through 5%, and Neil Dutter of Renmac as President Trump tells Walmart to eat the tariffs. We begin this hour with stocks lower and bond yields higher. Jack Manley of JP Morgan Asset Management writing, I don't think we are out of the woods just yet. There's a lot more policy uncertainty, which will translate into more macro uncertainty, which will translate into more rate uncertainty, which will translate into more volatility. Jack joins us now for more. Jack, good morning.
Good morning.
Is the worst behind us?
I think the worst is behind us, but I don't think the coast is clear just yet, John. I mean, there's a lot clearly going on underneath the surface at the moment. Headlines every day that seem to fine-tune the output of any sort of model that you may have. And I always like to remind people when I'm having conversations with our clients that trade and tariffs, that's what's been dominating headlines at the moment. Now we're getting, of course, some discussion around the fiscal side of things. That downgrade over the weekend helps to accelerate or emphasize that discussion. There are also significant changes to the regulatory environment coming down the pipeline. There are significant changes to immigration that are happening and evolving and will continue to get more impactful. We're in the early innings of this ball game. There's a lot more time until midterms. There's a lot more time until the presidential election. And when you're talking about years in Washington, that's essentially an eternity. There's a lot that can happen. And so, you know, I think, yes, you know, peak trade tariff enthusiasm in Washington, that is probably behind us. Does it mean the market's just up and to the right from here until the end of the year? I don't think so.
Let's pick out one security, one number. 30-year bond yield, 5%. Two questions. How much does that constrain Republicans in Washington? How much does it constrain this equity market?
I think it constrains policymakers a lot more than it constrains markets. You know, I think of this as somebody as, you know, I'm a relatively young guy. I'm living in the city. I'm not on the property ladder right now. And with treasury yields where they are at the moment, especially the further you get along the curve, the harder it is to get on that property ladder. And as we know, you know, owning property is a quintessential part of the American dream of how you define something like that. And this administration is going to lean very, very hard, and we see it on the pressure on central bankers, on Jay Powell in particular, to move rates lower. You know, you mentioned, Lisa, we of course need a little bit of growth to help to offset whatever's going on with deficits. You know, we also need lower interest rates to help to inspire some of that growth. It's very hard to grow when you have long yields that are as high as they are right now. And I do think that's going to force policymakers to rein in some of these fiscal discussions. On the equity side of things, though, I mean, we're kind of back to where we were, you know, last year and the year before, which is that the rally that we've seen since lows earlier this year has been driven overwhelmingly by those magnificent 7 names. They're up on long-term secular trends like technology, microchips, artificial intelligence, obviously, in particular. And if you are talking about a 5, 10, 15-year long-term secular trend evolution revolution, then 5% on the 30-year is not going to make much of a difference. Maybe for those smaller companies, maybe for those companies that are more sensitive to rates, but those magnificent 7, they're relatively insulated.
I'm struck by the fact that maybe models have changed, the parameters at least for these models have changed. Torsten Slok put out a deck this morning talking about how there's declining foreign participation in 30-year Treasury auctions, and that relates to U.S. equities as well. What we heard from Mark McCormick is that pension funds around the world, particularly in Scandinavia, in Canada, have really been selling U.S. assets. There is an anger and there is a look for something else that has potential better growth opportunity. Isn't that a structural change that removes some of the dynamism, some of the underlying momentum in U.S. equities in addition to bonds?
There have been sell America sort of you know, periods or periods of enthusiasm around selling America in the past, and all it takes is time to get over that. I mean, I think at some point, you know, we have clear evidence, I would say, that there is room for negotiation, that these trade hostilities could lower, which in theory could make us all a little bit friendlier, you know, over the next couple of months, couple of years. But I also think it's very hard as a global investor, regardless of your sentiment around the United States and the administration and current policy, it's very hard to ignore some of these companies that are out there that are doing the bulk of the heavy lifting in global equity markets. And I think when push comes to shove, a lot of these pension funds will have mandates to maximize returns for their participants. A lot of individuals saving for retirement on the private side of things are going to be looking for those meaty gains, and it's going to be really hard to get that outside of the States.
So you don't think that there's a structural change that moves any kind of outperformance away from the U.S. elsewhere?
No, I mean, that's the question I've been hearing constantly, Lisa, is how do we think about, the next 15 years? Have we abandoned this previous regime? And I have to say, no, I don't think that's the case. I mean, when I look at what's going on with foreign markets, in particular in the developed world, I like to think about things thematically, and I like to think about things thematically overseas, because valuations, which are always like the biggest reason why everybody wants to invest in foreign markets, clearly don't make much of a difference in and of themselves. You need something, you need some sort of catalyst, you need some sort of theme. And when I think about the themes that are taking over foreign markets, international developed market banks have done extraordinarily well over these past few months. European aerospace and defense companies have done extraordinarily well over these past few months. I mean, real, meaningful outperformance underpinning that sort of higher level outperformance of these ex-US markets relative to the States, the biggest outperformance that we've seen in decades. But European banks are doing well not because they're innovating, but because interest rates aren't negative anymore. And you can't make money if you're a bank when rates are negative, and now rates aren't negative. And is there a structural shift there? Will the ECB never go back to negative interest rates? Yes, that's probably true. But it's not like we can expect 20% returns out of European banks every year for the next 15 years. European aerospace and defense, I think it's actually a very similar story. There's a lot of pent-up demand here, with Europe not having spent a whole lot on its collective defense over these past couple of decades, now being forced to pony up a little bit more cash on that front. But at the end of the day, these are industrial companies. You're not looking for 15, 20% out of these names over the next 10 to 15 years. So this, to me, feels like a tactical story, and it's got legs. It's interesting, and these underlying shifts are real. But it feels like we've just sort of rebased ourselves higher in these markets, as opposed to unlocking some sort of new, secular trend or shift. I think tech is still where it's at, and I know that right here is the best place to do that.
What are you telling clients to do?
What am I telling clients to do? I like bonds right now. I like shorter duration fixed income.
So I can't sell you a 30-year with a 5% yield?
No, I don't think so, my friend. Okay. I'm sorry. I'm sorry. I don't want to touch any of those. And you know what? I've got a 30. That's been sort of the story for a long time, though. And I do think it's very interesting. We talk about this downgrade over the weekend. Stocks and bonds are back to moving in the same direction, because stocks and bonds move in opposite directions really only when you're looking at growth shocks. And what's driving rate markets right now is not growth shocks or growth risk. I mean, a lot of that recession risk is off the table given the trade deal. Now it's concerns around fiscal discipline, about this ballooning budget deficit. And when rates are moving up in response to those things, it's bad for stocks, it's bad for bonds. So I don't want to be very long duration, but I do like fixed income for its ability to protect against a growth shock, because as we talked about earlier, we're not out of the woods just yet. There could be a recession on the horizon. And then on the stock side of things, it's boring, but I like U.S. assets. I mean, maybe I like foreign markets more than I have in a long time, but I still overweight U.S. assets. I certainly like large cap companies, and I'm frankly kind of indifferent between the growth and value split, because you're just looking at a big old index that's going to have a lot of growth and a lot of value in it.
To your point, these aren't growth shocks, they're policy shocks. Yeah. And stocks and bonds continue to trade in lockstep. A 30-year yield higher by close to 8 basis points. The yield now 5.02%. Your colleague, remember this, Priya Misra, JP Morgan, 30-year. It's a risk asset I don't want to touch.
I heard that all morning in my head. I was thinking, she just nailed it. And that's the reason why everybody says we're bullish on bonds, the belly of the curve. Maybe out to 7, maybe out to 10, but 30-year, absolutely not.
We'll see if we can sell Jack a 5-year later in the program. Jack Manley of JP Morgan Asset Management is going to be sticking with us. Yields are up across the curve, but much more so at the long end of the curve. The 30-year, 5.02%. With an update on stories elsewhere this morning, let's cross over to Yahara Anand for your Bloomberg Brief. Hey, Yahara.
Hi, John. NVIDIA CEO Jensen Huang is everywhere. He unveiled new products, including faster chip systems and software in Taiwan earlier today. He introduced updates to the ecosystem around NVIDIA's accelerator chips, which are vital for developing and running AI systems. The goal is to broaden the reach of NVIDIA products and get more industries and countries to adopt AI. Meanwhile, Israel Prime Minister Benjamin Netanyahu said Israel will take over all of Gaza as the military announced it would carry out an unprecedented attack on Hamas. In addition, Israel will start allowing aid trucks into Gaza for the first time since March. Netanyahu said it needs to make sure there is no starvation crisis in the territory. And Morgan Stanley's chief U.S. equity strategist Mike Wilson says investors should buy any dip in U.S. stocks after Moody's downgraded U.S. debt. Wilson says he sees a greater chance of an equity pullback as 10-year yields move above 4.5% in reaction to the downgrade, but notes that his team would, quote, be buyers of such a dip. That's your Bloomberg Brief. John?
Yahara, thank you. Need Mike to define that dip. 1% move after a 5% plus rally in a single week. Does 1% get it done?
We can have him on and talk about that. Is this sort of the new threshold? He was also talking about 6,100. To get above that, you really have to have earnings per share upgrades, and you're not seeing that. So there are some other thresholds here. There are other things at play, so maybe the dip is maybe bigger.
Yeah, in the context of the rally off the April low, it's like this big right now. We're down about 1% this morning. Up next, getting the tax bill over the line.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets.
Not much stability this morning. Up next on the program, Bloomberg's Tyler Kendall joins us live from the nation's capital. Live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Before we get into the losses this morning, think about the rally over the last week. 5% plus on the S&P, close to 7% on the Nasdaq 100. We snapped the winning streak. It looks like this morning. Here are the losses. We're down by more than 1% on the S&P. We're down by 1.5 on the Nasdaq 100. Under surveillance this morning, getting the tax bill over the line.
The plan is to move it to the Rules Committee by midweek and to the House floor by the end of the week, so we meet our original Memorial Day deadline. I think it's going to send a very important message of stability to the stock market and the bond markets, and as I mentioned, to job creators and entrepreneurs and risk takers. This will be the pro-growth economy that we have been waiting for and that the American people voted for. We're going to deliver on this, and we'll get everybody in line to do it.
So here's the latest this morning. The House Budget Committee approving President Trump's big, beautiful tax bill. 4 hardliners on the House Budget Committee voting present, allowing the bill to advance after securing a promise from party leaders to speed up Medicaid cuts. Joining us now from the nation's capital, Tyler Kendall. Tyler, let's go through the timeline and the potential obstacles still ahead of us.
Yeah, hey, John. Well, House Speaker Mike Johnson says that he still wants to get done the entire reconciliation package by Memorial Day, but to be sure, there are still some big hurdles that need to be clear. And while these fiscal hawks say that they have in writing from House leadership some of these planned changes, including speeding up work requirements being implemented for Medicaid and also rolling back those tax credits, those clean tax credits under the IRA, to be sure, the actual bill text has not yet been changed, so negotiations are ongoing. We are expecting those changes to be implemented come Wednesday when the bill goes in front of the Rules Committee. But even as fiscal hawks bolstered their argument to their colleagues, perhaps amid the Moody's downgrade, at this point it really is uncertain whether or not they'll get the sort of aggressive changes that they are advocating for. I mentioned this last hour on this program, but I did have the chance to catch up with Congressman Chip Roy on Friday on a one-on-one basis before that vote was delayed. He's perhaps one of the most vocal members of the House Freedom Caucus, and he sits on the Rules Committee, which is where this legislation is headed next. And he told me that they are advocating for the immediate implementation of these Medicaid work requirements, considered to be pretty ambitious, not to mention that it will face pushback in the Senate and put the White House in a politically fraught position. Now, John, of course, the other big sticking point that we're looking for in order to get this deal all wrapped up by next Monday would be what happens when it comes to lifting that SALT cap. At this point, there hasn't been movement on a deal and, of course, raises more questions when it comes to revenue raisers.
Tyler, Terry Haynes of Pangea says that the One Big Beautiful Bill, he calls it 1B3, can pass by July 4th, become a law by July 4th. What are the hurdles potentially to get to that moment?
Well, we have to keep in mind, Erin Marie, that there's a few issues by doing this as one big, beautiful bill, which is that, yes, Republicans do not have to negotiate with Democrats. They get to pursue this fast-track sort of route, but they do have to negotiate amongst themselves, not just within their own chamber, but also in the coordinating chamber. And once this bill gets to the Senate, things could really completely change. And Medicaid changes are really one of the big sticking points in the House version of this bill. But once it heads over to the Senate, we've already heard from some key Republicans, including Senator Josh Hawley, who says that he will not support anything that could limit somebody's access to those benefits. So that's going to be a really big sticking point that we watch going forward here, because keep in mind the Senate does have to get to work on this bill as well.
Tyler Kendall with the latest in Washington. Thank you. Jack Manley of JP Morgan Asset Management still with us. Jack, let's continue this conversation, but I want to talk about some of the economic data we've had so far. You mentioned consumer sentiment is rock bottom. Is that an economic survey or a political poll?
It feels like it's become a little bit more political, John. I mean, I look at consumer confidence numbers over the last several decades. I mean, we have data going back to at least the early 1970s, and I think it is stunning when you realize that confidence numbers in April are the second lowest they have ever been in history. We're talking about worse than dot-com bubble, worse than 9/11, worse than the financial crisis, worse than COVID. And the world doesn't feel that scary right now, especially given some of the headlines that we've gotten over these past couple of weeks. I mean, not amazing news, right? But is this truly the worst, or I guess the second worst things have ever been in the last half century? I think the answer to that is probably no. The risk with soft data is that they have the tendency to become hard data if they're left to their own devices for long enough, right? That sentiment persists for long enough, then all of a sudden you might see these things realized, and that could be realized from a growth perspective. It could also be realized from an inflation perspective. Inflation expectations are about as high as they've been in several decades. But I really hope that the headlines, that trade deal about a week ago today, help to calm those individuals that might otherwise not be feeling so good. We see those numbers come up, and then soft data start to reflect the hard data reality that we've been looking at.
When it comes to the entire policy proposal and the tax bill, we've talked a lot, and analysts have talked about how extending TCJA was a removal of a headwind. But given the new concerns about the fiscal deficit, the Moody's downgrade, is it now actually putting a headwind back in play?
I think so. I mean, it's really complicated when you are dealing with such enormous numbers from a fiscal perspective. I mean, trillions that we run in deficits every year, and of course, any sort of tax cuts that we have, even without the incremental increase in SALT deductibility, even without the elimination of taxes on tips or Social Security benefits, we'll be adding trillions of dollars to this deficit. And when it comes to spending cuts, what I'm hearing right now, it really feels like you're picking up pennies in front of a steamroller. Like the biggest things that you can do to meaningfully move the needle from a spending perspective in Washington have to do with entitlement benefits. And it doesn't have to do necessarily with these work requirements, although I'm sure that would help. I mean, we need to fundamentally transform how Social Security works. I was a history major in college, so I always like to lean back on my history degree, and I always like to remind my clients that the Social Security Administration was introduced during the second Roosevelt administration, FDR administration in the 1930s, when most people didn't live much beyond retirement age. Like, the program was never designed to support you for 30 or 40 years. It's not the way that it's supposed to work. We need structural changes like that, and that kind of thing is certainly not in the cards right now, and it's certainly nothing that could get passed in the next week or couple of months. So I feel like we ultimately come back to this problem that, yes, we have an enormous amount of fiscal pressure right now on the government, but with the Treasury Secretary telling us that we shouldn't really care about that downgrade. And frankly, given the conversation we had earlier, maybe he's right. I mean, maybe this is something that's been baked in for a very long time.
Yeah.
I don't think it's going to meaningfully change the narrative.
Jack, you understand the problem. Lisa, the problem is the solutions we need. It's political suicide for many of the people down in Washington.
Which is the reason why it hasn't happened time and time again. At this point, there's some people saying maybe a 5-year, 30-year yield would be the pressure that they need for it not to be political suicide. We'll see. You ask about Mish, and the sort of political poll aspect of it. That still has import, because that also still does carry weight in Washington at a time where that clearly has been weighing on people's minds and has changed the conversation.
You need the pressure to come from the bond market.
Yes.
The question is 5% on a 30-year the pressure that's going to get it done?
It doesn't sound like it based on the rhetoric. But what level will it do? 5.5%? 6%? 7%?
Quick move to 6 might wake them up.
Yeah, that would wake them up. Like a fresh brew of coffee.
It might wake them up.
Yeah.
I just don't think it's 5. We're back to levels where we were in April.
And it hasn't been dramatic. That's also been really important. It hasn't been a seismic change that's really caused disruption.
Jack Manley at JP Morgan, thank you, sir.
Thank you.
We don't want a quick move to 6, just to be very clear about that. Up next, Kathy Jones at Charles Schwab as 30-year bond yields break through 5%. Live from New York City this morning. You're watching Bloomberg TV. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Five-day winning streak on the S&P collides with some bad news for the US government. Equities are down by 1% on the S&P. On the NASDAQ, we're down by 1.5. I think you have to take a step back, though, zoom out and think about the rally we've seen off the lows of April. Huge rally, including a big run-up last week, 5% plus on the S&P, close to 7% on the NASDAQ. I know you're all interested in the bond market moves, so here they are, 2-year, 10-year, 30-year. 30-year yield higher now by some 8 basis points, 5.02% on a 30-year. And much has been said so far this morning about the accompanying dollar weakness we're seeing. And it's real, it's true. It's something we should be thinking about. Dollar weaker against everything in G10. But there's an additional point I think we need to make, and we tried to make it on Bloomberg Surveillance a few times already this morning. You're not seeing a bid into another haven asset. You're not seeing a bid into bonds. Yields are higher in Germany. They're up in the UK. They're higher in Japan as well. Yields are up around the world.
So this really calls into question this narrative that the U.S.'s pain is going to be Europe's gain or Japan's gain, because ultimately it's not that clear cut. There's something else going on where people don't like the U.S., but they don't know what to like, so they go to gold. And that has been a story for a long time, and that seems to be the similar story this morning as we try to parse out how much reality there is from fiction around the Sell America trade.
Bond yields are up, the dollar's weaker, gold is trading higher, up by 1% so far this morning. With 2 hours until the cash open, your morning movers look like this. With Danny Berger. Hey, Danny.
Hey, John. Well, in that equity market weakness, it is Mag 7 that is leading us lower. Tesla being the hardest hit with this more macro type concern. Shares are down nearly 4%. But to your point, John, it is important to note that this led the gains last week. Tesla was up some 17%. Mag 7 did really well last week, rising every single day. Even so, shares are down. Now, in other tech news, you also have Alibaba shares, the U.S. ADRs, falling this morning, those by about 2.3%. The New York Times out with the story over the weekend that the Trump administration is more closely scrutinizing a deal between Alibaba and Apple to use Baba's AI technology on Apple products in China. Bad news for Apple if they are scrutinizing it, considering they're already behind on their AI products. But according to the reports to the New York Times, the U.S. administration looking at adding Alibaba and other AI tech names to a list of companies that can't do business with U.S. companies. Finally, wrapping things up with Reddit, this getting a downgrade from Wells Fargo to overweight to equal weight. The issue, according to Wells Fargo, is that demand for different searches, and it's not going to be going to Reddit. It's going to go to places like Google AI, with more and more beefing up of that technology. So I guess instead of going to Reddit to look for answers, we're just going to listen to the robots on Google AI for any questions we have. So those shares down 6.2%, John.
That's the future, apparently. Danny, thank you. More from Danny later in the program. On our radar this morning, Moody's stripping the US of its last top credit rating, cutting it by 1 notch from AAA, reinforcing worries about the nation's fiscal outlook.
So the commentary has been similar to what we heard from Scott Bessent, which is essentially Moody's tends to be a lagging indicator. We already got a similar downgrade of the U.S. by S&P and Fitch. And of course, the U.S. has been on watch for downgrades since late last year or the year before even. So this isn't a huge surprise. That said, and Priya Misra, who came out with the 30-year being a risk asset, had this to say: this is a reminder that it is expensive to kick the fiscal can down the road. And right now, that fiscal can is getting kicked once again. And that's the reason why a lot of people are focused on Washington.
Moody's in their statement talked about the interest payment ratios. And right now, if you look at our budget, paying off our debt, those interest payments are second line items after Social Security. So it's bigger than defense, it's bigger than veteran affairs. And this is the issue you have when the bond market starts to push back at a time when they're trying to pass another, quote, big, beautiful bill.
Manish Singh at Crossbridge over in London put it nicely. This is yesterday's weather report. What matters is the policy that got us to this place. not the call from Moody's, Fitch or S&P. And the policy needs to course correct. Now, this is the bill that's going through in Washington that Anne-Marie's talking about. It is advancing. The House Budget Committee advancing the president's big, beautiful tax bill. Republican hardliners winning agreement from party leaders to speed up cuts to Medicaid coverage. But the fiscal hawks just got some fuel over the weekend.
They got some fuel. They voted present. They're advancing the bill, but two of those individuals are now on the next committee that's going to meet Wednesday, 1 o'clock in the morning. That committee needs to advance this bill in order for it to hit the floor and then to get to Johnson's Memorial Day weekend. We've passed the bill. No one really knows what's in the bill because they haven't actually written it down. It's all been verbal negotiations. But Jake Sherman at Punchbowl talks about the fact that there's a quicker phase out of clean energy tax credits as well as an acceleration of the implementation of expanded Medicaid work requirements, which means the moderates are going to push back. So any leverage or concession Speaker gives to one faction, he then has another problem on the other side. And there's so many competing factions, and the numbers are just too slim.
I don't think that we're at the point where we walk into one of these meetings with Bloomberg Anywhere and hold up the 30-year bond yield of 5%. But I think the fiscal hawks are getting closer to that moment. Might not be 5, but we're getting closer.
What does fiscal hawk mean? And I've been asking this question because everyone comes on and they say all the proposals aren't enough to get us even close to it. They're just sort of a pimple on, but there's this question going forward about what happens when you actually have to deal with entitlements, et cetera. Jack Manley was here basically running for office talking about how we have to reduce the age for Social Security. This is really the key question. Can they do anything that's politically palatable? And is there an understanding in the general public that this is something that has to get done, or do they have to see mortgage rates at 7% to do that?
Republicans would define it as for the cuts, against the spending. That's what they'd say.
Well, sure. At the same time, you can't cut your way to prosperity either. And this is a difficult moment.
For the tax cuts, I should say.
For the tax cuts,
Sorry.
yeah. Oh, for the tax cuts, yes. And that is part of the reason why you're seeing tax cuts on the business side, but also the idea of the salt taxes and what potentially can get on there. It's so confusing. This sausage.
The extras.
Yeah, I know.
There's a lot of extras in there.
Yeah, but they're extras and they kind of have to happen. And I don't know. This is going to be a real fun one to watch.
Well, if they don't cap the salt tax, it goes the salt state and local tax deduction, then it goes to basically infinity. So they also need to do something if they want to rein in salt as well.
Yields are up by 8 basis points now, 30-year, 5.02%. Got to squeeze in this story as well. President Trump saying he will speak with the Russian leader at 10 a.m. about, quote, stopping the bloodbath in Ukraine. Sources telling us here at Bloomberg that Putin believes he has the upper hand as he looks to break through Ukraine's defenses by year end.
So this basically puts into question whether or not Putin's going to come on this phone call and offer any meaningful concessions. And then if he doesn't, he continues to slow walk it, then what's the administration response? There is a lot of chatter that potentially this administration at some point might be willing to double down and go harder when it comes to sanctions to try to force Putin to the table. This issue lingered over Trump's entire Middle East trip. Every single day, he teased out that he might go see Putin in person. That didn't happen, but they will have a phone call.
That phone call taking place 2 hours and about 23 minutes from now. So look out for that conversation. Let's turn to markets. Bond yields higher across the curve. The dollar weaker. Equities lower as Moody's strips the U.S. government of its top credit rating. Kathy Jones at Charles Schwab writing, this is not a case of the U.S. not having the capacity to pay the debt. It's the willingness to reduce the deficit that is the issue. Kathy joins us now for more. Kathy, welcome to the program. Just your initial reaction to the news from Moody's over the weekend.
Yeah, it really wasn't a big surprise, as you indicated earlier. They had them on negative watch. They're following S&P and Fitch. As I watched the negotiations over the tax bill or the budget bill, I thought, oh, well, we're not getting anywhere. We need to go to get our house in order. So not a big surprise, but it does bring forward all the issues that you've been talking about, that we're not on a path to sustainability, something we need to address, but Congress doesn't seem willing to address.
I feel like every couple of years we talk about the bond vigilantes grabbing their pitchforks and getting ready to go out there and pick it, and it never actually has any staying power because other people say, actually, what you don't want, we love. How close are we to the bond vigilantes getting the upper hand and really shaping the narrative here?
Yeah, I've never been a big fan of the bond vigilante story because I remember the 80s and it was more about inflation than it was about the budget. But that being said, in 1985, we got sequestration, which actually did help get the budget back in order. How close are we? I don't think that we're looking at a stampede out of treasuries, but I do think that when you combine the whole policy mix we have, tariffs, a lower dollar that goes with that, and this sort of deglobalization trend, then you get a steady march higher in long-term yields because you're discouraging inflow of capital that we need. So I think that we just continue to see a steady climb in yields from here until something changes. Either the economy gets a lot weaker and we look at more Fed rate cuts, or we get some sort of fiscal deal that actually makes sense.
Kathy, when it comes to a fiscal deal that actually makes sense, what are you talking about? Is there anything you see right now on the policy proposals?
Yeah, I mean, I'm not a policy analyst, but if I sat down with a spreadsheet today and said, how do I get back to 3% deficit relative to GDP, I wouldn't be cutting taxes on everybody, and I would, have to look hard at some of the spending that we're doing. But that's not what's going on. Now we're giving tax cuts and on top of tax cuts, and spending is maybe trimmed a little around the edges on Medicaid, but really all that does is on Medicaid, you're just going to limit access. They're already Medicaid spending to hospitals and to doctors is at a bare minimum level. So you're just limiting access to health care for part of the population. And yeah, maybe that gets you a little ways, but it's not going to turn the dial.
Kathy, in the grand scheme of things, we're having this conversation when things are good. The hard data's still okay. The hard data's still okay, and we were running budget deficits north of 6% through the previous administration when the economy was in expansion and GDP was running at 3%. Kathy, how much confidence do you have that if we do indeed go into an economic downturn, that this bond market rallies and yields fall?
Well, I think they'll fall just not as much as they would otherwise if we didn't have such a heavy debt load and we weren't pursuing these policies that are in conflict. Again, trying to get a weaker dollar, limiting trade, deglobalizing, all of that is going to be negative for getting the capital inflows we need to attract buyers of our bonds. So we can cut rates, but in line with slower growth and lower inflation, but they're not going to go back to levels that you might otherwise have thought.
Given that, Kathy, does that limit the argument for bonds, just as you talk to potential clients, as a counter-cyclical hedge the way that they have been traditionally?
Yeah, I was looking at the correlations between, say, equities and bonds over the weekend, and we had that big dislocation in April. Now we've gone back to a more normal correlation. I think we may see more of those dislocations. So what does that mean? Is bonds don't provide as good a hedge as they once did, but I think that it's going to be periodic dislocations rather than long-term dislocation, because eventually the policies will probably send the stock market lower, and you'll need to be somewhere. And frankly, a 4.5% to 5% Treasury yield is not a bad place to sit. We've been just advocating staying shorter, benchmark a shorter duration and up in credit quality, because we're not willing to take a lot of duration risk in this environment.
You're not alone, Kathy. That's for sure. Kathy Jones at Charles Schwab. That is the consensus position at the moment from pretty much everyone we speak to. They don't want to go out along the curve.
If you want to buy a 30-year bond, please call in and tell us why. Yeah, exactly. A 30-year leveraged 3 times bond. Let us know why, because ultimately it seems like there aren't that many takers out there.
Should we start doing phone-ins?
I think we should. I think that'd be really fun. Hi, I would
love
a 30-year.
Way too scared of doing phone-ins. Who's going to screen them?
Yeah, if they don't get screened, that would be a problem.
That's wild.
Yeah, well, maybe we could try that.
I'll take a pass on that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Shares of Alibaba are falling 2.2% in the pre-market following a report that the Trump administration raised concerns over a potential deal between Apple and the Chinese tech giant. The New York Times is reporting the Trump administration is scrutinizing a plan to make Alibaba's AI available on iPhones. Meanwhile, flights are being delayed or canceled at Paris's Orly Airport for a second day. It comes after air traffic control systems suffered a breakdown that caused significant disruptions yesterday. Airlines have been asked to reduce flights by 15% today, down from a 40% reduction on Sunday. And in sports, the NBA Conference Finals matchups are all set after the Oklahoma City Thunder blew out the Denver Nuggets in Game 7. They move on to face the Minnesota Timberwolves. That series begins tomorrow. Meanwhile, the New York Knicks are back in the Eastern Finals for the first time in 25 years. After beating the Boston Celtics, they'll be taking on the Indiana Pacers on Wednesday evening. That's your Bloomberg Brief. John?
Very cool. Yahara, thank you. More from Yahara in the next hour. Up next on the program, eating the tariffs.
Walmart is, in fact, going to, as you describe it, eat some of the tariffs. Walmart will be absorbing some of the tariffs. Some may get passed on to consumers.
Just how much? That conversation up next with Neil Dutta of Renmac, live from New York. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Here's a quick snapshot of the equity price action for you. Equities lower, but off session lows. We're down by 1.1% on the S&P, and the Nasdaq 100 we're lower by 1.5. Under surveillance this morning, eating the tariffs.
Walmart is, in fact, going to, as you describe it, eat some of the tariffs. On an earnings call, because of SEC requirements, they have to give the most draconian case. So Walmart will be absorbing some of the tariffs. Some may get passed on to consumers.
So here's the latest this morning. The White House putting the pressure on Walmart. The president writing over the weekend, quote, Walmart should stop trying to blame tariffs as the reason for raising prices. Eat the tariffs and not charge valued customers anything. Neil Dutta of Renmac joins us now for more. Neil, welcome to the program. Lots to get through. Let's start here. We know by definition the importer pays the tariff. How are the costs shared? That's the question. How do you think the costs will be distributed in the months to come?
Well, I think the important thing here is the admission that obviously the exporter is not the one that's paying, right? I mean, that's an implicit subtext here. They're basically admitting that it's American companies and consumers that will end up eating the costs. So I think that's an important sort of admission by omission there. You know, look, I mean, I think some of it's going to get passed on to consumers, maybe half. I just, you know, obviously retail profit margins aren't especially high to begin with. So I think it's going to be challenging for a company like Walmart to not pass on at least some of the tariff burden. But keep in mind that, you know, the bigger issue is what that means down the line. I mean, if corporate profit margins get squeezed, ultimately they're going to have to pay the piper somehow. And I mean, meaning consumers, and that might show up in the form of weaker hiring, weaker wage growth, and that's another sort of effect on consumption in and of itself.
Hold on a second, Neil. This is actually a really important point. There's a question about how much some of these retailers can increase prices where it becomes not necessarily inflationary, but disinflationary because it suppresses demand. Are you seeing any evidence that that's actually happening, given that reports have been pretty mixed and dependent on just execution as much as anything else?
Well, I think companies are going to find significant resistance in terms of, you know, trying to pass on the higher costs, because ultimately the inflationary story boils down to a household's budget constraint. And when you talk about tariffs, I mean, whatever goes, I mean, you think about price and quantity, whatever goes into P is ultimately going to come out of Q. And so, you know, look, I mean, right now, nominal GDP growth is probably barely growing at 4.5%, if you can maybe talk me into that. So if you get a significant increase in inflation, you're going to get a big drop in real growth. I mean, it's as simple as that. So look, I mean, the household's budget constraint is getting worse, not better. And I think that, you know, that ultimately means that, you know, anything that's passed on to consumers will mean weaker real economic activity.
We've gotten a pretty big consumer stimulus over the past month. That's come in the form of significantly lower oil prices. And this is something that we've heard the administration talk about quite a bit. And I wonder how much that offsets some of the constraints on household budgets and actually allows more money for retailers, for goods, for things that might be more expensive due to the tariffs.
Well, I mean, we have seen a widening in spreads, right? So it's not like the drop in oil prices has translated sort of one for one to gasoline. So consumers haven't really felt the benefits. But no, look, at some level, I mean, I agree with you that, you know, the drop in crude oil prices is meaningful, and the Fed should sort of take that into account when they think about how they're you know, looking at interest rates policy setting, because you can't pick and choose which supply shock you want to pay attention to. On the one hand, you have a negative supply shock from tariffs. On the other hand, you have a positive supply shock from the energy markets. And, you know, a typical rule of thumb, I believe, is a 20% drop in crude prices takes about 30 to 40 basis points off of headline inflation. So that'll, you know, provide a meaningful sort of tailwind to the disinflation story. And remember, oil doesn't matter a lot for, you know, underlying inflations, but it does matter for sort of the monthly swings in headline prices. So I think it's something to keep in mind here.
Neil, I want to get your take on what's going on in Congress. We have this big, beautiful bill slowly passing through the committees. Potentially it's going to hit the House floor by the end of the week. You've always talked about the fact that this is just basically baked into the market because it's an extension of TCJA. But now, potentially, does this become a risk for financial markets?
Well, I mean, I don't know. I mean, I always talk to you about what's going on in D.C. I don't really have many views on that myself.
Well, you have a view on what it means for financial markets.
Well, I think basically what they're doing is removing a headwind, not putting in much tailwind. And so, yeah, I mean, I don't think you know, I guess my sense is that there's not much new coming from this. So if the bond market's keying off of the fiscal negotiations, it doesn't really make that much sense to me. You know, so I do think a lot of that was already baked. And you're seeing, you know, yields go up globally. So I don't really think it's U.S. fiscal that's driving what's going on in the back end of the Treasury curve here.
And Neil, what do you think it is then?
I just think that, You know, that's a good question. I mean, I think there's some residual sort of you know, fading of recession risk. I mean, it's not just the U.S., right? I mean, it's also global in nature. I mean, you have a lot of countries kind of stepping up in terms of fiscal. It's not just the U.S. You have it in Europe as well. But I think it's sort of it's a combination of economic resilience. You know, people kind of getting tired of betting on a recession that hasn't happened. And, you know, I think it's a sort of global fiscal story. So, you know, the U.S. story, I think, by comparison to some of these other countries, there's not as much new there, I think, as is the case for some of these other countries.
We've been trying to sell 30-year treasuries to some people who've been coming on the show to see who wants to buy them. And so far, nobody has wanted to buy them, even those who believe in some of the resilience of the U.S. economic story. So are you one of those who sees this as an opportunity to invest in the dynamism of long-term interest rates?
I mean, look, I mean, to me, there are too many things in the economy that don't work with interest rates up at these levels. Therefore, interest rates will have to come down. So, yeah, I mean, I'd be buying duration here.
You think it's self-limiting, Neil? I think it's an important point. You believe it's self-limiting, that the laws of gravity still exist for the bond market?
Absolutely. I mean, how long can you sustain a situation where interest rates are running above the rate of nominal GDP? And I mean, and as you know, my economic outlook is generally more on the cautious side of the consensus. So I think if economic momentum is slowing down, interest rates will come down as a result.
No data. Neil, appreciate your thoughts as always, buddy. No data there of Run Mac on the bond market with yields back through 5% on 30s.
Yeah, he's a buyer. Well, he would
be.
We
found one.
We found one. His argument was actually something similar to what Jack Manley said, which is a self-limiting factor, that at a certain point, it is not sustainable. Emery, to your point about $1 out of every 7 going to interest payments, at a certain point, does it become sustainable for the U.S. government? That said, what's the mechanism to change that, right? I mean, are they going to just buy bonds at the long end? Are they going to, I'm talking about the Federal Reserve. How do they bring it down if we don't have this sort of fiscal responsibility
Interest
going
on our debt is currently the fastest growing part of the U.S. budget, and it is the second line item after Social Security. It's bigger than defense spending. That is why this is also challenging at this moment for Congress.
Bond sell-offs are typically self-limiting. As Neil described them, yields go up, you slam the brakes on the economy, yields go back down again. But it assumes that yields fall in bad times. And I just wonder how much that logic is being tested at the moment.
Well, we aren't necessarily experiencing a negative growth shock, and that will be the reason why. If you do get a negative economic data print, it's going to be really important, not just with respect to gauging where the market's sort of gaming out the market, but to understand what the response is in bond markets.
The third hour of Bloomberg Surveillance is just around the corner. The lineup looks like this. Vinu Krishna of Barclays, Scott Ciccarelli of Truist, Yelena Chiretseva of the Conference Board, and Krishna Mamani of Lafayette College from New York City this morning. Good morning to you all. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah,
how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Markets have wanted tax cuts and markets want fiscal responsibility.
The market is laser focused on these negotiations.
So much uncertainty is built into the market.
This is going to be the most expensive bill in U.S. history. And so how are we going to offset it?
If we get big deficit numbers coming out of this tax bill, I don't see how equity valuations hold here.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. This is Bloomberg Surveillance, and the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P taking some heat out of the recent rally. We're down by 1% on the S&P 500. On the NASDAQ, we're down by 1.4. The toxic mix. Bond yields up, dollar weaker. The 30-year through 5%. Yields higher by 7 basis points, 5.01% on 30s. And in foreign exchange, the dollar weaker against everything in G10. Euro dollar, a 1% move, 112.73.
Yeah, basically just turning up the volume on a narrative that Moody's really highlighted over the weekend, which is that the U.S. has a fiscal trajectory that feels unsustainable. This is coming off a really big week of gains last week. This falls into this narrative of whether the current trade cycle and how much has the world changed. Real question that I have is, are we just ping-ponging from narrative to narrative? And have we settled on which is the bigger risk right now? The growth shock or a potential positive policy mix that could surprise to the upside? And right now it feels like the market is toggling between the two from day to day.
The tug of war continues. What we can say is that downgrade collides with a big effort down in Washington, D.C. to advance a major tax bill in the nation's capital.
So they advanced out of one committee last night. They're going to meet Wednesday, and then if potentially advanced out of there, it goes to the floor. But this is going to be hurdle on top of hurdle. And right now, what we've been saying all morning, the fiscal hawks have momentum behind them. They didn't vote yes, they just voted present. And 2 of those individuals are going to be there on Wednesday. And they have more momentum to say, this is not doing enough to cut our spending.
How much relief will consumers get? This week is a big week for retail earnings. Home Depot, Target follows Walmart last week. Walmart basically telling the world that they can just about hang on before they have to pass on higher costs to consumers, potentially in the next several months. And you've got major pushback over the weekend by the President of the United States.
And then it was softened by Treasury Secretary Scott Bessent, who basically acknowledged that, yes, They would eat some of the tariffs and their profit margins, Walmart, but they would probably pass some along to consumers. It seemed to almost, as Neil Dunham pointed out, tacitly acknowledge that it wasn't going to be paid for by the exporter. It's going to be paid for in some degree by U.S. companies and by the consumer, which raises the question about how much this allows Target and Home Depot to do the same. They might not say it's due to tariffs. They could just say, we see pricing pressure across the board for exogenous threats that we have, macroeconomic babble.
Dynamism and all that stuff, yeah.
One interesting point that the Treasury Secretary brought up, that Lisa, you just brought up with Neil, is the price of oil. He said that the CEO of Walmart told him the most important price for consumers is the price of gasoline. He says this administration got the gasoline prices down, but not so much as the president continues to say $1.98. I still have not found a single gas station that's going for $1.98 a gallon.
Those retailers this week need a heavy dose of McKinsey, don't they?
Oh, yeah.
This could be a PR nightmare.
Well, except on the flip side, they could say, you know, we love the strong American consumer, America, Von America, and
Have you
look
seen
at all
how
these
many
things.
commercials are out there at the moment?
Totally, everyone's trying to do this.
Autos,
Exactly.
manufacturers, Mercedes, their home is in America.
I mean, so this is going
And
to be...
they all start with how many people they employ in the United States.
So expect more of the same, and then expect marginal pressure because of that strength on pricing.
Well, Flexport's Ryan Peterson made a really great point to me when I was in D.C. a few weeks ago. He said Amazon should have flipped this on its head. Put a sticker on everything that was made in America and forced that out to its clients. Instead, it took the opposite approach and got absolutely bamboozled by this administration.
Walmart getting ready to roll out some commercials, I imagine, in the next couple of weeks.
Can you imagine?
Equities right now in the S&P, negative by 1%. Yields are higher, the dollar's weaker. Coming up, Vinu Krishna of Barclays. The stocks struggle to extend a 5-day winning streak. Scott Ciccarelli of Truist looking ahead to this week's retail earnings. And Yelena Shiracheva of the Conference Board on rock bottom consumer sentiment. We begin this out with stocks lower following a U.S. debt downgrade. Vinu Krishna of Barclays writing, with hard data still resilient, deficit concerns building, and the Fed in no rush to cut, rising 10-year Treasury yields pose a challenge for equity valuations. Vinu joins us now for more. Vinu, good morning.
Good morning.
You and the team at Barclays don't have a recession call, you have a slowdown call. And you've had that slowdown call for quite a while. Put it together with all of that, what does it mean for equities?
Yeah, just to be clear, our economists had a recessionary call in Q3 and Q4, which they changed recently as the news on China-US trade came in, right? So yes, but our view broadly, the beginning of the year was a moderating of growth, and that remains intact, right? And for equities, it's been very complicated. At the beginning of the year, that setup actually looked pretty good for us because we were expecting earnings to accelerate 11 to 12% this year, better than last year. That changed as the tariff narrative took over. And in fact, when I was here about 6 weeks ago, we cut our earnings number to 262, right? And I think I'm quite comfortable with that because we've gone through a lot of ups and downs. It's been a roller coaster, but it is a fact that tariffs are higher than what they were before. And companies are really struggling to deal with it. And there are 4 or 5 different avenues they're using. And I think that is what is going to show up in earnings. First and foremost, they are taking a margin hit. If you look at retail, pharma sector, med tech, the list goes on, they are absorbing it. There are a handful of areas where they're increasing prices, like part of industrials, and a select retail where there's a brand and things like that. On the other hand, companies are trying to push some costs onto their supply chains, for example, right now. Some of them are on an ongoing exercise of trying to move the supply chains out of China, right? And more importantly, in the near term, everybody's stacked up on inventories, big time. That's why you saw Q1 GDP going to negative territory because imports have exploded.
So to what extent do you think front-loading is masking some underlying weakness in this economy?
It is, absolutely. I think what's going to happen is the front-loading is going to ease, and that's why I feel at this point quite comfortable that expecting a earnings sort of recovery back to where we were at the beginning of the year is an unlikely scenario because while tariff uncertainty has eased, I think companies still don't know how to plan for it. These are big decisions, especially on capital spending. So the pressure is eased, but the upside catalyst for earnings is not as robust as it was. Meanwhile, coming to your original point when you were reading out, I do think that the 10-year rates starting to creep up, they've been up 30, 40 basis points in the last few weeks, is once again going to act as a source of constraining equity multiples, which have recovered quite nicely.
So you see more downside risk right now than upside risk at a time when you've got both the pressure from the 10-year, but also pressure on the downside from margin compression and potentially slower growth.
Yeah, it's a mixed bag on the earnings one. On the one hand, like I said, the 262 earnings number is respectable. It's still up 6% compared to last year, but where I struggle with for it to reaccelerate back to where we were expecting at the beginning of the year, mainly because of some of the ongoing concerns on margins. I think on the multiples front, the story is far, far more interesting because we saw a massive derating in equities over the last 6 weeks, or call it 3 or 4 months. Now, for the bulk of S&P outside of tech, it's pretty much recovered. In fact, that some pieces of market are half a turn or so ahead of where they were at the beginning of the year. Big tech, which was a source of derating, which derated more than 30%, is still about 4 handles cheaper compared to where they were at the beginning of the year, at a time where they posted exceptional earnings in Q1 thus far. 6 out of the 5, 5 out of the 6 have done really well. So I think it's a mixed bag as far as the equity market is concerned.
This is fascinating because at the beginning of the year, everyone was saying you need to go to equal weight, not market weight. That is where you have to go because you have to expect that the outperformance is going to come from the other areas. Have we flipped that on its head? Where suddenly, when we wait for some of these retailers to come out and explain how they're going to be taking a margin hit, now people are going back to market weight because big tech's going to drive the ship.
Exactly. In fact, I am so glad that we didn't change our call on big tech, right? So, because the reason was simple. Even with decelerating earnings at 16%, we felt that is still fantastic compared to the rest of the market. Now, what actually happened is important to figure out. As we came into the earnings season, consensus came down to under 15%, so modest coming down. But for the rest of S&P, it was scaling down much harder and below long-term trends. Big tech earnings right now are 27%, 12 percentage points ahead of where consensus was. So I think, the fulcrum of this market has been big tech, 30% weight, 25% of S&P earnings. And if that cracks, the point is that correlations to the rest of the market also tend to typically increase. So I think big tech being in the driver's seat is actually a very healthy sign for the market that's not going to collapse.
Big tech was the star of Trump's Middle East tour. Jensen Huang was at every single stop. An individual, though, that kept getting called out by the president was Tim Cook of Apple. Do you like certain tech names because of their relationship right now with this White House?
Well, I don't want to go into single names. I like to think of big tech as a group, right? And one thing I would say to your point is that if you look at the historical correlations between these 6 stocks, it's been 40 to 50%. So at different points in time, a particular stock or a handful of them were better positioned. So clearly when you talk about certain names, like for example, you mentioned Apple, they have a significant exposure to China, right? And they are looking to get out of their, or diversify their manufacturing base. So those are ongoing concerns the market will have to deal with. On the other hand, you have idiosyncratic things, like there are issues our analysts have pointed out of whether the server useful life depreciation actually reflects the change in technology pace right now, right? So I think big tech has its set of issues right now, but in aggregate, when you look at names, Google, Meta, Microsoft, all of them are in a much, much better position than what the worst case scenario was, right? And the big narrative I heard, for example, when I was in Europe, call it 2 months ago, that everybody was saying the AI productivity story, is faded. And our point is, at least in software productivity, it's a tangible 30% improvement. So if you're a tech-centric business, that is very real, right? And what you're finding now is some of those productivity benefits are percolating across the economy, not at the pace you want, but still slowly percolating.
Ivina, did you find it a harder sell this time around in Europe to sell the US equity story to the Europeans?
Oh, absolutely. When I went, I think part of it is an emotional trade, right? I think our approach has been so, what's the term I'm looking for, aggressive, that I think that has a visceral reaction, which shows up in let's fade the US and let's focus on home. But I would argue at this point in time, that trade has probably played out. With the moderation in the tariff story, and with the narrative finally shifting towards some of the growth policies, even though that's creating concerns around deficits, for example. I do think that that story is changing. But it is a fact that if you put the aggregate of the policies undertaken right now, most of the world wants to diversify in a meaningful manner while keeping a healthy exposure to the U.S. There's no way you can cut exposure to the U.S. and get respectable returns, certainly in the equity markets.
Vinu, it's good to see you. It always is. Thank you, sir. Vinu Krishna there of Barclays. A lot of people writing notes this morning about buying the dip, not just Mike Wilson and Morgan Stanley, but just moments ago, Max Kettner of HSBC saying this bond market move doesn't constrain this equity market until you get into the danger zone, and he believes that's a 10-year closer to 4.7%.
Yeah, which goes back to the question that you were asking before. Is this really a dip? Is this viable? And when you look at what's going on with respect to stocks, but it points to how people are seeing this as something very transitory. I felt really bad. Very, short-lived. People felt like there was going to be some sort of change in narrative. Where I'm just
Chairman Powell words all over the place. Put some meat on those bones. This from Max just moments ago. We'd view any fall in risk assets as an opportunity to scale up exposure. Seen that in a few places already this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Anand. Hey, Yahira.
Hi, John. The House Budget Committee approved President Trump's tax and spending package after Republican hardliners won agreement from party leaders to speed up cuts to Medicaid. The bill now heads to the full House and then to the Senate, where the deeper Medicaid cuts and other provisions face scrutiny, if not outright opposition. Meanwhile, the New Jersey transit strike is over, but train service won't resume immediately. The Brotherhood of Locomotive Engineers and Trainmen approved a deal Sunday night to end New Jersey's first rail strike in 40 years, but rail operations are not set to resume until tomorrow. Because of that, New Jersey Transit encouraged commuters to work from home today, if possible. And sad news, former U.S. President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has spread to his bones. Biden posting on X this morning saying, "Cancer touches us all. Like so many of you, Jill and I have learned that we are strongest in the broken places. Thank you for lifting us up with love and support." That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour. Up next on the programme, the Morning Calls Plus. Scott Ciccarelli of Truist looking ahead to this week's retail earnings, including Home Depot and Target from New York City. You're watching Bloomberg TV.
In New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The opening bell's 1 hour and 12 minutes away, and equity futures are down by some 1% on the S&P 500. On the Nasdaq, we're down by 1.5. We've basically had almost a 20% rally off the lows of April. We had a 5% plus move last week on the S&P, close to 7% on the Nasdaq 100. We're down by 1 to 1.5%, and there are notes out there talking about buying the dip.
Right. This is the question. Is this a dip? Is this a viable dip? Is this something that even counts as anything, given the fact that we saw a 9% gain last week in just the Magnificent 7 stocks alone? It seems like maybe that's the case. Load up on risk assets, according to maybe Max Kettner and Mike Wilson over at Morgan Stanley.
Outside of equities, bond yields are higher. The 30-year through 5%. The dollar's weaker against everything in G10. That's the price action. Here are your morning calls. First up, Barclays upgrading Williams-Sonoma to equal weight, saying the company's raised prices could provide, quote, tariff cover. Williams-Sonoma is down by 1.3%. Next up, Stifel cutting its price target on Lowe's to 250, highlighting a wait-and-see approach after a softer start to the year. And finally, Evercore adding Home Depot to its tactical outperform list ahead of earnings tomorrow, expecting sales guidance to move the stock higher. Sticking with retail, busy week of earnings kicking off with Home Depot, followed by Lowe's, Target and TJX later this week. Scott Ciccarelli with a word of caution on Target, writing the company was already in a very challenging position before the tariffs and now faces significant risk to what was already expected to be a soft year. Scott joins us now for more. Scott, welcome to the program, sir. Let's talk about the weakness already for the months ahead and how the tariff situation could just reinforce that weakness.
Well, I think you've had a couple things happen. First of all, February, early March, the weather was absolutely horrid for a lot of companies. You had a little bit of, let's call it a Christmas hangover, a lot of spending, right around the holidays, and then you get deeper lulls in between. And then, you had a later Easter on top of it, and then you have all the geopolitical situation. So you've had kind of a rough first quarter, but for most companies, I'd say Target's actually one of the exceptions. Sales trends seem to improve during the course of the quarter.
Scott, how do you think they managed inventory? They've been in positions where they've had too much and not enough. And we've seen big stock corrections. I remember May 2022, I think it was, coming out of the pandemic where we had that massive gap lower. Scott, how do you think they've handled things this time around?
My guess is it's going to be pretty lean. I think a lot of companies, they want to make sure that they're playing relatively cautious, especially with the geopolitical headwinds, the way we've seen them with all the rhetoric coming out of D.C. So my guess is retail inventories will be reasonably lean, and I don't think you're going to be facing a lot of markdown risk. That's really what threw people off back in 22, as you mentioned. And so I don't think companies want to get back into that same spot.
Will they be eating the tariffs, as the president, the Treasury Secretary says, when you think of the likes of Walmart?
Well, my guess is every company is going to try and manage it a little bit differently. I mean, the general playbook says you push back as much as you can onto the vendors, then you're going to have to eat a piece of it, and then you're going to pass on the rest via price increases. And each company is going to try and find, what's that optimal, kind of profit strategy. Specifically for Target, yeah, I do think they'll have to eat some of it, because otherwise you're going to be in a situation where your price gaps versus Walmart versus Amazon is just going to continue to blow out much wider, and puts you in a really tough competitive position.
Scott, a week ago, we basically had this détente with China lowering the tariff rates. The president, over the course of the week, was talking about a number of countries want to do negotiations, and if they don't get to an end game, they're just going to set a new tariff rate. Is there a thinking in the retail space that by mid-July they will have clarity?
I don't know if there's an actual time frame associated with it, but I do think you saw companies like Walmart, like Target, like Home Depot, basically delaying shipments from China, hoping that in a couple of weeks you'll get some sort of clarity. Now, eventually, where it ends up, is it July, like where kind of the 90-day pause, we'll get full clarity? I think that's certainly the hope, but there's no guarantee. I mean, we've seen kind of tariff commentary change not just week to week, but day to day. Right. So in that kind of environment, I think you try and manage your business as well as you can, and you kind of hope for the best, if you will.
How much is Walmart taking advantage of this moment to really steal market share at a time where they already have been? And arguably, that's Target's biggest issue right now.
Sure. Yeah, I think Walmart is really putting the pedal down, if you will, and trying to open up price gaps as much as they can. Here's a stat for you. Since 21 relative to 25 estimates, Target will not have grown their sales base, whereas Walmart will have grown their business by almost as much as Target.
Oh my gosh. So this is the reason why people are actually looking at Walmart and seeing them as both the leader when they come out and saying they're going to pass along some price increases, but also the big competitor. And we're talking about not just Target, but also Amazon, also a lot of the grocery stores. I'm just wondering how much you see that as the environment that we're in, a winner take all. It's not going to be Home Depot and Lowe's. It's going to be one or the other. And it's going to be a real sort of reckoning for any players that have a strategic advantage or not.
Yeah, look, I think there's some verticals, retail verticals, that are a little more insulated than others. You can call it home improvement, you can call it auto parts, et cetera. But, to your point, whether it's, Amazon, Costco, Walmart, they are scooping up the vast majority of that general merchandise sales between the three of them. And, that becomes a really tough situation for competitors to operate in. And what Walmart has done is, very similar to what Amazon did in terms of building all these alternative revenue streams, be it membership, third-party marketplace, advertising, et cetera. And so they're actually helping subsidize the core retailing business, buying something from a vendor, selling it to a consumer. And when you do that, and they're driving their own margins down, despite retail margin down, despite this massive sales growth, it just makes it harder and harder for all the smaller companies to operate in.
Scott, just before you go, I wanted your thoughts on how to approach earnings season in the C-suite and how things have changed. It just feels like such an unusual moment. They have to decide whether to scrap guidance, keep guidance, cut guidance, offer dual guidance. And Scott, now they need to think about how to talk about pricing with the president breathing down their neck. We saw a report from Amazon a few weeks ago on Amazon that maybe they'd break out the tariff costs. The president calls Jeff Bezos. Then all of a sudden, we see from Walmart, they talk about higher costs and maybe passing it on to the consumer. And the president has to call the Treasury Secretary, who then calls Doug McMillon of Walmart. And then the president's tweeting over the weekend about it. Scott, how unusual is this for retailers in America? And how do you think they're going to approach things this week?
Well, let's face it, it's unprecedented in modern times, right? Like, we haven't had this kind of price increase. I mean, we've dealt with, whether it's the GFC, whether it was, COVID, we've dealt with various emergency scenarios, but we haven't faced, a tariff scenario the way we're looking at it. So what I can tell you is, companies, some are just choosing to scrap guidance. Some have tried to provide some sort of parameters. If this becomes the tariff rate, then this happens to our sales or earnings. Other companies, early on the stage, it's just like, look, we don't really know, so we're going to continue to guide without tariffs for the moment. And then as tariffs start to impact our P&L, then we'll start to revise what the expectations are. Now, investors, they've got to make decisions kind of before that. So I think that the investors and people in our seats, they're really in a tough situation of trying to handicap what the impacts are going to be.
The calls could be more interesting than the numbers themselves. Scott, appreciate your time, sir. Thank you. Scott Ciccarelli there of Truist. Up next, we'll talk about the consumer with Yelena Shulacheva of the Conference Board and Krishna Bhamani of Lafayette College as consumer sentiment hits rock bottom. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The open about 60 minutes away, coming off the back of a 5-day winning streak on the S&P 500 and snapping it quite cleanly this morning. On the S&P, we're down by 1%. On the Nasdaq 100, we are lower by 1.5. In the bond market, yields are higher on a 10-year and a 30-year by 6 or 7 basis points, close to 8 basis points higher now on a 30-year bond yield, back through 5%, following the downgrade from Moody's, losing the last rating of a AAA credit rating over at the United States, and that unleashes some higher bond yields. And a weaker US dollar. Euro dollar, 112.64, positive by 0.9%. Worth pointing out where we have been, though, over the last week or so, both in equities and in foreign exchange. Stocks have had a monster rally, 5% plus on the S&P just last week. And the dollar, over the last month, rebounding, just shown some strength, Lisa, over the past few weeks.
Which is a reason why Mark McCormick had a great point, which is maybe what is to watch is not necessarily the relative performance as much as the direction. And if this type of correlation continues with a weaker dollar, higher yields, and potentially a sell-off in risk assets, that's when people start to take notice about a longer-lasting trend in terms of a shift away from the United States.
This mix spooked people a few times in April. You're seeing a repeat of this mix this morning, and we'll see if it continues. Certainly, that's what it looks like this morning. Bond yields are higher, dollar's weaker, equities are lower. With 60 minutes until that cash open, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. And with that equity lower move, it is big tech. It is Mag 7 that seems to be leading us on the way down. In some ways, it makes sense. It's what led the way up yesterday. Maybe it's longer duration stocks like tech that you start to get worried if bond yields are bumping up around 5%. Nvidia down 2.8% with that sell-off, despite the fact Jensen Huang was in Taiwan at one of Asia's biggest electronic forums, touting new technology, that vastly being overshadowed by the macro story right now. We do have a little bit of deal news. A few hours ago, BlackRock confirming earlier, Bloomberg reporting that they will be buying TXNM. This is a New Mexico power supplier. Those shares jumping 9.3% with news of that take private. The price tag on that is $5.7 billion. It's a real trend we've seen. A lot of investment being made in power supply with more energy demands, more electricity demands, especially with data center growth. Now, finally, rounding things off with Netflix, getting a downgrade from JP Morgan this morning from overweight to neutral. The analysts there saying, look, we're not long-term bearish on this. We're so bullish on the stock, but it hit a record price on Friday. It's run up more than 30% this year. Basically, all of the good news for 2025 is already priced in, so those shares falling 1.8%, John.
Danny, thank you. Appreciate the update. Danny Berger there with your movers. Going into the opening bow. Busy day of Fed speak coming up as well. Mike McKee, our economics and policy correspondent, will be conducting some of that. He joins us now from the Atlanta Fed conference. Good morning, Mike. What's the focus over there?
Focus over there is the same as the focus as it is in New York and around the world, and that is what happens with U.S. markets and where do we go with tariffs. The uncertainty premium is built into every conversation. Nobody knows where we're going with this. Raphael Bostic was on CNBC earlier this morning and said that it'll take 3 to 6 months before it becomes clear enough for the Fed to know what's going to happen, and that is basically the feeling here. And you talk to the investors who are here, And they're thinking, we just kind of sit on the sidelines. It's a little risky to start putting on any specific tariff-related trades because you don't know what the president's going to do minute to minute.
Mike, we've just had repeated policy shocks, and it really started for most people on April 2nd with Liberation Day, these massive tariffs that for many were unexpected. Now the attention has shifted to the tax package going through Washington. What are the thoughts that are slowly evolving, quickly evolving, given the weekend's news on that front?
Well, basically, the feeling is it's going to be a stimulus to the economy in 2026 because they're putting a lot of benefits to people into that, the child care tax credit, the no tax on tips, that sort of thing. And so we should see a bit of a tailwind. The question is, can that overcome the headwind that comes from people paying more because of the tariffs? So there's kind of a confusion about that as well, and it does weigh on the Fed when you talk to Fed officials. It's just one more thing they have to try to figure into what they're doing and what they think is going to happen because, of course, monetary policy works with a lag. The downgrade, Lisa put it well, the downgrade has everybody looking at what's going to be happening first in the bond market, then to the dollar, and then to the equity market. And if everything goes south there, that adds another weight onto it with the wealth effect impacts and the consumer confidence impacts. So this is a really uncertain time, perhaps the most uncertain time any of the folks here have seen.
Mike McKee, looking forward to your conversation, sir. Look out for the Atlanta Fed President, Raphael Bostic. Speaking to Mike McKee later on this afternoon, 2:45 Eastern Time. Let's stick with the economy. Yelena Shuracheva of the Conference Board writing, we expect hard data to move closer to the soft data in the coming months. April retail sales is just one of the first signs. Yelena joins us now for more. Yelena, good morning.
Good morning.
Why do you believe the soft data is leading data and not misleading data?
There's a lot of noise in the data, of course, and the recent gap between the soft data and the hard data has been really tremendous. So I think it just takes time. It's a time differential. So I think we're gonna see hard data moving down to the soft data. Why? I think just simply because consumers are concerned. They're concerned not only about tariffs, they talk about it all the time, but they're concerned about their jobs. They're concerned about the state of the labor market. So we are going to get another update on the Conference Board Index of Consumer Confidence next week. And the thing that I will be looking at is the differential, the labor differential, the things that consumers say about the labor market. In the April survey, that survey showed the worst reading on consumers' share of those who say fewer jobs will be available over the next 6 months.
How does this contrast with what companies are saying and how CEOs feel about the situation?
Well, we're going to find out about it again on Thursday, May 29th, when the CEO Outlook survey will be available from the Conference Board. So the latest survey, which was released back in February, showed a big increase in confidence among CEOs. And we're going to see if that is going to change because we had quite an interesting 3-month period.
How long do you expect this policy uncertainty to last?
For a long time. I don't see that abating this year. So we're probably going to see some decline, some abatement in the trade-related policy uncertainty. But we're going to see other types going higher. So sovereign debt uncertainty is going to be on the rise. Fiscal policy uncertainty, here's another one. So I think we're going to see these waves, like one type going into the next one. And I think that will affect both businesses and consumers.
What you see in the surveys, does it mirror any other time in U.S. history?
Well, some readings are really concerning because they go back to the COVID time, they go back to the Great Recession. And that to me is a little bit more concerning. If people see the labor market at the point that they thought about it back during the Great Recession, that's a concern. We're not at that point in the hard data just yet, but we may see some freezes in the hiring going on to continue.
So it feels like we've been flipping back and forth, depending on the day, about whether it's a growth shock or whether it's a positive policy shock that's going to cause some of the sentiment. And we've seen recession both be a base case for people, both be pushed off into a more remote case more recently with the policy shift when it comes to trade. Why are you still more squarely on the growth shock, which potentially could even percolate into recession?
We never expected a recession in our baseline case. We actually expected a significant slowdown, and this is what we continue to expect. And there are different things. So consumers, they're already telling us, and they're already showing us actually that they are going to step back, right? Businesses, are you going to do your capex if you don't know what's going to happen? Housing is another one, again resurfacing today with mortgage rates going higher and delinquencies on the rise, right, because of what happened with forbearance regulations.
Well, here's what people are having trouble with, people being myself. We have people like Bank of America come on. You have people from Citigroup come on, and they say credit card spending pretty much at the same level that it has been. People are still spending. You hear from the retailers, a lot of strength, a couple pockets of weakness, but otherwise consumers remain resilient. What is it this time around that's going to make the soft data that much more relevant than it was, say, 2 years ago, when it wasn't as much of a leading indicator as it had been in the way past?
Inflation. That's the answer. So the University of Michigan survey, the cutoff was before the Walmart, announced they're going to raise prices. So the Conference Board survey, the cutoff date is this week. So that will include that announcement. So when consumers start seeing prices going higher, they're not going to be happy. They will pull back. And I think businesses, too, like a lot of uncertainty about all these different things that are happening is going just to put a speed limit on how much they spend. So
you don't think the trade truce between the US and China does some work to unravel some of that?
I think, maybe, potentially, but, I think it's already behind us. The news flow is so intense that, a lot of other things happened since then, and that could, affect uncertainty.
That was only a week ago, and it feels like a lifetime ago already, right?
It was. I think I was a different person last week. Tomorrow I'm going to be ChatGPT.
The speed of this news flow is just absolutely unreal. What a news cycle. Yelena, good to see you.
Nice to see you.
Yelena Shulitz over there of the Conference Board. We need to turn to the bond market. Krishna Mamani of Lafayette College with this to say: I still like bonds despite the recent pain, for the simple reason that I think inflation will not be as significant an issue as the markets expect. Krishna joins us now for more. Krishna, welcome to the program, sir. Before we get to tariffs and inflation, downgrades. How relevant is that downgrade from Moody's, if at all?
Well, so I think Besant is right on this count. That is, the downgrade itself should have happened a while ago, and it really isn't much of a driver of anything in the market. I think if the downgrade had come when S&P 500 was at, let's say, 5,400, 5,600, I don't think we'll be talking about in terms of impacting equities and risk assets very much.
But Krishna, as you know, it's coming after a big conversation through much of April about the future of the safe haven status of the United States following a big policy shock on the trade front. And that's raising questions about the future of a tax bill advancing down in Washington, D.C., and what it means for fixed income going forward from here. What do you think it does mean?
Well, so I think the real issue for the economy right now is, as Yelena was talking about, is really the slowdown and the tax bill. But it isn't tariffs, and it isn't really the impact of the fiscal deficit that much on the state of the economy, or even the dollar for that much. So I think what we are talking about here is the tariff situation will get resolved. The tax will probably gets passed, but with lower level of fiscal expansion in 26, 27 than what we are expecting right now. That's really not a bad environment for bonds. And especially in the light of the fact that inflation is really not going to be that big a deal. It's, tariffs impact in price levels, but it's really not as inflationary as people are thinking in terms of. It's a consumption tax rather than inflationary. So if that is the case, inflation is not a big deal, and real rates are high, and you end up with a tax package that is more reasonable rather than meaningfully expansionary. I think that's not too bad for the bond market.
So, Krishna, are you buying 30-year bonds?
Well, so, in our allocation, for example, for an endowment, for example, what we are focused on is really the long-term return of equities and private equities in particular. So bonds, bonds are interesting, but we can generate bond-type returns out of low-vol hedge funds just as much. So, no, we are not buying it. In my private portfolio, yes.
Okay, so here's my question, Krishna. Why does it not concern you at all that we have a toxic brew right now, where you have bonds selling off, stocks selling off, and the dollar selling off in tandem at a time where people are making a lot of noise about the fiscal deficit?
Well, so I would say that you have to put it in a bit of a context. That is, all of this is happening after a significant rally on all of those things over the last month and a half. So, you know, we are taking profits rather than rethinking the basic strategy here.
Krishna, would you talk about in your notes that you don't foresee a recession but a slowdown? What would make you reconsider that actually the U.S. could tip into a recession?
Well, if the tax bill doesn't pass and tariffs get implemented, that's a fiscal consolidation for the history book. So I think that really would get us into a recession. If we have a reasonable tax package and the fiscal consolidation is, there isn't as much fiscal expansion, I don't think we get a recession.
Well, that's already baked in that we're going to get an extension of TCJA. The issue right now is potentially, a lot of people talked about how this was a removal of a headwind, but does this actually offer some risk given the fact that we have this Moody's downgrade?
Well, so I would say the fiscal consolidation or the tax impact effectively of tariffs of, let's say, 1% in GDP without any corresponding expansion on the tax package. If it is just a renewal of TJCA, then that's a different equation than what we are talking about right now with the current bill.
So right now, you see that there's a downside risk to growth. You see it because there is not necessarily more fiscal impulse coming from from Washington, D.C. Going forward, is this going to be something that can sustain some of the private credit, the private investment that's been ongoing in the U.S. economy? Or do you see something of a very difficult time, the fact that you are going to private assets?
Well, so, you know, I think private credit and things like that are really a reflection of credit growth and the fact the disintermediation at the bank level. If the Fed is really effective in changing bank regulations in a meaningful way, again, it's an open question whether they will away from, you know, just giving them a little bit of room to buy treasuries. I think if that happens, the expansion in private credit probably comes to, you know, the growth, it probably stops to some extent because banks will have an opportunity to do a lot of things. You know, without that, you know, if the U.S. economy and U.S. corporate sector is as good in shape as it has been over the last 2-3 years, I think private markets probably continue to do, from a growth standpoint as opposed to return standpoint right now, probably continue to do just fine.
Krishna, always wonderful to hear from you, sir. Krishna Mamani there of Lafayette College on what he thinks of the bond market right now. Doesn't seem too concerned about what we've heard from Moody's, and I have to say, after 3 hours of programming this morning, he's not alone.
Well, nobody really particularly is going to take a forward look from Moody's. It just kind of emphasizes a narrative that people can cling on to this morning. As he said, it's basically, after we saw this rip-roaring rally in all these asset classes, there's some profit taking that a lot of people are lining up to buy, evidently.
Puts a massive spotlight on the process emerging in Washington as they try to advance that big tax bill.
Right, and this process is going to be really challenging. I know Speaker Johnson has this Memorial Day goal. Potentially they'll get there, but then it goes to the Senate, and it's going to be incredibly challenging because of so many different factions evolving. The SALT caucus, the Medicaid caucus, the green incentives and renewals of potentially or rescinding of the Biden-era tax credits. This is going to be really challenging, and they want to get it done by July.
You think that's too aggressive?
It depends. If the president continues to jawbone then and send out troops and start putting the calls through, and Tyler made a great point, it's so big, everyone can latch on to at least something they got out of it, and potentially that's what we'll see.
Well, the fiscal horse can latch onto this. The 10-year yield that's higher by 7 or 8 basis points, back through 450, and Lisa, a 30-year that's now at 5.03% and higher on the session by close to 9 basis points.
Kevin Hassett speaking on another news outlet coming out and saying the U.S. debt is the safest bet on earth. Moody's decision is backward-looking. That talking about trade deals, I mean, this is all going to be a lot of noise as people try to position this in a way that seems benign.
A lot of people believe, with reason, that U.S. assets are the center of the market universe. And if they're not AAA, what is everything else? And I think that's a question we've got to ask. Do you really believe that you can get a bond market sell-off in isolation, in the Treasury market, that just sits there on an island, and everyone else is okay? I'm not sure that's how the market works.
And it's not how it's working this morning. You can see yields around the world that are increasing. You have seen the Japanese yields blowing out as well, in addition to German Bund yields. So it starts to raise the question, is this really a United States story or is there something bigger? And to the extent that the U.S. isn't exceptional, everything else isn't amazing because everything else has been pinned to the exceptionality of the United States. So this is the sort of conundrum for markets that people are grappling with.
The 30-year bond yield this morning higher by 9 basis points, 5.03%, with an update on stories elsewhere. With your Bloomberg Brief, here's Yahara.
Hi, John. As you've been discussing all morning, Moody's stripping the U.S. government of its top credit rating. The agency lowered the U.S. by one level from AAA to AA1 on Friday. Moody's cited the failure by successive administrations to deal with rising U.S. debt and deficits. Treasury Secretary Scott Bessent downplayed concerns over the downgrade, saying Moody's is a lagging indicator. Meanwhile, President Trump is set to hold a phone call this morning with Russian President Vladimir Putin. That's after Ukrainian President Volodymyr Zelensky met with Vice President J.D. Vance yesterday at the Vatican. Secretary of State Marco Rubio says President Trump is prepared to back new sanctions on Russia if today's talks don't go well. And the first Subway Series of the year was electric between the Yankees and Mets. The stakes were already high between the rival first-place teams, but the weekend series had extra flair with former Yankee Juan Soto returning to the Bronx for the first time as a Met. The Yankees won the series 2-1 after an 8-2 win last night. That's your Bloomberg Brief. John?
Yahara, thank you. Do you want a final word on this? Is that your final word?
$765 million for Juan Soto. What did he deliver? Really nothing. 8-2 blowout. Absolute blowout last night. Incredible.
How much do you like that mug?
I love this mug.
Great, we're going to break it.
Okay, up next on the programme, we'll set you up for the week ahead. Commercial break should be fun. Live from New York, this is Bloomberg.
The President of the United States does say he wants to keep a more mutually beneficial trade balance with these countries. What does a country like Egypt and Kenya and some of these others have to provide that won't completely dent their own GDP?
No, it's tough. I mean, there is the commodity side. There is the. I think it's less about bringing it to the table and more trying to take advantage of the hit elsewhere. So China exports 30% of all the textile exports to America come from China in 2023. It's something like $40 billion. And whatever the tariff rate ends up being on China, it's going to be a lot higher than it is on Africa. So there might be scope for African countries to say, well, let's move those textile factories.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The opening bout just around the corner, 37 minutes away. Equities sliding by 1% on the S&P, down by 1.4 on the NASDAQ. Your trading diary, your week ahead looks like this at 9 a.m. Eastern Time, a White House press briefing. Look out for that. 1 hour later, President Donald Trump holding a phone call with Russian President Vladimir Putin. 2:45, Atlanta Fed President Raphael Bostic speaking with Bloomberg TV. Tomorrow, Home Depot earnings. Wednesday, Target results. Thursday, PMI data and another round of jobless claims. And through the week, a big conversation about this tax bill. Joining us from the White House is Tyler Kendall. Tyler, talk to us about next steps to advance this bill.
Yeah, hey, John. Well, the House really needs to get going when it comes to negotiations if they want to end up passing this through the Rules Committee by a 1 a.m. Wednesday vote. Of course, one of the big things on the table here is what's going to happen when it comes to extending or moving up those work requirements related to Medicaid. I actually just caught up with NEC Director Kevin Hassett here at the White House, and I asked him if the White House would support that timeline, moving it up, and he said that they will do whatever it takes to get this reconciliation package through, because at the end of the day, this administration really is banking on these tax cuts getting through the House, excuse me, in order to fulfill the rest of their economic agenda. That's one sticking point that we're watching closely as negotiators get going on Capitol Hill.
Tyler Kendall, thank you. Tyler, appreciate it. That bill's advancing down in Washington, D.C. Will this bond market have something to say about it?
Yeah, well, it's already having something to say about it, maybe, on the margins. Is it enough to get some attention in Washington, D.C.? That remains to be seen. It does seem like people are trying to pick up the bond vigilante mantle just a touch. Nobody seems to want to buy 30-year yields, even when you end up with somebody, Krishna Mamani, who likes duration. You can find it in other places.
But where has everyone been? We've known that this bill is going to cost some $4 trillion over the next decade. That has not gone away. Potentially, maybe they see it actually coming to fruition. How quickly we've seen these four ultra-conservatives basically say, we're going to allow this to sail through. I still think this is going to be incredibly challenging. The margins are just too slim, and everyone is asking for something that, once you give it to them, creates a whole other problem for the Speaker of the House and the President of the United States.
What a way to start the week. Live from New York City this morning, a big morning already in the equity market, a correction after a 5-day winning streak on the S&P 500, a 5% plus rally on the S&P just last week. We pulled back 1%. In the bond market, though, this is what gets your attention, the mix between what's happening in fixed income and foreign exchange. A 10-year yield higher by 8 basis points, 4.55. A 30-year bond yield higher by 8 basis points, 5.02%. Combined with not dollar strength, but dollar weakness. And that's what spooked us back in April. And it might be spooking some people so far this morning. Coming up tomorrow morning, Ed Yardeni of Yardeni Research, the man who literally invented the phrase, the bond vigilantes, will be joining this program. We'll catch up with the former World Bank President, David Malpass, Philippe Singh of PGIM Fixed Income, Jim Karen of Morgan Stanley. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance. It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter, because then I got left alone. And actually, I think out of that period, we started to create better art, because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period, that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
In case you missed it on Balance of Power.
If we're going to get all this revenue from tariffs, why would the president be pushing for higher taxes on anybody? Because our understanding is for the wealthy, he's looking at a new rate of 39.6%, and I thought the Republican Party didn't stand for that kind of thing.
Well, you realize that the tariff revenues doesn't count toward the reconciliation numbers. Don't ask why. I can't understand why. We're running at like 20, 25 billion a month, and they're not counting it, but we'll leave that aside for another day. This is Washington. They have their own accounting practices. So the president's trying to make sure he gets no tax on tips, no tax on overtime, and no tax on Social Security. And if he says, look, the richest Americans, remember, he cut it from 39.6 to 37. So if he just goes back to what he did last time, you know, I'm in favor of that. I think it's smart.
Don't miss Balance of Power live every weekday.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Ruhodern in Buenos Aires, Argentina, and this is Bloomberg.
A downgrade leads to a sell-off. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, Morgan Stanley's Mike Wilson says buy the dip as Moody's strips the U.S. of its last AAA rating. President Trump's big, beautiful tax bill advances on Capitol Hill, but the legislation still faces obstacles. That downgrade, not the least of them. And the battle for AI supremacy ramps up again. NVIDIA unveils a tech to stay ahead of its competition. Shonali?
We're looking at NVIDIA shares this morning, Matt. We are taking a look at them, taking a dive at about 2.5%. This is along with the broader market, but remember, they will allow customers to use rival chips as part of their AI efforts to expand an ecosystem across data centers. They're also looking to buy a quantum computing company. We'll keep an eye on that.
All right, definitely going to be watching those Mag 7 shares. They're really a big reason behind the drop that we're going to see in equities today. Also, vaccine makers. They're among the few gainers this morning as COVID cases spike in Hong Kong and Singapore. Novavax just got full FDA approval for its COVID vaccine. So we'll be talking about them with our own Sam Fazeli today as well. Shonali?
And as Matt had earlier mentioned, Moody's is the last of the big 3 credit agencies to strip the U.S. from its top rating. Now, Treasury Secretary Scott Bessent took to the Sunday shows to explain that this isn't a direct result of the Trump administration.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. You know, we inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
A Morgan Stanley strategist, Mike Wilson, reacting to the credit downgrade by saying he would buy any dip in equities as long as the 10-year yield is above 4.5%. Let's discuss with Bloomberg chief correspondent of global macro markets, Liz McCormick. And Liz, I said, you know, the downgrade is not the least of the problems that Trump has with the big, beautiful bill, but it is really the least. No one cares, right? I mean, we get a little dip in equities after a massive gain last week. We get an 8 basis point rise in the 10-year. I mean, that's nothing for this.
You're desensitized.
Yeah, well, I mean, yeah, the market isn't going nuts, but
remember, we came into this in a backdrop where fiscal concerns were already top of mind for bond investors. So this adds to it. Like you said, 30-year went above 5% again. I mean, it doesn't help, Matt. So I think because obviously we had S&P downgrade the first time in 2011, we had then Fitch come in 2023. People knew this was eventually coming from Moody's, but it definitely makes the point that fiscal is top of mind. So I don't think you could just say, oh, whatever, you know. But I do think Scott Bessent, in what he was saying, the market wants to see it actually happen. They won't listen to words anymore. You know, the budget that's moving through the House, like you said, it doesn't look too pretty for the deficit outlook and debt. So that's what they're focused on.
And a lot of concerns about growing your way versus inflating your way out of a deficit. Now, I want to point out a chart that Torsten Slok was sharing at Apollo this morning. This idea that foreign buyers have already been reducing their purchases of longer-term treasuries. That 30-year in particular, that's now above 5%. How long does that continue? Does 5% not attract people?
Well, yeah, 5% has tended to attract people. And I would say, and I saw Torsten's chart, very cool. And he was talking at the auction bidding, right? His gauge of foreign demand. I would say overall foreign demand in the whole Treasury market, if you look at the Treasury data, has kind of been coming down. It's about 30%, but it's not falling off a cliff. We're still seeing buying. So I think maybe we don't need to be that concerned, but this kind of sell America trade did get revived today, right, over the weekend since Friday. But it's not screaming, like Matt said. 8 basis points isn't earth-shattering, but I do think it does keep giving people pause. You know, is it worth buying the dollar? Treasury yields, do we want to catch a falling knife? No one wants the long end. You know, everyone likes, you know, the middle of the curve, that kind of thing. So, and right now the Fed's doing nothing. So there's no kind of juice from the Fed cutting rates anytime soon. I see a lot of people saying they're going to cut again in December. So you're kind of in this middle ground here. And if this package comes out that, you know, it's going to be deficit negative in a big way, the bond market still has a reason to stay away from the long end.
This is the problem. Maybe it's not a scream, but it is a slow bleed. Bloomberg's Liz McCormick, we thank you so very much for your time. Now, in Washington, lawmakers are closer to adding trillions to the deficit as part of Trump's so-called big, beautiful bill. 1B3?
1B3.
1B3. Now, the House Budget Committee advanced Donald Trump's tax and spending package after party leaders agreed to speed up cuts to Medicaid health coverage. Joining us now, Bloomberg's Tyler Kendall. Walk us through the House, but more so the Senate's reaction to what we're seeing right now.
Yeah, hey, Shanali. So while fiscal hawks in the House did get in writing these promised changes from House leadership when it comes to moving up the work requirements on Medicaid, as well as rolling back more of those clean energy tax credits that were implemented under the IRA, to be sure, at this point, the text of the bill hasn't actually changed and the negotiations are ongoing. While fiscal hawks perhaps were able to bolster their argument to colleagues amid the Moody's downgrade, at the same time, it really does remain to be seen whether or not they're going to get the sort of aggressive changes that they are advocating for. So for sure, both sides, the moderates as well as more of these fiscal conservatives, don't appear super happy at the moment as they try to reach some sort of agreement. I actually was on this program on Friday right after I had caught up with Chip Roy, perhaps one of the most vocal members of the House Freedom Caucus, who told me that he wants to see those Medicaid work requirements moved up immediately. That is something that is going to be difficult for the Senate to get behind, as well as put this White House in a politically fraught position. In fact, Shanali, I actually just caught up with the NEC director, Kevin Hassett, here at the White House, and I asked him if they would be in favor of moving up those work requirements, and he said that they would if that's what it takes to get the deal done, because at the end of the day, this administration really is banking on getting this reconciliation